I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. India's elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins today.
Welcome back to Bloomberg Daybreak Europe. Let's turn the focus now to India, where voters in the world's largest democracy are heading to the polls in an election set to last 6 weeks. Prime Minister Narendra Modi is hoping to emerge from the mammoth vote with a third 5-year term. Bloomberg's Haslinda Amin is and has been looking at this for us. But before we go there, let's bring in our correspondent on the ground, Menaka Doshi, who was outside a polling station in the southern city of Chennai, the capital of Tamil Nadu state. Menaka, what is the mood? Good morning. Thanks for joining us, or good afternoon for you. What is the mood on the ground ahead of this, or at the start of this mammoth vote for India?
Well, the mood is hot. That's the best way I can describe it. And you will see fewer voters behind me than we did witness early this morning. As the sun climbs through the day, the voter turnout will fall. This is also a weekday. And then we might see a last-minute rush before the polling booth shuts down. But Tom, as you mentioned, this is an important election, both domestically and for the global economy. India is the world's fastest growing economy. It is the world's 5th largest economy, and this is the largest democratic electoral process in the world. Now, as you pointed out, Prime Minister Modi is looking for a third term, but that's not all. He's looking for a third term with a supermajority of 400 or more seats of the total 543. Now, here in Chennai, that ambition of his is going to be up for test because several parts of South India have not yet been charmed by Prime Minister Modi. In the last election, his party didn't win a single seat here. If he wants to be able to take the number of seats higher, he needs to win voters in the southern states of India. So that's the big battle that we will witness, not just here in Tamil Nadu, but in many other southern states. And then, of course, this is a 7-phase election. So we've got 6 more weeks of reporting to do in peak summer.
Menaka, you're going to be very busy indeed, by the sounds of it. Okay, so he needs to win the votes of those southern states.
And hot.
And hot, indeed. Stay cool, certainly, Menaka. How is he hoping to win over those voters then? What is the policy prescription that he's leaning into? The consequences domestically for India, huge, of course, but globally as well. This is a hugely significant vote.
Well, Prime Minister Modi's 10 years in power have been characterized by a few things. GDP growth, yes, but lower than in previous decades. But that could be contextualized to a slowing global economy. But it has also been a time when he has chosen to assert a fairly strong leadership style. He's chosen to emphasize majoritarianism and religion, and on the other hand, has announced and delivered a slew of welfare schemes, more recently put large amounts of money into an infrastructure push in India, and his constant refrain is that he wants to see India as a developed country by 2047. That's within 100 years of India's independence. So it's an interesting mix of politics that's taken place over the last 10 years. Though India is growing at above 7% in terms of GDP, there are weaknesses in the economy, such as very low consumption numbers, joblessness, which is a critical and chronic problem, and all of these need to be fixed in subsequent terms of Mr. Modi or whoever the next government will be.
Okay, Menaka Doshi on the ground for us in a steamy Chennai at the start of this marathon vote, of course, for India. Menaka, thank you very much indeed. Coming up, a deficit of high-quality iron ore. Switching focus is adding to the challenges of greening the steel-making industry. Our weekly deep dive on the green transition is next, and we keep across, of course, all the geopolitics for you and the market reaction. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
DOJ or other authorities
Could face bigger challenges. Britain's next.
It was going to keep
Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Okay, time now for our weekly deep dive into the green energy transition. A shortage of high-quality iron ore is proving a hurdle for the steel industry as it attempts to curb its emissions. Global demand for this type of iron ore is expected to outpace supply and could reach a deficit of 133 million metric tons by 2040. Those numbers from Yuchen Hua on BNEF's metals and mining team, who joins me now with all the expertise. Yuchen, how much more steel then demand will come from this energy transition?
Well, the energy transition will be a relatively small demand for steel, as the transitional sectors, including wind turbines and solar panels and electric grids, will use steel as the fundamental material. But this is relatively small compared to the traditional sectors, including construction and automaking. And that is to say, if the world is to get on track for net zero emissions by 2050, we estimate that this demand for steel from energy transition sectors will more than triple between today and the end of the current decade.
And steelmaking, of course, producing a lot of emissions. How then is the industry looking to clean up its act?
You're right. Steel production is not very clean today. It is responsible about 8% of the global CO2 emissions, about 5% in the EU. And that is because steel production today is still largely relying on burning coal to reduce iron ore into iron. And many steelmaking companies are betting on hydrogen as a replacement for coal for low carbon solution. And one big catch is, of course, the supply and cost of hydrogen in the future. But another catch is that the hydrogen-based direct reduction of iron ore requires very high-quality iron ore. Today, we are already seeing a shortage in the seaborne market for this grade of material, and that deficit is only set to grow in the decade as more demand, especially from green steel projects, ramps up.
And just very briefly, who's driving the momentum then in terms of that demand?
Currently, the Middle East is the largest source of demand for what we call the high-grade direct reduction grade iron ore. But of course, Europe is set to grow fast as the region looks to decarbonize, and particularly as free allocation of emissions in the European Union is set to be phased out. And Europe is on track to become the second largest demand center for direct reduction grade iron ore. That's overtaking Asia by the end of the decade.
Okay. Yu Chen-hua, thank you very much indeed from Bloomberg NEF's Metals and Mining team. If you'd like to hear more from BNF's analysts, download the Switched On podcast on Apple, Spotify, wherever you get your podcasts, and of course log on to the terminal. Coming up, as US officials confirm Israel has struck targets in Iran, we bring you the latest analysis and market reaction. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Israel launches a strike on Iran, according to US officials. But there are conflicting reports out of Iran about the extent of any damage. Iranian media reports the country's nuclear facilities are safe. Stocks slump as investors rush to haven assets on concerns of a widening Middle East conflict. Brent crude briefly spikes above $90 a barrel. Plus, voters in the world's largest democracy head to the polls. We are live in India as the country's 6-week-long election gets underway. Let's check in on these markets, I should say. Peak, of course, risk haven moves maybe have started to play out. We are still very much in risk-off territory, but the upside that you saw in some of those havens pairing a little bit, at least so far in this session. You're looking, of course, at futures still firmly in the red when it comes to the stock market picture. European futures pointing lower by 1.4%. FTSE 100 futures pointing lower by close to a full percentage point. And S&P E-minis looking at just above that 5,000 level. 5 straight days of losses across US stocks, pointing lower by 0.8% today. The hawkish commentary coming through from the Fed, but front and center for us right now, of course, is the geopolitics and this strike apparently by Israel on Iran. NASDAQ futures pointing lower by 171 points. Let's flip the board then and look at how the money has moved into some of those havens. You've seen yields move lower across the Treasury curve, undoing some of the selling pressure that we saw at the front end of this week when it comes to the US Treasury market. The benchmark at 455, yields down close to 7 basis points right now. The Bloomberg Dollar Index, the dollar is bid once again up 0.2%. Gold also getting a further lift, up a little over 0.1% at 2,382. 2,400 is seen as a resistance level for the yellow metal. We'll see if we break through that. $88.98 on Brent, having broken through that $90 level earlier in the day on the back of those initial reports, now up 2%, having seen a pop of over 3% earlier, but still $89 a barrel on Brent. Prices again up, and year to date, of course, we have seen continued price pressures coming through on Brent and WTI. Let's get the latest then in terms of this story on the geopolitics. US officials saying that Israel has struck targets in western Iran. That's after multiple reports from Iranian news agencies of explosions around the city of Isfahan. Iranian state media saying all military and nuclear sites are safe in the city. Let's get the details then with Bloomberg's Middle East anchor based in Dubai, Jumana Basetji. Jumana, what do we know then at this point about the strike?
Yeah, good morning, Tom. Well, ever since Iran's unprecedented attack on Israel last weekend, there's been rampant speculation as to how Israel were looking to respond. And indeed, it seems like the response has come overnight. Now, explosions were heard around Iran's third largest city, Isfahan, very early in the morning. Shortly afterwards, U.S. officials confirmed that indeed Israel had launched an attack on Isfahan. Details are still fuzzy at this point, but what we do understand is that the target of this specific attack was the airbase in Isfahan, which actually was the same airbase that Iran used to launch those drones and those missiles that they used last weekend for their attack on Israel. Now, at this point, what we are hearing from Iranian state officials is that they are downplaying the extent of this attack. They were very quick to say that none of their nuclear facilities had been targeted. There was no harm there. And that, of course, caused a bit of a turnaround in market because initially there was some concern that Israel were going to go after those nuclear facilities. And they're recently just saying moments ago, Iranian local media, Tasnim, has also said that there are no reports of an attack from abroad on Iran's central city of Isfahan or any part of the country, and that Iran's own air defense system was the source of all of that noises. So again, details are very fuzzy at this point, but analysts are quick to point out that if this is indeed the Israel response to those unprecedented Iranian attacks on Israel last weekend, then they are deemed to be quite limited and proportionate in nature. But of course, it is up to the Iranians at this point on how they will choose to respond.
Yeah, and give us a little bit more detail then, Jumana, in terms of that potential Iranian response and the implications.
Yes, so the Iranian state media have actually denied that a Security Council meeting is taking place at this point. So we haven't had anything from Iranian leadership. All that we can parse together is what we're hearing from Iranian state media. And as I just said earlier, they have been denying reports of extensive damage within the country. But what we do know is that Israel themselves are preparing themselves for a possible retaliation. We know that the U.S. Embassy in Jerusalem staff there have been warned about the possibility of a retaliation as well. But again, as we were just referring to, because this at this point appears to be a very limited strike on one specific military base, perhaps it could be deemed insufficient enough to worry a significant response from Iran. The background, of course, yesterday, the Iranian foreign minister was speaking at the Security Council, and he warned Israel against further adventurism. Whether or not this qualifies as adventurism, again, remains to be seen. It is a fast-moving story.
Yeah, absolutely. And as you say, that test will be crucial, won't it, in terms of the Iranian response. Jumana Pasedji, thank you very much indeed, with all of the latest, of course, on this unfolding story, joining us out of Dubai, our Middle East anchor. Let's get more of a deep dive in terms of the market reaction then. Treasuries jumping, of course, along with the dollar as concerns over an escalation, potential escalation. What has escalated? Is there further escalation in the cards? Of course, in the Middle East, bolsters that demand for haven assets. Some of that demand has eased off in the last couple of hours. Let's bring in Venram from Bloomberg's MLive team for the reaction to this. Ben, what is your take on the market response to what we're seeing in terms of Israel and Iran?
Morning, Tom. So far, the market's reaction has been pretty measured, and that reflects, as you said, just one strike so far on a military base. We don't know whether this is going to be the only retaliation from Israel and how Iran is going to react. So the reaction in the coming days will depend on how whether this is going to escalate and how protracted this new epicenter of conflict is going to be. But at the moment, the markets are kind of, there's been a measured reaction. There was an initial bit of flight towards havens, but as you said, that has come off a bit. But going forward, it will be the degree of response and how protracted it proves to be that will determine whether or not the havens are bid continue to be bid.
What are the preferred havens right now? We talk about the yen, we talk about the Swissy, gold. Some of the gains in terms of what we're seeing in gold have kind of eased off in the last hour or so. Then, where are the money flows when it comes to those preferred havens?
I think the three biggest preferred havens for this conflict are going to be the Treasuries, German Bunds, and gold. And if you look at, Treasuries and Bunds are kind of self-explanatory because, that's where the money is going to go because, people want the safest assets and you can't get safer assets than those. In terms of gold, in the past 2 months, it surged a lot. Already on signs that this conflict could escalate. And if you look at gold's move, it's kind of contraindicated to everything else because if you look at inflation-adjusted real rates in the US, they've actually gone up over the past 2 months. That would typically bring the value of gold down. And again, investors were pricing some 80 basis points of rate cuts from the Fed at the end of February for 2024. Now they reckon we'll get less than 2 rate cuts by the end of the year. So again, that's a factor that should have hobbled gold. Instead, gold has surged, so suggesting that investors do see gold as a haven if this particular conflict proves to be protracted.
Okay, Venram, thank you very much indeed around the favoured havens given this conflict from, of course, our MLive team. Bring the analysis and the market reaction. Ben, thank you. Now to what is happening in Europe. German Chancellor Olaf Scholz says he is sending a third Patriot system to Ukraine, and more will follow from other EU member states. He was speaking to reporters after an informal meeting of EU leaders in Brussels, with G7 foreign ministers meeting today. Berlin is pushing for stronger support for Kyiv. Let's get more then from Bloomberg's Oliver Crook in Berlin, who was covering this meeting out of Brussels for us yesterday. Ollie, what is Ukraine's defence situation right now? Will the support from Olaf Scholz and Germany be enough?
It will certainly make a difference. It will certainly not be enough, right? We know that there's the ammunition shortage, which is something we've been talking about for months now, where Russia is firing maybe 5 times more artillery shells than Ukraine is. That's been going on for a long time. What we've seen now is Russia really focusing on a lot of the infrastructure within Ukraine and some of the power generating supplies. And so what they need is air defense systems, right? And Olaf Scholz says he's sending another Patriot battery defense system. He said that according to the conversations he had with EU leaders in Brussels, that they can expect another 6 on the way. But there is a pretty great frustration, which I think is perhaps best embodied by the sort of candid tweet that was put out by Donald Tusk saying that if all the words that were said in the last years here in Brussels about common defense could be changed into bullets and rocket launchers, Europe would have have become one of the strongest powers in the world and the safest place. And that sort of echoes some of the things that we've heard from some of the defense CEOs that I spoke to also in Brussels, saying, listen, if you want this capacity up and you want to deliver on a new paradigm for European defense, we need to get the order flow in and we need to make these decisions now. And the question is, of course, always around financing and that sort of thing. But there is a certain sort of disconnect between the rhetoric and the action within Brussels. We say that the G7 foreign ministers meeting, Annalena Baerbock, the German foreign minister, is really pushing for more support to Kyiv. But really the thing that we need to watch is probably the major breakthrough, which is Mike Johnson bringing this to the floor of the House to get that Ukraine aid bill in through the United States. That's been stalled for 6 months, Tom. $61 billion for Ukraine, so that could have movement as soon as tomorrow.
Yeah, does Johnson get that across the line, or does he get ousted by those extreme right Republicans in his own party? A crucial question, isn't it? And of consequence for Ukraine. Ollie, look, you outlined this for us brilliantly yesterday. Mario Draghi with the report
here,
and the priorities that Europe should focus on in terms of
Iran's nuclear sites.
With the US, competition with China, Chinese influence as well. Did they come up with any answers?
Well, in short, Tom, the answer to that is no. You had this sort of stark warnings from Enrico Letta. He put out a 150-page report he gave to leaders. Admittedly, that report came kind of late, so the leaders and their teams maybe didn't have enough time to read it in great detail before the meeting to get those conclusions out. Draghi made that speech, as you mentioned. And what's interesting is we saw a draft proposal of the conclusions from the meeting that included a line that said Europe needs an urgent paradigm shift. They took that line out of the final conclusion. So that gives you an idea of where they got. So where the sticking points were around the Capital Markets Union. Really what Letta and Draghi have been pushing for is a bigger single market, more capital flows, and that means more centralized supervision. There could not be agreement around that. France, Italy, Spain, the Netherlands are sort of in favor of this. There was a lot of pushback from the smaller nations. You have the question of harmonizing tax rates across Europe. Of course, a very thorny question for, say, Estonia and Ireland. And this really goes to show, Tom, the difficulty of political consensus despite the looming sort of, they're talking about in terms of basically economic obsolescence for Europe if it doesn't get its act together. But there is so much complicated politics
IAEA also continues to call for extreme restraint from everybody and reiterates that nuclear facilities should never be a target in military conflicts.
Indeed, with the latest. Now,
they also note that they are monitoring the situation very closely.
What US officials say is this Israeli strike on Iran. The IAEA, of course, the International Atomic Energy Agency, confirming no damage to Iran's nuclear facilities and nuclear sites. So backing up what we've been hearing from Iranian state media, who had said that the nuclear sites at Isfahan had not been impacted, not been damaged. Now the IAEA coming out and saying they confirm there has been no damage to Iran's nuclear sites. And we know that a strike on those sites would have been one of the worst case scenarios in terms of the potential risk within this region. We know it's a scenario that potentially Israel's looking at. It seems like that is not a scenario that's played out, and the IAEA confirming no damage to those nuclear sites. We, of course, keep across this story for you. There's plenty more coming up in terms of the earnings front as well, and we'll break that story down for you with a focus on Netflix coming up. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Let's switch focus, at least for now, away from the geopolitics, Iran and Israel. We'll keep across that story for you, but focus now, briefly at least, on the earnings story as well, because Netflix shares fell in extended trading, despite reporting its best start to the year since 2020. The streaming giant added over 9 million new customers in the first quarter, nearly double analyst estimates. For the details then, let's bring in Bloomberg's Chloe Melly with the top lines on this. Chloe, how did Netflix do then?
Well, there were some very rosy forecasts from analysts ahead of the first quarter, and by and large, Netflix delivered. So as you said, it really beat expectations in terms of subscribers. That led it to be on earnings and sales as well, and it also upgraded its operating margin forecast for the year. But there are a couple of things that might worry investors a little bit. The first being that it will stop reporting subscriber metrics starting from the first quarter of 2025, which means that there might be, it implies a slowdown there. And also, the revenue guidance for the second quarter is a little bit weaker than anticipated. So that's probably why there were a little bit of weakness in trading.
Yeah, and they've benefited, haven't they, from the clampdown on password sharing? There's a question mark over to what extent that continues to benefit them. What are the key kind of growth drivers then for Netflix going forward?
Well, as you mentioned, currently the password crackdown is still kind of boosting them. They've also introduced a subscription tier with ads, and that is developing quite well. About 40% of new customers are choosing this option in markets where that is available. And there's also a very strong slate of programming. So in this first quarter, there was Love is Blind, The Gentleman, really, really big successes for Netflix there.
Chloe, thank you very much indeed.
Thank you.
Those Netflix earnings and the top lines coming through, of course, from that streaming company. We switch focus now to the cosmetics space and the luxury space.
13 comments coming through from ECB's Kazakhs now, who says it's too soon to declare inflation victory, also saying that the economy isn't strong, but confidence is improving, and the ECB takes the Fed into account, but has its own mandate.
Senior analyst from Bloomberg Intelligence for a deep dive on this story then. The key drivers behind the sales coming through from L'Oreal then, Deborah.
Yeah, so 9%, and the big thing here, it was a couple of percent ahead of the market, a couple of 100 basis points ahead of market expectation. But it was on a big year ago 13% growth, and the stock had kind of underperformed into the sales number only, on the back of data coming through from other peers like Ulta in the US, where product was seen as a little bit old in the stores and others, and also from Circana industry data. So there was a bit of an expectation, I feel, in the market that they may have just met. So that was very good. And then it's about that double-digit growth, so plus 10% growth in North American market, in European market, doing very well in mass market, where we would expect maybe some price pinching, still pricing going through there. The big area for them too, dermatology, and that's still up over 20%. So overall, there were 3 out of the 4 sectors and 3 out of 4 regions that did well. 3 out of 4 regions. One of the regions that didn't do so well, China. Yes. Talk to us about that. Yes. So China for them is up 6%. Actually, against a market which is generally flat. And that's another 100 basis points higher than they were at the Q4. So they're gradually improving their market share versus the China overall. And China is gradually improving itself, but it's slow pace. And outside of that too, you have on the Lux side, so that's only up just less than 2%. North Asia was down 1% because of China. market overall flat, and also because of the travel retail industry. So we've heard from L'Oreal.
So at 2 a.m. Eastern Time, we do get UK retail sales numbers. UK retail sales year-on-year with a forecast of 1% on the prior minus 0.4%. UK retail sales month-on-month forecast 0.3% on the prior 0%. UK core retail sales month-on-month forecast 0.3% on the prior 0.2%. UK core retail sales year-on-year forecast 1% on the prior minus 0.5%. German PPI figures as well year-on-year with a forecast of minus 3.3% on the prior minus 4.1%, and month-on-month with a forecast of 0.1% on the prior minus 0.4%.
Money going from China over into Japan, traveling to Thailand, to Singapore and others. So the actual China number.
And so just noting the ranges here, UK retail sales year-on-year with a range of 1.2% to 0%, and month-on-month with a range of 0.6% to a minus 1.5%. And also noting UK core retail sales month-on-month with a range of 0.7% to a minus 0.6%.
The market reaction to that crucial geopolitical story, and also the reaction to the increasingly hawkish commentary from Fed officials. Stay with us. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel, and I think there's one thing.
A source tells Iran's main news agency there has been no attack against the Air Force Base in Isfahan.
Putting your money where your mouth is and really trying to do something about the problem, and that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Every time we come up to one of these halving events, it really does come back to the fundamentals of supply and demand.
The crypto industry goes through cycle. It's to be expected. There's going to be market volatility. It doesn't only impact the asset front. I mean, given the geopolitical tension, given the interest rate environment that we are seeing, the inflationary environment.
Obviously, Bitcoin and crypto right now in general is part of the global financial system. So we are not completely disconnected from what's happening in equities, for example, and what's happening with monetary policy or with what's happening in the geopolitical environment.
We've been preparing for many years. Our business is one that requires long-term planning, and these halvings are known events. And so the evolution of mining has really changed since previous halvings, where we had a really fragmented market.
I think a lot of investors are eagerly anticipating to see what the market reaction will be.
Welcome back to Bloomberg Daybreak Europe. Let's bring you the detail in terms of what continues to unfold. US officials telling Bloomberg that Israel has struck sites in Iran. Iranian media playing down the impact. The IAEA, the International Atomic Energy Agency, coming out in the last 30 minutes saying that the nuclear sites in Iran are not impacted. Here's the map then. Isfahan, of course, is the location of one of their key nuclear facilities, and again, the IAEA and Iranian state media
So
say
just
there
less
has
than
been
5
no
minutes away now until we get
damage
our
to
UK
this
retail
site. We know
sales
that had
numbers
been a
year on year with a
worst-case
forecast of
scenario
1%
in terms of the
on the prior, minus
potential
0.4%,
repercussions
month on
and
month with a
retaliatory
forecast of
risks and the
0.3% on the
spiraling
prior
conflict
0%.
potential
UK core
in the
retail
Middle East
sales
if
month on month
Israel had
forecast
damaged that
0.3%
site.
on the
Again,
prior
so far, state media
0.2%.
in Iran and
UK
the
core retail
IAEA
sales
say
year
there
on
has
year
been no damage
forecast
to
1%
Isfahan.
on the
We
prior,
continue to
minus
work out the details
0.5%.
of what has
German
unfolded
PPI figures
in
as well
Iran. The
year
fog
on
of
year
war
with
is
a
very much
forecast of
at
minus
play here, but it
3.3%
seems
on
like
the prior,
Iranian
minus
officials and Iranian
4.1%,
state media
and month
are
on month with a forecast of
downplaying what US
0.1%
officials
on
tell
the
us
prior, minus
is this attack by Israel on
0.4%.
Iran. Let's see the market reaction to that then.
So again, just noting the ranges here, year on year, with a range of 1.2% to 0%, month on month, with a range of 0.6% to minus 1.5%. Then the core figure here, month on month, with a range of 0.7% to minus 0.6%.
You're seeing gains of a little under 2% right now. So again, pairing some of that risk-off move.
And also noting here, Iranian analyst to State TV says mini drones flown by infiltrators from inside the country.
Lines crossing, and then you've paired some of the price gains that we've seen in Brent. Let's flip the board and look at some of the other assets and some of the other haven moves. Of course, gold being bid as well, but again, gold giving up a lot of those gains right now. You can see the spike there, and we're almost back to the pre-event levels in gold, just up 0.1% on spot intraday 2,382, 2,400 by the way, seen as a key technical level for the yellow metal. And Bitcoin, if anyone thought that Bitcoin was a move in terms of a haven, well, that's been put to bed again with moves lower in Bitcoin, offsetting the optimism that some had around, of course, the halving event. This is the yield, of course, in terms of Treasury yields, and there has been a move into Treasury with yields lower. There's going to be more analysis across this in great detail. Markets Today is next with all the analysis. Stay with us. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up the, we don't want to be in the bidding of
just less than 1 minute away now.
Long tail. So I'm not sure. They did bid on Formula One.
I will be leading with the month-on-month figure.
So I think that was a smaller package, meaning smaller economics. So we'll see.
Ten seconds. 0%, 0% lower than the forecast of 0.3%, year-on-year 0.8%, 0.8% lower than the forecast of 1%. UK core retail sales month-on-month minus 0.3%, minus 0.3% lower than the forecast of 0.3%. UK core retail sales year-on-year 0.4%, 0.4% lower than the forecast of 1%. German PPI year-on-year minus 2.9%, minus 2.9% higher than the forecast of minus 3.3%, and German PPI month-on-month 0.2%, 0.2% higher than the forecast of 0.1%.
Stocks slump as investors rush to haven assets on concerns of a widening Middle
Noting
East
some
conflict.
minor downside in the
Brent
pound
crude
there.
spikes above $90 a barrel. Plus, Bitcoin drops on the heightened geopolitical risks overshadowing the once every 4-year halving of the digital asset.
In the meantime, let's put some numbers to that dynamic Anna was just talking about. Your stock 50 futures really taking a hit this morning, down 1.5%. You're seeing the FTSE 100 right on its tail, but a lot of those haven bids you are seeing show up as well. The dollar, however, seems to be the major player. Dollar Swissies when you want to watch. Dollar yen, of course, hitting a lot of technical levels there, and gold virtually pairing its losses now, but was much higher. We're going to dive into those market moves shortly. Stick with us. Markets Today starts right now.
Friday the 19th of April, good morning everybody. US officials, as we've just been hearing, saying Israel has struck targets in western Iran. Multiple reports from Iranian news agencies, though, suggesting that explosions around the city of Isfahan, Iranian TV saying all military and nuclear sites are safe. Guys, it looks like what we've seen this morning is a big knee-jerk reaction by markets. That looks like it's now fading. There is a lack of clarity. It looks like Asian hours have probably taken the biggest hit in terms of what we're looking at here in terms of the risk-off sentiment.
Yeah, we'll get an update in just a moment from our colleague Jemana on the ground in the region with an update on the exact developments. I say exact, but there is a lot of haziness, a lot of a lack of clarity as to what exactly has taken place. But even that is quite instructive, because if we are getting mixed messages, if it turns out that the Iranians are trying to downplay whatever has happened, whatever has taken place here, then that is in itself will be meaningful information for investors.
It will. And remember, we've been trying to quantify what this conflict in the Middle East actually means for things like oil prices, for the commodity prices, and we haven't gotten a clear read-through. Yes, a knee-jerk reaction, but still only barely above $90 a barrel. It hasn't been that exciting until it hits supply, and that's where the concerns seem to lie. If you do see an attack, does that actually affect Iranian supply? Or is that part of the equation relatively safe?
I think it's really difficult to tell at this point. Let's get some clarity on all of this now. Jemana Basetchi joins us now, Bloomberg's Middle East anchor. She's based out in Dubai. Jemana, what do we know? What do we not know? It seems the picture is very confusing this morning. Markets are really struggling, therefore, to price in what appears to have taken place overnight, but we don't know enough details to do that accurately.
Yes, that's right. Good morning. Great to be on your show. Let me just walk you through what happened this morning, the sequencing. So, as we know, for almost a week now, there's been a lot of speculation as to how Israel would look to respond to Iran's unprecedented direct attack on Israel last weekend. And of course, as we know, most of those missiles and drones were intercepted. But again, there has been a lot of pressure on Netanyahu domestically on a response and a potential response to Iran, despite the fact that their key allies, including the United States, have tried to exercise some restraints or encourage them to exercise some restraints. Now, the early hours of the morning, we walked in, we heard of explosions in Isfahan, that is Iran's third largest
So we have posted
city.
out the March 2024 UK retail sales report.
Confirmed that indeed the Israeli Air Force had indeed carried out an attack. And again, as we were talking about earlier, the details is still very hazy. But what we understand is that this was a very limited and very specific attack directed at the military air bases located within Isfahan. And again, this is significant because these were the same air bases Iran used just last weekend to launch their own missile attack on Israel. So at this point, it appears to be that the retaliation was very limited and very proportionate to what we had last weekend. Now, in terms of the Iranian response, as you say, they have been looking to downplay it per state media. We heard from local media Tasnim a short while ago saying there are no reports of an attack from abroad on Iran's central city of Isfahan or any part of the country, and that in fact it was Iran's own air defense systems that had been activated in response to drones that had been circulating. But crucially for markets, you were talking about this earlier, I think the main concern was that Israel were perhaps going to target some of the nuclear facilities. The Iranian state media were quick to report out that no nuclear facilities had been hit. They are safe. And a short while ago, we heard confirmation from the IAEA saying that that is true. No nuclear facilities have been hurt or seen any damage in response to these attacks.
Yeah, and despite a lack of clarity, Jumana, that is the kind of information that would get out because, of course, it would be detected if there had been damage. So that is interesting in itself. So what is the likelihood, then, of other countries being drawn into this? If we are seeing that Iran is downplaying this to some extent, then maybe that leads you to conclude that the risk is perhaps lower than it otherwise would have been.
And I think that is the big question for the region right now. And I would say the last week has really amplified some of the concerns about this conflict getting blown out into a broader regional conflict. And remember, for the last couple of years, the confrontation between Israel and Iran has taken place through proxies, not directly. So we are getting into a new stage of this type of confrontation, starting with the response, Iran's response last weekend, because that was the first time in history Iran had directly attacked Israel. And now we got the retaliation. The question for everybody in this part of the world is whether Iran would look to amplify this one step further, or whether, given the limited response that we've seen from Israel and the fact that they only targeted military air bases at this point, whether that would be deemed insufficient enough to warrant an even bigger response on their part. So far, we have not had official commentary from Iranian officials. Everything that we're hearing is coming from Iranian state media. In fact, they're denying that a Security Council meeting is taking place. But within Israel, they are being told to get ready for a potential Iranian response. And actually, the U.S. Embassy within Jerusalem, their officials have been told to be on high alert as well.
Jumana, thank you very much. Thanks for the update. Jumana Basetchi joining us then, Bloomberg's Middle East anchor based in Dubai, and giving us an update on what we know and, crucially, what we don't know at this early stage. Markets had to react in the absence of clarity. We still don't have the full picture. Markets did see some reaction. We spiked above $90 on Brent, but we're back down. And even when we were up at 90, we were only where we were last week, really, to Critty's point earlier. You know, the reaction in markets has not been that substantial.
Thin overnight trading as well. Just got to factor that in as well. This came at a point where maybe the market didn't have the liquidity maybe to kind of deal with this properly. We'll see how the rest of the day progresses. As you guys were saying, like futures at the moment still pointing fairly negatively at this stage. But we've been dealing with a down market all week. We've had negative reversals for most of this week throughout sessions. Maybe today actually is a day when we start low and maybe end a little bit higher, which has been counter-trend at the moment.
This may also just be, to your point, low trading volume, but also just taking your chips off the table. Saturday marks a big, big vote in the States that a lot of countries around the world are going to be watching. A $95 billion national security vote that includes Russian assets, China divestiture on TikTok, Iranian sanctions, aid to Israel, aid to Gaza, and aid to Ukraine. This is something just came back from Brussels. Everybody in Brussels is talking about.
There are a lot of geopolitical strands in there, aren't there?
There are. And what is the ramification if this does get through to the House? What kind of response are you going to hear from the various countries that this targets around the world, creating perhaps some of that risk on Monday morning?
Because that takes in, you know, funding for Ukraine and the war in Ukraine. It takes in the Middle East. It also takes in relations with China. So, it goes quite extensively. And we're going to be continuing our conversation around the geopolitics, how much risk you need to price in shortly.
Is what we're getting here inflationary? Because that's the other factor you've got to kind of...
It reminds you, certainly, of the inflation risk, doesn't it? Even if we don't stick there. Even if you go up to 90 and you test it and you don't stick there.
Williams is mentioning the word hikes.
The very first time he said it. This is massive. The market's taking it in stride yesterday. You didn't see as big of a jump as you have in the past in terms of the bond market, in terms of yield. I think it's fascinating, though, that's coming from the New York Fed president of all places. They have extra insight into the market mechanics, et cetera.
Yes, and doesn't it come back to what we said yesterday? they say things like that. It depends how much tightening the market then does on their behalf as to whether that ever needs to come to pass. I mean, there's a long distance to travel this year, it feels.
Well, the market's taken yields lower because of the
geopolitical risk, yes.
But you wonder how long that move lasts, because in theory, some of this could be inflationary. And then you plug Williams in talking about hikes as well. It's interesting that a lot of the Eurozone officials, ECB officials in Washington have very much been downplaying the link between the two. But that link still exists, i.e. the ECB and the Fed. And if the Fed is hiking, that really would limit the ECB's ability to do pretty much anything on the downside, cuts. Let's talk about what we're going to talk about next. We've got a great guest lined up. In fact, a perfectly timed guest. We're going to dive into the implications of heightened geopolitical tension. Citigroup's global chief economist, Nathan Sheets, is going to be joining us, just publishing a report titled Geopolitics, Implications for the Economy and Markets. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back to Markets Today. We have 45 or so minutes still to go until the start of cash equities trading. We are very risk-off. This following overnight reports, certainly getting news flow coming through from the US, from US officials confirming that Israel has launched strikes on Iran, but Iran saying there is no damage and actually even casting doubt on whether there were strikes. So certainly there's a lack of clarity as to what's happened. The market has moved, though, the market jumping on those comments from US officials suggesting that Israel has launched some strikes. This is the extent of the reaction we see. We did for a brief period see oil, Brent, above $90 a barrel. That's retreated a little. 88.49 is where we trade. We saw money into treasuries, money into the dollar, into the franc, a little into yen, into gold, not into crypto, and as I mentioned, into oil, stocks then selling off. Let's talk about this. Let's talk about geopolitical risk. A very well-timed conversation. Nathan Sheets joins us, Citigroup's global chief economist, who has been thinking a lot about the intersection of geopolitics and economics. Really nice to see you, Nathan. Thank you for coming in. There's a lot we don't know about what's happened overnight, but this adding to a host of geopolitical tensions of late. Yeah. In a situation like this, for investors, with your experience, what are you watching for? We need to establish more of the facts on the ground, I'm sure, but what catches your eye?
The key question, I think, is very much what the markets are focused on, and that is, what are the implications of this for oil supply? That really seems to be front and center. And the baseline, as the oil market is suggesting this morning, is that the disruptions are limited to physical oil supply. But the problem with geopolitical challenges is you've got to think hard about what are the tail risks. You know, what could happen that's different than that baseline? And then you move from concerns in the oil market to broader concerns about the economy and, frankly, the uncertainty associated with this. Might this thing escalate? If it does, what does that look like?
Okay, I mean, and sticking in the moment, if we are seeing the Iranians downplaying what has happened overnight, if that tells us anything about their reaction function around the Straits of Hormuz, that's really what markets need to know. And
if it does, then I would say that's extremely good news. And the reality of geopolitical challenges that we saw when we looked really carefully at the data is that markets tend to initially overreact. And I think it's precisely what we're alluding to here. That overreaction reflects that uncertainty premium when it first erupts. But typically, these events end up being less disruptive than we fear they might be.
Nathan, in about 24 hours' time, there is going to be a vote in the U.S. House. $95 billion of national security. That targets Iran, Russia, China, defense spending, aid, etc. What do you make of that? How much of a difference does that aid package make? This is the first time you've seen all of these geopolitical issues wrapped into one with bipartisan support.
Yeah. I think that aid, that support is just absolutely critical. It's essential for Israel. It's essential as well for Ukraine. This is the United States asserting its role as the leading geopolitical, military, economic power in the world. And on the one hand, is there a cost associated with it? Absolutely. But I think it's a reflection of the U.S. role and our responsibility in the world to try to ensure that the world is as peaceful as it possibly can be. You know, at the moment, peaceful and it doesn't sound like a very good description of where we are, but I think that that's the aspiration, and I think that's what we're hoping for with this aid.
At the same time this week, as these negotiations have been happening in Congress, you also have the IMF and World Bank spring meetings over in D.C. Kristalina Georgieva, the managing director over at the IMF, saying very crucially she's expecting those rate cuts to get pushed back, but ultimately to show up for the United States. To what extent can the U.S. consumer story hold up the global economy?
The U.S. consumer has been exceptional. The resilience we've seen over the last couple of years has been, and I need to use superlatives, remarkable. And when I look at the underlying fundamentals of the U.S. household sector, I continue to be quite encouraged. U.S. household balance sheets are strong. Wage growth is solid. Now, a footnote to that is we are seeing some strains amongst the lower income households. And if there's a place where there may be some cracks emerging, it may be there. But all in all, my sense is the U.S. consumer is far from tapped out.
But they are dealing with a lot of inflation, and potentially geopolitical events are going to make that inflationary story more difficult. Good morning, Nathan. How should we think about that intersection, about how geopolitics is going to impact the inflationary story? And should we be expecting, is your assessment, and you've done a lot of work on this in the report, that we are going to a period of heightened geopolitical tension where we're going to see more events, and therefore the inflationary impact could be even greater, both in the short term and the longer term sort of supply side knock-on?
We do look fairly closely at this issue of whether geopolitical risks and pressures are becoming more intense than they were previously. And on the one hand, we see these kinds of near-term geopolitical pressures in Ukraine and the Middle East, but there are also big structural developments that are geopolitical in nature, like the rise of China, a new great power in the world. And when you have new great powers rise, that's often been a source of ongoing geopolitical pressures. So we certainly see that potential. Now, thus far, when we look at the data, we don't really see a lot of evidence that the level of geopolitical pressures is elevated relative to the last 100 years. And you think about the last 100 years, you had the Cold War and the World Wars, and you had the War on Terror. There's been a lot of geopolitical pressure. But, the current decade has been somewhat elevated compared to the previous decade.
Right, and your analysis is quite clear. It takes you back to sort of the 2000s, the War on Terror, rather than back to anything.
Then.
Right, and it was elevated there, but we're not even, on your analysis, not back as high as that. So, I mean, even in your recent report, Nathan, you've got a guest essay from Ambassador Dennis Ross, really interesting. But even there, saying, rarely has the world seemed more unstable. Why does it feel that way to people and investors?
It certainly does. Now, I think part of that is our memories are not infinitely long, and I think there are a lot of investors that don't remember the Cold War and even 9/11 and the War on Terror in that period. And we have been through a period of where it's been more quiet. But then in addition, I think there are some major seismic shifts that are occurring. The rise of China, which I mentioned, the rise of populist voices in politics in many countries, and even I think a really interesting geopolitical development that could have huge implications is the rise of renewables. It's going to shift the role of commodities that we see. So we haven't seen it yet, but I think maybe people are picking up that there are some pressures and developments in the global economy that could yet lead to meaningful shifts and perhaps even increases in geopolitical shocks and tensions.
In just a moment, I want to pivot and talk a little bit about how central banks are going to be responding to this. We've got some sound from Klaus Knott and from John Williams. Just picking up very briefly on that last point you made, oil no longer the transmission mechanism of geopolitical tension into the economy. What will become the transmission mechanism?
You know, we struggled with this issue, and my sense it's likely to be something. Maybe in a world where we're trying to decarbonize, maybe it becomes copper. From time to time in geopolitical standoffs, it's rare earth metals. But it could also be other things, like maybe it becomes access to data. You know, it's an open issue, but even without oil, my instinct is that we'll find new mechanisms of geopolitical confrontation.
But maybe pivoting away from that. Okay, let's turn our attention to what's happening with the central bank story and kind of come at this from a different angle, particularly the inflationary angle. Sit tight for a minute. John Williams was speaking yesterday. Klaus Knott was speaking yesterday. Very different kind of opinions being vocalized on either side of the Atlantic. Let's take a quick listen.
It's not my baseline. My expectation right now is that interest rates are in a good place, and eventually at some point would want to lower interest rates as the economy really gets to the 2% inflation that we're headed towards. If the data are telling us that we would need higher interest rates to achieve our goals, then we would obviously want to do that. So it's not my base case.
Monetary policy always takes place in a global context, but at the same time, we're not the 13th federal district. We have our own monetary policy, we have our own set of outlooks, economic outlook, inflation outlook, and as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area.
Nathan, how far can the ECB and the Fed diverge?
This is a question that markets are wrestling with in real time. And it's striking that on the way up, I think there was remarkable synchronization during the hiking cycle. And now we're at a place where some of the economic fundamentals are diverging. And specifically, it is distinctly our sense that U.S. inflation is looking somewhat more sticky than European inflation. And moreover, the U.S. economy is looking somewhat stronger than the European economy. So the macro context for some divergence with the ECB and probably the Bank of England cutting well in advance of the Fed and maybe cutting several times.
So stating here, according to Sana, Syria says that Israel struck its southern region overnight.
We've also seen that these major central banks, I would argue, like to follow the Federal Reserve, that following Jay Powell and the Fed.
So a bit more clarity there. Syrian state news agency reports Israeli attack with missiles targeted air defense positions in Syria's southern region.
So it's going to be a very interesting interlude here to see how much divergence we get. It's an open issue. My sense is that bottom line, you can see maybe a couple of cuts before the Fed, but I'd say only a couple of cuts. It's going to get hard to really get into a cutting cycle if the Fed is holding.
When we're talking specifically about kind of the marriage of geopolitical risk and the monetary policy, a lot of it is so much baked into this commodity story, that commodity inflation, supply side shocks is what's going to be the game changer. But if we're talking about wartime, hasn't historically, and you mentioned this a little bit in your report, hasn't historically wartime been a tailwind to the U.S. economy? Could we see that reinflation story again, not from the supply side, but from the demand side?
You know, the reality is that the spending associated with, military...
Noting here, Bund's open higher amid haven buying. 10-year yield down 6 basis points to 2.44%.
The spending. It's not necessary, and I think this is a key point, not necessarily stimulative for the rest of the world, even in that instance. And moreover, and I think this is the bigger point, is it's very costly, humanitarian-wise, but in terms of wealth and structures, and over time it's a substantial reduction of wealth, even if it's an increase in near-term GDP.
Nathan, great to see you. Thanks for stopping by.
Good to see you. Thank you.
Come back anytime. Be great to see you. Perfectly timed report on geopolitics. So thank you very much indeed for that. Nathan Sheets, Citigroup's Global Chief Economist. Some headlines coming out of Israel. Ben Gvir suggesting that the Israeli response to the Iranian attack was, quote, weak. He is, of course, the Minister of National Security in Israel. We're getting other headlines coming through suggesting there were attacks in Syria as well. Bunds have just opened. Haven buying, unsurprisingly. Up next, we'll continue this conversation. We'll talk about how the EU is responding. We'll go to Brussels next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome back. You're watching Markets Today, Friday the 19th of April. There's a lot going on this morning. Generally a very strong risk-off tone coming into markets as we digest the news from overnight, and unfortunately that news is relatively confusing. But certainly the picture on futures at the moment, negative, but not as negative as we anticipated it would be even a few minutes ago. So the markets have been firming as it appears as if this response from Israel maybe was weaker than originally anticipated.
Yeah, when we started this program, oil was a little higher, NASDAQ futures were a little lower, NASDAQ futures were down 1%, now down 0.8%. So we're pairing our negative expectations, I suppose, about the day ahead as a result of some of the, well, maybe a lack of developments on what's happening in the Middle East. There's certainly a lack of clarity, and it might take a long time, and we may never get confirmation of who exactly did what, but we'll certainly be pursuing it. Interesting to think about whether corporate news cuts through all of this. We had these numbers out of L'Oreal, and there is a suggestion that that stock benefited overnight, but that was before we saw the latest Middle East developments. Yeah. We're getting numbers out of Nissan just now, preliminary full-year operating income lower than it previously was seen, so a sort of downgrade to expectations coming through from Nissan. Do any of these stories cut through on a day where we're very dominated by that geopolitical risk?
It does feel like, and it has felt like, at least in the corporate space, a tale of two markets, quite literally. This consumer resilience story that we were just talking about with Nathan Sheets, that's driving the inflationary picture in the Fed narrative. But then on the other hand, real weakness in Europe and Asia. And you see that, to your point, Anna, in the L'Oreal numbers and in Nissan as well, I should say, the strength you saw in the Netflix numbers, again, highlighting the strength you saw in the States. This idea of this kind of divergence that you're seeing within growth has a very real effect as well in terms of the defense story, the geopolitical story, whether there is even appetite and affordability to defend in Europe and to really rearm ahead of well, any sort of threat that they have, but also what a Trump 2.0 might look like. These are all questions that are starting to get priced into this market.
How do you do it? How do you fund it? Do you have to make cuts elsewhere? Yeah. Some really tricky questions for Europe. And it feels like Europe is gradually waking up to the idea, and I'm stunned it's taken as long as it has, but it is now clearly on the narrative that people are, part of the narrative that people are talking about. There is a crisis, and Europe needs to figure it out. And you've just laid out some of the issues that Europe faces right now, and they all do seem to be becoming increasingly concentrated. Are they concentrating mind enough for Europe to make a breakthrough, though?
Yeah, absolutely, and that's where our thoughts go next. In the context of the wider geopolitical tensions we're seeing in the Middle East, EU leaders met in Brussels to make progress on some of the most contentious and significant challenges that they face. The immediate problem, of course, is much closer to home, the war in Ukraine. Longer term, being left behind economically by Chinese and American industrial policy.
But here, a senior Iranian official tells sources after a reported strike by Israel there is no plan for immediate retaliation, no clarification on who is behind the incident.
Place, Oliver, and of course these conversations have been happening in the run-up to what we saw overnight in the Middle East. Geopolitical tensions once again to the fore, but I know for European leaders it's the situation in Ukraine that perhaps rightly gets a lot of attention. Ukraine's defense situation deteriorating. What are European leaders bringing to the table?
Yeah, I think the European leaders realize that they have sort of limited influence potentially on what happens in the Middle East compared to the situation in Ukraine, which of course has a lot more influence on them. And we know from months now, we've been reporting about the ammunition shortage on artillery shells in Ukraine. That has not gone away. But now what we're seeing is Russia really stepping up the attacks on some of the infrastructure, on some of the power generating units, which means they need more air defense, which we understand from Olaf Scholz. He said Germany will send them more Patriot batteries, air defense ones. We understand that there will also be another 6 from other EU leaders. But really, I think some of the frustration was very well articulated by Donald Tusk, the Prime Minister of Poland. You can see it there. If all the words that were said in the last years here in Brussels about common defense could be changed into bullets and rocket launchers, Europe would have become the strongest power in the world and the safest place, right? So there's a big discrepancy between the rhetoric and what is actually getting delivered to Ukraine. And that's sort of the message that we heard from many of the defense CEOs that we've spoken to over the last couple of days, also in Brussels, saying that, listen, we need predictable, large order flow if you want to get the capacity up to match the ambitions that you're talking about, right? So that's the situation in Brussels. We're also watching Capri, where the G7 foreign ministers are meeting there, also talking about stepping up more aid for Ukraine. But the reality of the situation for the Ukrainians and for Vladimir Putin, they're not looking to Brussels, they're not looking to Capri, they're looking to Washington, D.C., where Mike Johnson, the Speaker of the House, will, we understand, bring this this vote to the House floor on the Ukraine aid, $61 billion. So while Brussels is sort of talking and maybe not making progress, the real sort of significant move forward could be this Saturday with this vote from the House that could pass the bill, and of course it could threaten the Speaker's job.
Absolutely. US politics is going to dominate this agenda. Let's come at this from a different angle as well, Ollie, and talk a little bit about how China is going to factor into these leaders' thinking and how they're going to adjust policy. Olaf Scholz has just come back in terms of the clear threat, economic threat that China poses in terms of overcapacity at the moment. Do leaders have an answer to that? Can they keep all these plates spinning? Can they find answers to all these different questions that they're being challenged with at the moment? Europe tends to move slowly, but it's facing multiple threats right now. Can it deal with all of them?
Yeah, well, Guy, you sort of injected what turns out to be, I think, an appropriate degree of skepticism in terms of making some breakthroughs in some of these bigger challenges when we spoke yesterday, and that really is sort of what we saw. I mean, we got this letter from Enrico Letta, 150 pages, suggestions of how to keep Europe more competitive, and the focus for that is to expand the single market, to try to get Europe to work more like a single nation than an arrangement of different nations, and that really sort of found some sort of immediate hurdles. There is the question of the Capital Markets Union. Many believe that if you could really work that out, something that we've been talking about for the last 10 years, that you could really mobilize some of that private investment. Guy, you have 250 billion euros leaving the continent every year to go to other capital markets. That is what they want to capture. Where that discovers some issues is with some of the smaller nations within Europe. I mean, the French, the Spanish, the Dutch, they're all in favor of having a more robust union, but the smaller nations are sort of more skeptical of relinquishing control, relinquishing power. There's also the question of harmonizing the tax codes across Europe, which reaches, of course, some limitations in Estonia and Ireland, for example. I mean, even on telecoms, we were talking about there are 32 carriers in Europe. There needs to be some consolidation in order to create efficiencies. Margareta Vestager says, we don't really think so. We don't see that as creating more efficiency. We see it jeopardizing the single market and competition. So almost immediately, despite the fact that you have these huge issues for Europe, and they perhaps understand that their economic viability is at risk, the politics of it is very, very difficult until the crisis is really staring you in the face.
All right, Bloomberg's Oliver Crook there walking us through some of the issues in the view from Brussels. We thank you so much for that crucial context. As we talk about geopolitics on multiple fronts, we got to factor in India as well, where 6 weeks of voting are getting underway in the world's biggest democracy. Nearly 1 billion people eligible to vote as Prime Minister Narendra Modi bids for a third term in office. I want to get more on the story. Bloomberg's Menika Doshi in Chennai, the southeastern part of India, where, of course, voting is beginning. Menika, walk us through the strategy that the Prime Minister is using.
Hi, good afternoon to you from Chennai in Tamil Nadu, one of South India's largest and most successful states. Now, as you pointed out, this is not just the world's largest democratic electoral exercise, but that it's taking place in the 5th largest economy with the fastest growth rate means the implications matter to the global economy as well. Now, in this election, Prime Minister Modi's policies that range from majoritarianism to a big infrastructure push in recent years will be tested. But Modi is not just looking to come back for a third term, he's looking to come back for a third term with a supermajority of more than 400 seats in the total tally of 543.
And so the world watches, investors are watching. Menika, what about what are the main issues then for voters?
India is, like I said, the fastest growing economy in the world. The last numbers came in at above 8% for this full fiscal year. We will clock somewhere close to 7.5% or more. Now, that growth is also characterized by the lowest consumption growth in 2 decades. It's characterized by chronic joblessness amongst youth. This is a country which has a very high youth population. These are the economic challenges that an incoming government would have to deal with. Boosting manufacturing, being able to push services exports further, global capability centers, which have been a big contributor to growth in recent years. So all of this matters to global companies that are looking at India as an option as they shift away from the China-led supply chain strategy. Can India's policies make their move to the country more attractive?
Menika, in terms of how a third term from Modi would evolve were he to win this election, what do we know about kind of how the rest of the world is going to react to this election, how carefully people are watching this election? What's he already indicated in terms of how he will deal, not with India, but with the rest of the world? What is it going to say, if he wins, about India's place in the world?
It's an interesting question. I don't know if you recall, the many images that emanated from India when we were hosting the G20 last year. But one of them has stayed with me, and I'm sure many others, all through these past few months, and that is of Modi leading several leaders from across the world, including President Biden and Prime Minister Sunak, to Mahatma Gandhi's, fire. Now, that image of Modi walking ahead of all of them is exactly what this government wants to project, that India is finding its place in the world. And the world is watching very, very closely, not just for trade reasons, but for geopolitical reasons as well. For instance, the news that has dominated, through the morning, India is amongst the few countries that have ties to both Israel and Iran. And the government here has been calling for a de-escalation over the last several days. So I think the world is watching this election very closely to see who wins, to see what that means for what India's place in the world will be and where it will align. So far, India has walked a middle path. It hasn't strongly aligned with the US while touting a very strong friendship, but also purchasing large amounts of oil from Russia post the Ukraine war. So will that policy continue? Will it change? These are the questions the world will be posing of a new government, whether it's Modi or someone else.
Jim. Menika, thank you very much indeed. Menika Doshi joining us from Chennai as we start this process of the Indian election. Let's turn back to what we're watching so carefully this morning, and that is the implication. I was going to use the word fallout, but it seems as if the nuclear strikes, the nuclear sites are safe, so that wouldn't be appropriate language. But the implications for the global economy of what we've seen overnight. Oil gaining, haven assets certainly have been moving, but it does seem as if we're fading some of those moves. We're going to track you into the open. That's in 17 minutes time here in Europe. We were initially looking at a very, very soft open this morning. Things have firmed a little bit, but it looks like we are still going to be lower. We'll talk about that next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, it doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Welcome back to Markets Today. We have 15 minutes to go until the start of cash equities trading. The futures picture suggests we will take a leg lower at the start of trade. The Asia session has been weak. This all as a result of factoring in further geopolitical risk. Reports are pretty unclear, but it seems as if there has been some kind of attack on Iran, perhaps also on Syria. We see reports of both. Confirmation actually from US officials that Israel attacked Iran. Some hawks in the Israeli government describing that response as weak. This developing story clearly weighing on sentiment and causing a move into various havens this morning. Let's weigh up where we are. Let's take 2 minutes on the markets with Bloomberg's executive editor for Asia Markets, Paul Dobson, who joins us this morning. Paul, very good to have you with us. So markets reacted, didn't have the full picture. We still don't have the full picture about exactly what has happened in Iran, in Syria, and by whom. But the markets are nervous. But we're off earlier lows on stocks, off earlier highs on oil, as if perhaps we're working our way through this. What's your sense at this point on this story?
Yeah, I think you're right, Anna. Maybe the knee-jerk reaction that we had in the Asia session when we didn't have all of the details was a little more extreme than what we've got now, where it seems like there's no immediate saber-rattling or escalation on the Iranian side, not huge outrage, and on the flip side, not too much damage caused by whatever these blasts and explosions have been. And so that's enabled the market to unravel some of the extreme risk-off sentiment that had been priced in while still being on edge and setting us up for a risk-off day. I think, the big concern was, is this a strike on military structures in Iran? Is it on the nuclear stuff? It became clear that the damage didn't seem to be anything like as extreme as that, and probably not aimed in that direction either. So as you said, some officials describing it as mild, but enabling the market to cool off a little bit from some of the moves that we'd seen priced in earlier.
Yeah. Where does this leave Treasuries, fixed income markets, Paul? Because there are competing trends, just as we saw at the beginning of the week. It seems the haven bid is winning out over inflation fears this morning. But where does it leave us?
Yeah, so it's interesting, the Treasury's response. Earlier on, overnight in the US session, there was a little bit of focus on the fact that two of the Fed policymakers actually responded to questions on the possibility of hikes and said that they wouldn't rule it out. All of a sudden, we were thinking, oh boy, are we headed for another Treasury sell-off? But of course, in came the haven bid, which flipped us on our heads in a way, drove interest rates lower, shows that Treasuries still do have that haven appeal if you're looking for places to hide out when there's risk. That and gold did well. The yen and the Swiss franc rallied as well. So some haven assets did perform after all.
Paul, good morning. It's Guy. So are we going to flip back fairly quickly to focusing on that Fed narrative? Williams is out talking about hikes, as you've mentioned. How quickly do we return to that? We have seen a pretty risk-off week, basically. You certainly look at kind of how sessions have developed. You've seen reversals throughout most of the days, and we've been heading lower into the close. Broadly, as we come to the end of the week, how weak is sentiment for risk assets?
Yeah, impossible to completely say without fuller clarity on exactly what happened in the Mideast, Guy, and I wouldn't want to be flippant about that by any means. When we started this week, you know, the question that we had before markets opened on Sunday was what would be the Israel response to the situation, to the Iran bombardment that we saw over the weekend. We got a little bit of an answer to that now, but it's not clear that that's the final answer. And so those tensions remain elevated, even though during the week, you know, there was also all of this look at the higher US interest rates and what that's doing to currency markets and the dollar as well. Feel like that's not gone away. And in fact, you know, if oil prices continue to have an embedded premium in them, that only talks to the idea of higher inflation still and the need for the Federal Reserve to continue to worry about that inflationary outlook. All the data that we've had has been pointing to the US economy still firing on all cylinders as well. So that's all there in the backdrop. The IMF meetings this week provided a nice canvas for everybody to be discussing it. Now, of course, we're going into this period where we're not going to hear from Fed policymakers for a while as well. So it's only going to keep the market on edge as we build up to the next meeting and the next fuller update into Fed thinking that we'll get from there. But it's really interesting. You look at the pricing in the market, you know, we're basically at zero for the front months in terms of whether the Fed's going to cut or do something else. We only see a full cut being priced in September or maybe November, and only, you know, less than 2 for the entirety of this year. So that talks to that idea that we're going to have that embedded premium in yields, and that's going to continue to support the dollar and drive that kind of nervous sentiment across the rest of the global financial market complex.
Paul, thanks for the update. Always appreciate it. Thank you very much indeed. Bloomberg's executive editor for Asia Markets, Paul Dobson. Very much a kind of top-down macro feel to the start of the day, but actually there's some single stock stories that we need to plug in as well to the narrative. Let's do that now with Joe Easton.
Morning, guys. So we have got some strong sales numbers out of L'Oreal in France, the French skincare and makeup firm, reporting a jump in their like-for-like sales, and they did beat analyst expectations at 9% versus expected less than 7%. Double-digit growth across all regions except North Asia, because China tourism still seems to be a drag on some of their sales. Chinese tourists not traveling as much as they were pre-pandemic, still weighing on some of those sales. But we did see a decent jump in the American depository receipts. Over in the US, the ADR's up 5.6%, a nice gain for that one. The thing with this one is it has declined recently following a little warning from the big rival Ulta Beauty over in the US, the maker of the MAC brand in terms of makeup. That one did slide and weighed on L'Oreal, so potentially expectations lowered heading into this one. Then we're also looking at EssilorLuxottica, another French-listed company, maker of sunglasses and also general eye care. Now, sales out of them pretty strong as well after market last night. Constant FX sales on the quarter up 5.5%. The maker of Ray-Ban and Oakley, however, sees the strongest growth over in Latin America, up as much as 11% in terms of sales. But the interesting thing here is they say North America saying weakness in some sunglasses. Americans not buying enough sunglasses, according to them. Now, in terms of the analyst ratings, we've got 13 buys, only 3 sells. Even as this stock trades near a record high at the moment, the prescription business does give a bit more of a defensive quality to the stock. It's a bit more stable than sunglasses. We can see it up 87% on a 5-year, but as I say, that stock near a record high at the moment. Then we've also got a big share sale over in the auto space. Geely from China is offloading around $1.3 billion worth of Volvo truck shares, according to a statement yesterday. They will remain the second largest holder in the company, according to the statement. There it is on the screen. So they're selling 49.5 million shares. It is priced at a 2% discount, though they say it is in line with their longer-term strategy, kind of just diversifying the portfolio, but it's priced at a discount, and that stock is expected to continue underperforming the broader auto sector this morning.
All right, our equities reporter there, Joe Easton, walking us through some of the stocks to watch. We thank you so much. He'll be back later to give us an update. There's another one that we are also keeping an eye on. That, of course, is Schneider Electric. This is one of your favorite, one of your sensational six. Confirming talks with Bentley Systems on a potential deal. They're still saying they're early talks. Remember, the Wall Street Journal had reported this yesterday, saying there may potentially be a merging of its software business with Bentley Systems. But again, early stages. They are now coming out and saying that is a confirmed report.
A lot of money in engineering, in transition, in all of that grid technology.
Well, this is an AI play. This is what people are using Schneider for, basically, at the moment. It's how do you power up these big software centers that AI is going to require, and it's got a lot of the technology, so that's why it's had the pops that it's had. It's interesting you kind of plug that into next to I use the term advisedly, ABB as yesterday, that was also kind of moving strongly on this story as well. But it's interesting they're expanding now, looking to get a greater footprint in the States on the software side.
Yeah, we'll see how much these individual stocks cut through, won't we? Because expectations are that we open a little bit weaker. The geopolitics very much to the fore. With that in mind, we're keeping an eye on what's happening on the island of Capri. G7 leaders are gathering there. We've been monitoring the images coming through as they assemble ahead of the G7
Noting here,
meeting.
Iran's army chief says that Israel has already seen our reaction.
German foreign ministers as well in this shot. We'll continue to bring you lines from this as well. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up now for your trading day with a look at what's ahead. American Express will be reporting its earnings before the bell. Then Chicago Fed President Austin Goolsbee participates in moderating a Q&A at 10:30 a.m. Eastern. India's elections then begin with Prime Minister Modi seeking a third term with over 900 million people eligible to vote. Now it's moving in the pre-market. Netflix is falling as its second quarter revenue forecast was a slight disappointment, but it absolutely crushed subscriber expectations. But soon they're not going to report subscriber growth anymore. Paramount shares, those are jumping. Apollo and Sony are said to be considering a joint offer for the media company, up some 10.2%. Coinbase also rising as Bitcoin rebounds from its losses. We're getting the Bitcoin halving over the weekend, but some of the Bitcoin bid coming in with a bid for the rest of havens, which is subsiding. Stocks, though, are still lower. We're on track for our sixth consecutive day of losses for this U.S. equity market. Should it hold, it would be the worst since October 2022. We're still monitoring the lines of Iran and Israel. We'll have that for you on surveillance, which is up next. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The basic fact is growth has surprised persistently, for the last year.
The U.S. is quite boomy right now. That does not seem like an economy that has restrictive monetary policy.
From just a growth perspective, we're exceeding expectations, but people are still nervous.
The question is, for the next 10, 15 years, is inflation at 2.5% or 3%? And the economy is perfectly fine with that and can continue to grow.
The U.S. is performing in an exceptional way. The question is, that sustainable or temporary?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. The latest overnight. Israel said it would respond. Reportedly, it has responded. Long-range missiles targeting an Iranian Air Force facility. And the moves in crude, maybe not as obvious as you might think. We're lower. We're negative across the board. Let's bring up the board. WTI and Brent a little bit softer on the session. Most instructive, Bramo, what they didn't hit and Iran's response to it.
Basically, this was signaling. They didn't hit any of the nuclear sites, and that was sort of the big fear that would cause some sort of retaliation by Iranian officials. But they did target specific areas by drone. The idea being, this is messaging. We can do more if we want to.
So, Anne-Marie, a couple of questions, I think. Have they demonstrated superior capability after the strikes from Iran on Israel? And do you think that's going to reinforce more of a deterrence for the Iranians going forward?
Absolutely, in the sense that they took that fine line we've been talking about for weeks. How do you have an attack without sparking some retaliation cycle, this revenge cycle that they want to try to de-escalate? So it's an attack, but it's a de-escalation as well. And already there's reports that Iran says they're not going to strike Israel after this. They were sending a clear message. And that's why you see Brent pulling back. Goldman Sachs this week said already there's $5 to $10 a barrel already in geopolitical risk premium into these markets, but futures may fall without escalation. This is not escalation. This is just capability showing that we can hit these targets if we wanted to.
Okay, I'm just going to say for now, because you have to think, okay, this is a tit for tat. For now, Iran's not going to respond. For now, Israel isn't going to go after any of the more sensitive sites, but they're showing they've got the capability to do so. And right now, it seems like within Israel, there is a feeling, as one of the representatives said, this is weak. So you do have that push on one side for a little bit more.
Yeah, I think we end the week how we started the week, which was a couple of words that's been familiar to this program over the last few days. Contained. Contained but not calm. And not calm was how you phrased things on Monday. And I think that's still true this Friday.
It is. What I found really interesting in markets was how markets actually responded. Because suddenly, where are the haven trades? Treasuries. How does this work? At what point does that break down, given the fact that ultimately, if you do get some kind of curtailing of oil flows, that is going to be fundamentally inflationary. So there's some real questions here about what calm means and what an escalation means beyond just this particular region.
Big turnaround in equity futures. Equity futures overnight were down by more than 1 full percentage point. At the moment, if we get to the board, equity futures at the moment, negative 0.4% on the S&P 500. Lisa talking about that bid into bonds, it sticks. Yields are lower by 5 basis points on a 10-year, 457.96. On the south side, going into the weekend, no to the morning so far. I salute you, Michael Hartnett, over at Bank of America. If the dove don't fit... That's in the note this morning, in the Flow Show, the Bank of America regular weekly note.
Yeah, well, and what he was talking about is that, and I'm going to use this because he used this, good economic news is starting to be bad news for stocks. I started reading this. I'm like, yes, we get to talk about good news is bad news, bad news is bad news. And I know that you love that so much, so I was excited for that. But this idea that we've had the biggest 2 weekly outflow from U.S. equity funds going back to December of 2022, there has been a shift where higher yields are punitive for equity valuations where they are.
There's been a shift as well in the Fed speak. I think we have to acknowledge that. I don't think the base case has shifted just yet for many of the policymakers on the FOMC, but let's pick out 2 policymakers in the last 24 hours. Let's go with New York's John Williams, and we can go with Kashkari of Minneapolis. Kashkari entertaining the idea that there might not be cuts until 2025. John Williams, not his base case, we'll be clear about that, just entertaining the idea that if inflation demands it, they can push interest rates higher. Now, I'm not suggesting they're going to hike anytime soon, anything but I think they know what they're doing. When a Fed official comes out and uses that kind of language, they know exactly what they're doing. Are they pushing for tighter financial conditions?
I will just take this a step further and say that this is a pivot from the pivot, because this is John Williams, who essentially was one of the bigger doves on the committee, coming out and raising the prospect of a hike at a time where they know how that's going to resonate on Wall Street.
So it's a U-turn then? Is that what you're saying? The Fed is actually making a U-turn?
The pivot on the pivot is the U-turn?
It's not a U-turn.
It's not a U-turn.
Because that's deliberate.
Should we do that another time? We should do this in commercial breaks and maybe not live on the programme. Coming up this hour, Victoria Fernandez of Crossmark as investors weigh outside risk in the middle of earnings season. Douglas Redeker of International Capital Strategies as Israel responds with a direct strike on Iran. And Tobias Adria of the IMF on the last mile of disinflation. We begin with our top story in this market. Investors weighing geopolitical risks and a more hawkish Fed as earnings season ramps up. Victoria Fernandez across Mark saying this: we will need to see earnings be the driver of further stock price appreciation. Over 70% of the S&P 500 companies have issued EPS guidance for Q1, have actually lowered estimates. Victoria joins us now for more. Victoria, great to catch up. We need to talk about the Middle East, the Fed speak. Let's start with the earnings. Are you saying that earnings won't be able to do the heavy lifting going into year end?
I'm not sure they're going to be able to do as much heavy lifting as the market is anticipating. They're still looking at double-digit earnings growth. I think that's a big stretch. Obviously, we're just about a week and a half in to earnings right now. Banks were okay. The market didn't have big moves on that. And obviously, we haven't hit a lot of those growth companies yet that tend to move the market a little bit more. But we're not seeing the lift that I think we're going to need to see in order for valuations to stay at a 21 and a half, 22 times earnings that we're seeing. I think we're going to have a pullback somewhere in there, and earnings is probably going to be the catalyst for that to happen.
Victoria, last time we spoke, you were looking for economic weakness. I've got to ask the question, where is it?
Yeah, you know, I expected that we would have seen more of that by now. There are some elements in there, and I guess weakness, John, we have to look and see, how do we want to categorize that? Is weakness in the economy going to be the fact that the numbers are stronger and therefore the Fed is going to keep rates higher for longer, and that puts more pressure on the economy? It's very much kind of a cycle when you get going there, but the consumer continues to be strong.
34% of economists are saying that the Bank of Japan will hike interest rates again in Q3 this year, and 31% see a cut in Q4.
That's what we're waiting on, and it could be earnings. We're just talking about that. It could be margin pressure from earnings as pricing power starts to erode that is going to begin that cycle of pressure.
76% of economists say that Japan will intervene to stop the yen from weakening further at 155 per dollar.
And that right now we're looking at stocks that are poised for some sort of additional downturn, additional to what we've seen over the past 5 and maybe 6 sessions.
Yeah, you know what, a month ago, Lisa, I think everything was good news. It didn't matter what came out. It was all positive. It was all good news. Momentum was really driving the market. And now I do think we're starting to see a little bit of shift in that, a lot because of what's come out from Fed speak, but also because I think people are concerned that we're not going to see the growth expectations.
ECB Simca is saying that quarterly projections will form basis for cuts, and that 3 or 4 rate cuts are possible for this year.
We'll see the earnings come through on those. Netflix obviously did better, but guidance was poor, so that stock is down. We'll see what happens with the rest of the handful of those stocks, but the momentum isn't what's driving us anymore, and I think that's key when we're looking. Low momentum names have actually outperformed high momentum over the last week, so I think we do have to take a step back. The equal weight S&P is below the peak that it had in early 2022. I think that's telling us that we're starting to see some worry come into this market.
So, Victoria, what do you do with this, considering the fact that everyone just seems to be piling into oil stocks? So those have been getting a massive bid. Bonds are all over the place. I can't come up with a consistent narrative. And then gold, a lot of people are saying maybe has gone a little too far. So what do you do?
Well, I think you have to have some defensive components in your portfolio. We've talked about that before, and you know that we like the bond market as well, locking in some of the income that you can get in a barbell, both on the short end of the curve and the longer end of the curve to do that. But look,
G7 foreign ministers say they will impose new and significant measures against Iran if it transfers ballistic missiles to Russia.
Sector, again, another good defensive play that you can put in your portfolio. So there's some areas that you can go into to add some defensive posture, some low
G7 foreign ministers urge financial institutions to stop supporting Russia's military and will take steps to ensure this happens.
How things play out over the next couple quarters.
Well, Victoria, as we wait to see how things play out, we're waking up to a world
Call for an immediate release of Israeli hostages and a sustainable ceasefire in Gaza.
Do you expect this to continue to be basically the status quo until there is serious confrontation in the Gulf?
Yeah, I think there's going to be a lot of turning going on here, Anne-Marie. I mean, obviously, the retaliation that we saw from Israel, many people are saying, yes, it was just a warning shot. It's just kind of letting them know we're here. And, you know, there's that phrase, kind of mess around and find out what's going to happen. And I think that's what they were doing, which is why markets have rebounded from what we saw overnight. So I don't think that we'll see a huge shift today unless there's more action coming. But I can't imagine that this is going to be it. I can't imagine we're done. There's going to be more pressure coming from geopolitical events, along with the elements that we have going in Congress. We've got 4 aid bills sitting there right now that need to be voted on. So I think there's a lot more coming, which is just going to cause more churning and more volatility in this market.
Do you think that puts a floor under crude? Because we have had a week of losses in a crude market. WTI and Brent pulling back, mid-80s on Brent, low 80s on WTI. What kind of a floor do you think is in the energy market?
Yeah, I don't know a number, Jonathan, on the floor for the market, but seeing the rally that we had overnight above 90 on Brent and the fact that it's pulled back to where it is now, I think you're looking at kind of a consolidation trade where we are here in the mid to low 80s. I would expect that we would stay somewhere in this range. And you're looking at OPEC Plus. I haven't seen any statement come out from them, but as of late, they're saying, look, we're going to continue with the cuts that are in place. They're not looking to add any more supply. And as China starts to ramp up a little bit, you've got some more demand coming in. So I think we could move closer to that $90 range than to, say, a $75 or $80.
So the big rotation, the elusive rotation that everyone was positioning for out of Q1 has faced a bit of a challenge, particularly for the small caps. Energy really started to work in the month of March coming into April. Victoria, is that a trade in the equity market that you want to stick with?
I think you have to stick with it for now, and I'm not just saying that because I live in Houston, right, and I'm trying to pump up the energy trade, but small caps have taken a really tough hit on the chin, and look, we think we're going to see some more correction. If you go down for the S&P 10%, that's down to the 200-day moving average. I wouldn't be surprised if we start to go closer to that level, and small caps are just going to continue to struggle. We need to see better economic strength globally, and I think we need to see the Fed have a fair plan laid out before we start to see a rebound in the market. That's when you're going to want to go into small caps. Energy continues to be a strong play with the good cash flow that they're seeing on their balance sheets.
Hey, Victoria, great to catch up to close out a week with you. Victoria Fernandez there of Crossmark. Big repricing higher in interest rates over the last few months has really hammered the small caps. Another tough week, another struggle. Looking at crude, we're down about 0.5% on Brent, down about 0.3 on WTI. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. 12 jurors and one alternative have been selected for Donald Trump's trial in New York. It's his first trial and the first ever criminal trial against a former president. Opening arguments in the case could start as soon as Monday. Trump also faces 3 other criminal prosecutions. He's denied wrongdoing and claims the cases are part of a political witch hunt against him. Paramount shares surging in the pre-market, up more than 10% after a report that Sony and Apollo are considering a joint bid for the company. Paramount is in exclusive talks with Skydance, but the proposal has generated significant investor pushback. All that according to the New York Times. Apple has removed WhatsApp from its Chinese App Store at Beijing's request. Threads, Telegram, and Signal have also reportedly been removed. Apple said the country's Cyberspace Administration ordered that social media apps be removed over national security concerns. If that sounds familiar, it's because the U.S. has also cited national security concerns in politicians' push to force a sale or a ban of TikTok. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. You spot the difference, though. The difference in how things get done in China versus the United States. We're still working this out in Congress. In China, it's just like, bang, Apple, done.
There's a healthy debate in China, what they call the Great Firewall. We want to get rid of some of this stuff. We want to control some of the communication, and it's done overnight.
Just like that. Coming up on the program, up next, Israel retaliates.
The Israeli retaliation will likely be proportional. It will likely be limited. It will likely be something that is meant to demonstrate we can touch you in ways that hurt.
And it looks like that's exactly what it was overnight. That conversation up next, live from Washington. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Equity markets recovering from overnight losses on the S&P 500, negative by something like 0.4%, down a lot more than that. Late yesterday evening, we were down by more than 1 full percentage point. Yields, though, still lower. Heading south, we're down by 6 basis points, 456.73, and crude settling down, softer by 0.6% on WTI 82.26. Under surveillance this morning, Israel retaliates.
Israeli retaliation will likely be proportional. It will likely be limited. It will likely be something that is meant to demonstrate we can touch you in ways that hurt. And for that reason, I think Israel is also not looking for a conventional war itself.
It's the latest this morning. Israel launching a retaliatory strike against Iran, according to U.S. officials. Iranian media reporting an explosion in the country's third largest city. The IAEA saying no damage was done to nuclear sites. The news adding to pressure in Congress as the House looks to pass a $96 billion aid package for Israel, Ukraine and Taiwan this weekend. Douglas Redeker, founder of International Capital Strategies, joins us around the table this morning. Doug, good morning to you.
Morning.
It's good to see you. Do you believe that Iran, based on reports, has just witnessed superior capability coming out of Israel?
Well, it depends on who's going to answer that question. I think objectively, from what we know, this seems to be, as your guest, that you just showed the tape said, it's a limited response that shows a signal that we can do more. But of course, the Iranians are spinning it as, no, we shot these things down, and as I understand it, they're not even mentioning it. The president gave a speech today, didn't even mention the attack, went back to the attack last week, didn't mention this attack. The Israelis, of course, are saying, yeah, well, we showed them. Let's see. I think one of the things that we have to think about is, what does the White House think? Because, of course, the White House said, don't do anything. So is the White House going to say, all right, well, you did something, just not as much as you could have, so you kind of deferred to us? Or does the White House say, hey, we told you don't do anything, now you did this, now there's a risk? The IRGC are a bunch of bad guys. So whether they have decided to retaliate or say they're going to retaliate this morning or not, there's still a risk that there's going to be an escalation here, and that's what the White House obviously does not want to see.
You brought up the White House, so let's talk about that a little bit more. Let's explore it together. So the White House told Iran don't, Iran did. They told the Israelis take the win, they didn't. So how much influence does the White House actually have over what's happening in the Middle East?
More than I think your question suggests, but a lot less than we'd like it to be. So if you go to where the Israeli war cabinet wanted to be, they're, all in, right? There is no dovish wing of the Israeli public or the Israeli government anymore. There's hawkish and even more hawkish. So on that basis, I think that the Israelis have been, believe it or not, somewhat restrained in how they've responded not only overall to the Iran response, but to Rafah, to Gaza. I mean, it's hard to say it's anything other than egregious in many cases, but it has been somewhat more restrained than we thought might have been the case. Having said all of that, obviously the White House has been trying to tell Netanyahu and his government, don't do a lot of the things that they're doing anyway. So it's a balanced picture here. But I don't think it's right to say the White House has no influence. I think in particular in the Rafah thing. Remember, 6 weeks ago, the threat was, if there's no hostage release by Ramadan, we're going into Rafah. Now we're after Ramadan, and they still haven't gotten into Rafah. That doesn't mean they won't, but it does mean that there's been some tempering of the worst-case scenarios.
Doug, you've done a lot of work on sanctions, not just when it comes to sanctions the United States puts on countries like Iran, but also Russia. Have any of these sanctions worked? Because the U.S. is mulling new ones, but they have a laundry list of others. It just doesn't seem like they're enforcing them.
Yeah, so your question has a lot of parts to it. First of all, let me start with the end of your question. Enforcement is the key, right? So what we do, what we say, and then whether we enforce it are often two different things. First of all, sanctions used to be very rare. Then over the past decade, they've become enormously commonplace. That's a problem for the markets because what are sanctions? Sanctions are basically the government stepping in and impairing commercial relationships for geopolitical or other strategic reasons, right? That's what they are. They are simply saying, you have a contract, we're going to tell you you can't enforce the contract. You want to buy something, you want to sell something, we're going to say no. Okay, but then the question is on oil, which is where a lot of the sanctions are focused. Venezuela, Iran, Russia. What we've seen is sanctions that are not only porous, they're almost blatantly ignored. And so the question then becomes, if you put on sanctions and if you ignore the compliance with those sanctions, then are you undermining the effectiveness of those sanctions? The one part of the sanctions regime that works, and it really works, is secondary sanctions. That's where we basically say no bank in the world can touch anything that has even a secondary relationship with something that we've sanctioned. So the banks, which have enormous compliance departments, say, okay, we're not going to touch this. We have not done that in most cases. Why? Because we're worried we're going to wrap up Chinese banks and other banks in a much more broad-based, geopolitically significant way. So we're saying, number one, we kind of like oil being on the market because it helps gasoline prices. Number two, we don't want to go there on the secondary sanctions level. So yes, we're escalating sanctions. Yes, they're a serious threat. No, we don't enforce them very well at all.
Well, all these issues are basically a cloud that's overhanging the IMF meetings, especially what higher oil prices would mean to some of these central banks at the same time that they're dealing with a stronger dollar. How much are you seeing on the sidelines of this IMF? How much U.S. policy is impacting the rest of the world?
It's certainly a major topic of the official meetings. So it's hard to say that people aren't saying, wow, U.S. Fed policy, U.S. fiscal policy, the debt deficits. And, that has been a percolating message across the meetings. What's interesting to me is if you go back 6 months ago to Marrakesh, to the last time this group got together, many of the same issues were there, but the reaction to participants then was one of enormous, I don't want to call it panic, but it was enormous unsettling nervousness. Now the same issues are here, and everybody seems to be saying it's too uncertain for us to figure out how to price it, so we're going to ignore it. And that's really interesting to me. It's almost the difference between risk and uncertainty. Uncertainty is too big to price, so you can either take your money off the board and go home, or you can say, I'm just going to ignore it. And that's what seems to be what's going on.
That's where I wanted to go. How much is this faith in the election cycle, given the fact that ultimately some of the people, this administration in particular, doesn't want disruptions of a certain type, read higher oil prices, ahead of the election. And so therefore, they probably are going to pull out all the stops to either not enforce sanctions or unleash the Strategic Petroleum Reserve to prevent that from happening. So why not bet on that? Why not bet on the Federal Reserve doing the same kind of thing?
So the premise of the question is the uncertainty, right? This is not the stuff that you can model out. One of the problems that markets have is they don't do geopolitical risk very well, but they also don't understand politics very well. They think they do. They get obsessed by it, but they're really pretty bad at it. So, I mean, to answer a different question than the one you're asking is, everybody is saying to me, what's going to happen in the election? And everybody's telling me what their favorite pundit is saying, and I keep saying, you've got to be kidding me. It's April. Right? There are going to be 25 surprises between now and November. There are going to be 10 surprises in October alone. There are going to be 5 of those are going to be man-made. 5 of those are going to be natural disasters. Who the hell knows? So everybody is kind of looking at the U.S. election as the huge elephant in the room. And I've met with a number of government delegations this week. And I've said, how much is that impacting your thinking? And a lot of them say it's not, because we just don't know what to do about it. We found ourselves misplaced back in January coming out of Davos. Everybody was like, Trump's going to win, Trump's going to win. Now everybody's like, we don't know. I said, so what are you going to do about it? They say, we don't know.
Doug, it's great to catch up with you, sir. Appreciate it. It's fantastic to see you.
Always a pleasure.
Douglas Redeker there of the International Capital Strategies, weighing in on a whole host of issues. The lack of
So just a correction from the source. The Bank of Japan will hike interest rates again in Q3 this year, according to 34% of economists, and 31% see a hike, not a cut, in Q4.
Well, she wrote this paper, and I was actually reading through the whole thing last night, where she was talking about what fragmentation actually looks like. And what she found is it's not less trade. It's just going through intermediaries that actually create less efficiency. So I want to understand how much that's going to be inflationary going forward on a structural basis, in addition to some of the other issues that we've been talking about.
Looking forward to that conversation a little bit later on this morning. Coming up next on this program, Tobias Adrian of the IMF. That's coming up very shortly, live from Washington, D.C., with equity futures recovering on the S&P 500. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference. There's putting your mouth and money where your mouth is and really trying to do something about a problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
5-day losing streak on the S&P 500 coming into Friday. Could become day 6. Equity futures negative here on the S&P by 0.4%, on the NASDAQ down by 0.7%. We're off by 0.75% on the Russell. The small caps not having a good time through the month of April. On the S&P, the longest daily losing streak going back to late October. Let's switch up the board and get to the bond market. Big moves again this week. 2-year yields making their way back towards 5% in yesterday's session, then pulling back 4 basis points. The 2-year 494.71. You just get the feeling that the conversation, maybe not the conclusion, but the conversation is changing at the Federal Reserve based on some of the commentary, Lisa, we've had over the last few days.
And the John Williams note that you pointed out, really, to me, that speech highlighted just how much of a turnaround there's actually been. This was one of the big doves coming out and even acknowledging the possibility of a hike if the data were to come in hotter than expected really speaks to a complete shift in how they're thinking about this.
4 consecutive weeks the 2-year yields have been pushing higher. So yields have been pushing higher again this week, trimming some of that gain just on today's session. If you switch to the board, and you probably want to know where crude is. Crude's a bit softer on the session and down on the week as well. For a second week, we're down by 0.6%, 86.56. WTI down to 82.29. The market is sort of embracing this idea that things are contained in the Middle East. But Lisa, I think you've done a fantastic job this week of making sure that this market alone doesn't shape your thoughts exclusively as to what is happening in the Middle East. Because as Norman Rule said on Monday, this is a new Middle East after the lines we crossed over the weekend and again overnight.
And you saw that with respect to the knee-jerk reaction going up to $90 on Brent very quickly in terms of what kind of reaction it is. And frankly, in every note that we get across Wall Street, people talking about the increasing possibility of $100 barrel of oil if there is some sort of greater escalation that could be highly punitive for other potential asset classes.
Greater escalation that hits global supply. So what we've seen in terms of missiles back and forth between Israel and Iran does not touch a barrel of oil. And that's why you're seeing all this risk taken out. Now, if it was to touch, say, vessels in the Strait of Hormuz, then we have a different price on Brent.
86.56 is the price on Brent right now. Under surveillance this morning, Israel launching a strike on Iran after vowing to respond to last week's unprecedented attack on the country. Explosions were heard in Iran's 3rd largest city. The United Nations watchdog says nuclear facilities located there are safe. The details, I have to say, at 6:32 Eastern Time, here in America, still really vague and very foggy. At first it was missiles, then it was drones. We've got various reports coming out of Iran suggesting that this was unsuccessful and they won't be doing anything about it. What do we actually know, Anne-Marie, about what took place late last night?
Well, there's still a lot we're trying to digest. It also depends what media you listen to. So Israeli media is saying it was missiles. Iranian media is saying it is drones. And actually, it wasn't big enough to even warrant a national security meeting that they're having. They're trying to downplay this, potentially for 2 reasons. One, they want to show that they got the last big hit. And 2, if they really don't want to escalate, they have to show that their public domestic consumption, that this wasn't big enough to then warrant an escalation back to Israel.
To your point, John, we don't know what they hit. That was one of the big questions. What exactly were they targeting? It was a highly targeted strike on what? So, yeah, still a lot of questions out there.
Demonstrating capability, I think, is a conclusion that a lot of people made on Monday before we even had these strikes. And if you are targeting that specific city, isn't that what you're trying to demonstrate? That you can, if you need to.
Absolutely. Isfahan is where you will have nuclear facilities. It's where you will have drone manufacturing. It's where also one of the big cities that was key for Iran when they targeted Israel with those more than 300 missile and drones. So what Israel is saying at this moment is, we are not hitting you right now, but do it again and we will hit you.
That's the latest on strikes in Iran. We'll give you regular updates throughout this morning, of course, on Bloomberg Surveillance. Tech season, tech earnings season kicking off. We should check it on Netflix. Shares actually falling in pre-market trading. The streaming service giant posting its best start to the year since 2020. However, the company's guidance saying they expect subscriber gains to be lower this period, and investors will no longer get quarterly membership metrics. That's what's weighing on this stock, Bramo. We're down by about 6.8%. It's hard to point to subs growth as a reason for the stock to be up when the company itself is saying it's no longer going to provide it going forward.
Because they're going to get value in other ways. which means basically prices are going up. If you read this release, it's basically like, how many ways can they raise prices on your Netflix account? And oh yeah, if you are sharing anyone's account, then you potentially are going to have a problem
do that?
going forward. But I am thinking that maybe this also speaks to just how much risk aversion there is in the market right now, that not even that big of a miss gets punished this much in markets.
I can't decide whether to tell the audience who around this table is a password sharer or not.
You can't tell?
Is it a sharer? Is it a moocher? It's a moocher.
A moocher?
I'm going to say this. I think Netflix has done a fantastic job cracking down on passwords, but maybe they need to do a little bit better.
Netflix is down by 6.66%. Let's get you the Fed wrap. Presidents Kashkari and Williams saying rate cuts may not come this year. Williams adding that a hike is still possible if warranted by the data. Bostic saying a cut is unlikely until the end of the year and that he has to be open to higher rates. Tobias Adrian of the IMF also warning the fight against inflation may be stalling, saying this: there is recent evidence that disinflation may have stalled in some countries. Higher than expected readings could challenge the last mile narrative and related investor optimism. I'm pleased to say that Tobias is with us now. Joining us from Washington, D.C. for more. Tobias, fantastic to catch up with you, sir. The last mile has proven to be difficult. Rates have repriced higher. It's driven a much stronger US dollar, and we're seeing complaints from all over the world, from Japan to South Korea, Malaysia and elsewhere. Tobias, at these meetings this week, have those countries been given a green light to intervene if they need to?
Yeah, good morning. Very good to spend time with you today. So we have certainly seen quite a bit of movement in the dollar since the beginning of the year, in particular since the announcements of inflation data in the US that was above expectations. The moves we are seeing in currencies is fairly closely aligned with moves in currency differentials, so we're watching the situation closely.
Do you think if this is driven by larger deficits and industrial policy, that perhaps countries are maybe have a stronger argument to intervene than maybe they otherwise would do?
Well, when we are thinking about currencies, we look at two main inputs. The one are fundamentals. So exchange rate differentials are a key driver of exchange rates. The second thing we're looking at are market conditions. So to what extent are market conditions orderly or disorderly? To date, these movements have been fairly orderly, but we will certainly be monitoring the situation.
Tobias, some people have been talking about the idea of the election and what could happen if there are proposals for tariffs, as well as potentially increasing the deficit further, whether we could see something akin to what we saw in the United Kingdom under the former Liz Truss. Do you think that that's a risk?
Well, we have certainly seen fluctuations in longer-term bond yields in the U.S. and around the world. Some of that is certainly driven about expectations of fiscal policy going forward, but there are also other ingredients such as Federal Reserve policy and other central bank policy about quantitative tightening, i.e. the balance sheet going forward, and then the economic outlook. So part of the drive up in bond yields is reflective of the very strong economic performance, particularly in the U.S., that really has kept surprising to the upside in recent months.
One thing that we're trying to get a handle on, Tobias, and you're wonderful with this, is understanding where financial systemic risk is. And I guess that's the reason why we're focused on the dollar. When is it going to be strong enough to break something? That's what we're focusing on yields. When are they high enough to break something? Where do you think the biggest financial systemic risk lies?
Well, the good thing is that the major emerging markets have been very resilient. Really, over the past 5 years, we have seen massive shocks. The pandemic, inflation, geopolitical tensions, and the strong policy frameworks, the higher reserve levels, the strong regulation of banks has kept these major emerging markets very resilient really for a long time. So when we are looking at financial stability issues, we continue to worry about financial sector weaknesses in some corners. In most countries, there's a weak tail in the banking sector, and in the baseline of a soft landing and of global inflation coming down, that weak tail is probably okay. But in an adverse scenario where inflation is higher than expected, more persistent, where interest rates are moving, and where credit risk may deteriorate more than what is currently priced in, we could certainly see some turbulence going forward.
Tobias, what is that weak tail? Are you talking about hedge funds that have dominant positions in treasuries? Are you talking about regional banks? What is it?
Banks around the world do have exposure to credit risk. For example, in the US, there are some institutions that have exposure to commercial real estate, and of course, quite a bit of commercial real estate is coming to refinancings this year and next year. So a combination of the macro outlook together with a tightening of financial conditions could put some banks, but also some non-banks, under pressure.
The IMF really pointed to loose fiscal policy in the United States as being an issue for the rest of the world. How much do you see the Inflation Reduction Act out of the U.S., that fiscal policy, adding to inflation that the rest of the world is dealing with?
Well, the good thing for the world is that the U.S. economy has been very strong, and that is, of course, a positive spillover to other countries. Demand is strong. Capital market activity is very strong. Capital markets have reopened for very countries that weren't able to issue in the past year or year and a half, and we have seen very strong issuance. So the dollar markets really remain very important for issuers around the world. Financial conditions have been tightening to some degree in recent days as volatility and uncertainty more broadly has increased. But spreads remain fairly tight even for riskier issues. So overall, the picture remains fairly positive.
Interesting. Tobias, we appreciate that assessment this morning. Thank you, sir. I know you've got a very busy day ahead of you. Tobias Adrian there at the International Monetary Fund on what's happening in capital markets right now worldwide. We've heard plenty of complaints from places like Japan, South Korea and Malaysia. Malaysia has had to intervene in the FX market because of this rip-roaring dollar. Plenty of concerns about potential crowding out in capital markets given where yields are in America and the amount of capital that's currently attracting into US capital markets. But what you heard there, Bramo, was almost the positive assessment of the spillovers that come from better than expected US growth.
Basically, this is the reason why the IMF upgraded their forecast for growth globally, so that this is more of a positive than a negative. Okay, maybe you're not going to hear that from some of these central bankers that have to deal with it on the other side. But this, to me, raises this question. Are we looking at a world where it's going to be stronger dollar and there isn't necessarily the disruption to derail that? Also, remember all that discussion about de-dollarization?
Yeah.
Where do we go with that narrative?
His assessment of the FX market was interesting. So the way they look at things, have we seen excess volatility or disorderly moves? I think the way the rest of the world looks at things is, okay, is this based on fundamentals? Is this based on unsustainable policies? Is this based on policies that we just can't compete with? So if you believe this is based in part on an unsustainable fiscal deficit, in part on perhaps even industrial policy, and you're a country that maybe doesn't have the ability to do the same thing, certainly does not have the privilege that America has when it comes to raising debt and going forward with big industrial policy initiatives like the Inflation Reduction Act that you mentioned, okay, then do you have a reason to intervene? Which is kind of what I was trying to get at there. How legitimate would intervention be in countries that do not have the options in front of them that America does?
I would argue you could draw an analogy between what you just described and, in a way, what China is doing with respect to putting their thumb on industrial policy and subsidizing it. On one level, you can say, okay, that's not a fair playing field. The U.S. has the privilege to borrow and then to fuel a recovery that allowed it to avoid the scarring of the pandemic that the rest of the world did. So then, do you have a legitimate reason to intervene? but can you? And I think that might be the more relevant
That's
question.
a much tougher question.
Yeah.
I think you're fighting against what? What did you say? It's like throwing money uphill and hoping it doesn't roll back down. That was a great phrase earlier this week. I think it's true.
I appreciate it.
And it's exactly what they're trying to confront in foreign exchange at the moment. Let's give an update on stories elsewhere this morning. Let's get to the Bloomberg Brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. High prices are still hitting UK shoppers. Retail sales in the country unexpectedly stalled in March. Shoppers scaled back spending on food and department stores. The volume of growth was unchanged in March. Economists had expected a 0.3% increase. Deutsche Bank is overhauling its staff for some Asia offices, trimming 10 private banking roles over the last week. As many as 60 were cut in Singapore and Hong Kong over the last year. Deutsche Bank wants to focus on more profitable markets and weed out underperformers, according to people familiar with the matter. Tesla shares lower pre-market this morning, down nearly 2%. They recalled almost 4,000 Cybertrucks. Tesla will be repairing accelerator pedals that can dislodge, become trapped, and cause the cars to unintentionally accelerate. Tesla says the fix will be free of charge. That's your Bloomberg Brief. John.
Yeah, that's a problem. Danny, thanks for that. Up next on the program, tech earnings season kicking off. Up next, a new approach from Netflix.
We're not going to be silent on members as well. We'll periodically update when we grow and we hit certain major milestones. We'll announce those. It's just not going to be part of our regular reporting.
That conversation up next, live from Washington. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
So just a reminder, at 6:55 a.m. Eastern Time, we're expecting earnings from Procter & Gamble with core EPS estimate of $1.41 and net sales estimate of $20.43 billion.
Future officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Equity futures right now in New York, negative by 0.4% on the S&P 500. Just a little bit softer, but I can tell you last night, much weaker. Negative by more than 1 full percentage point as we start to get reports of a retaliation from Israel on Iran. And I have to say, the details of those reports still pretty vague. We'll try and get you more detail as the show grows older. Yields are lower by 7 basis points on a 10-year, 456.53. And in the commodity market, negative by 0.6% on WTI, 82.27. This week, we wrapped up earnings on Wall Street, and now the attention starts to turn to big tech on the West Coast. Under surveillance this morning, Netflix's new approach.
We're going to report and guide on revenue, on OI margin, net income, EPS, free cash flow. We're not going to be silent on members as well. We'll periodically update when we grow and we hit certain major milestones. We'll announce those. It's just not going to be part of our regular reporting. We're going to continue to report subscribers until Q1 of next year.
Here's the latest this morning. Netflix falling in the pre-market despite posting its best start in 4 years, adding over 9 million new customers, nearly doubling estimates. The company also announcing it will stop reporting paid quarterly memberships and revenue per subscriber in 2025. Joining us now is Bloomberg's Geetha Raghunathan for more. Now, Geetha, this stock in the pre-market has been getting slammed over the last few hours. And it's interesting because the numbers themselves pretty decent. So I think we have to start elsewhere. Removing certain disclosures. Geetha, do you sense that's what's spooking this stock this morning?
Yeah, absolutely, John. It has definitely rankled investors because remember, Netflix at its very core is a subscriber story. It always has been a subscriber story. I mean, this has been one of the easiest companies in the media space to model out. You have number of subscribers, you have their average revenue contribution per month, you just multiply those and you have your whole Netflix model. But that's not the way it is going to be anymore. There's just so much more nuance to the way that the model is working because the company now is a mature company and that's really what they're saying. But obviously it is going to be very hard for investors to map out the growth because you don't
So
have
just
that
less than 5 minutes away now until we do get
Geetha, can we just throw
Procter
this in as
& Gamble's
well?
Q3 2024 earnings, estimated EPS of $1.41 with an estimated revenue of $20.43 billion.
If you look at the way subs come in relative to the estimate, it's all over the place every single quarter.
And as well as that, at 7 a.m. Eastern Time, we do get American Express's Q1 2024 earnings with an estimated EPS of $2.96 and an estimated revenue of $15.77 billion.
Around earnings, to your point, John, it is hard for them to predict things, and you know, this is, I think, in a way the right approach for them to take. You know, they have consistently said over the past couple of quarters that, you know, subscriber growth is no longer the main metric. Yes, it is important, but what they really want investors to focus on are the financials, right? Double-digit revenue growth, operating income, and look at the operating margins. We're getting to 25% this year, possibly 30% in the next couple of years. And that's really been the question all along, right, John? Can Netflix replicate the old media model where companies were earning about 32% margins? And it looks like, yes, they can, and maybe they can even exceed that.
So just not on a selfish level, but maybe a little bit on a selfish level, Geetha, I was reading some of the commentary by the executives, and they were talking about monetizing certain corners as they provide more quality and value to their subscribers, which just is huge dollar signs in my mind of how much more I'm going to be paying for Netflix. Do we have a sense of what kind of price increases we can expect going down the line?
Oh, there is absolutely, Lisa, there are absolutely going to be price increases. There is no question about that. And I think the fact that they introduced this new advertising-based tier, it's a lower price tier at about $7 a month here in the U.S., that kind of gives them a lot of leeway, a lot of flexibility to raise prices without really having to worry about subscriber churn. So you look at the standard price or the price of a standard plan of Netflix, it's about $15.50. The price on that plan hasn't really gone up now for more than 2 years. So, you know, rest assured, they're absolutely going to raise prices on that. And, you know, they were asked this question on the call, you know, how much more runway do you think you have? Where is the ceiling? And they actually cited the pay TV bundle as the ceiling, which I thought was really interesting because, you know, the average price of a pay TV bundle is $70. Now, I don't think they're necessarily going to take it that far, but obviously they have a lot of pricing levers and they're going to exercise them definitely.
Is this the new model, Geetha? Because this is kind of what we've heard for Disney, too. That they're going to charge more for some premium content, and they're not necessarily going to focus on growth. Is this the new streaming model at a time where we're reaching, I don't want to say saturation points, but maybe saturation points?
Yeah, I think we are definitely reaching saturation point. I think that's what part of, you know, the not disclosing subscribers also kind of tends to indicate that. But yes, it's going to be all about pricing because remember, the new mantra in the streaming model, in the media model is profitability, is operating income, is free cash flow, and Netflix is delivering. And the one way that they can do that is to keep raising prices at a regular cadence.
Geetha, can you tell us what the latest is in terms of Paramount? Do you see this Apollo deal with Sony potentially going through?
I'm not yet sure about the details, but I think it's definitely great news for investors. They were always very dubious about, the Skydance Paramount negotiations. That was not well received. Most of the non-voting shareholders felt that they would be diluted at the expense of, the Redstones kind of getting
Shortly
a better
expecting
deal,
Procter
in
& Gamble
that
earnings.
transaction. So the fact that, Apollo already actually came in with an offer for Paramount, a $26 billion offer, but there were always concerns, I think, both on the management side as well as maybe even some investors about whether they would be able to finance that. But now that you have Sony, which is a huge player, a huge experience, a huge media conglomerate coming in, I think it's really good news for investors.
Paramount right now up by more than 10% of the pre-market. Geetha, wonderful summary as always. Geetha Raghunathan there of Bloomberg Intelligence. Let's get Netflix back up. Not a great start to tech earnings. If you do consider that stock a tech name, we're down by more than 6% in the pre-market as they start to pull back on certain disclosures. We're negative 6.44%. I think the only thing you care about are the numbers we get in early May, and that's Apple. Apple just around the corner. And Lisa, for me, Apple, the standout this earnings season. Let's not try and be cute about it. Given the year they've had so far, given the amount of different stories, touch points, tension that they touch, I think that's got to be the story of earnings season.
And it's rather inauspicious that the Taiwan semiconductor
Seeing Procter & Gamble earnings coming through now, they see fiscal year core EPS growth up 10% to up 11%, seeing an increase of 8% to 9%. Third quarter core EPS at $1.52, a beat on estimates of $1.41.
Just simply the elimination of that really sent the
Third quarter net sales at $20.2 billion, a miss on estimates of $20.43 billion.
It's going to be even harder to try to map out what the growth model looks like and the
Third quarter gross margin 51.2%, a beat on estimates of 49.9%.
How bad is it, given some of the preliminary data we're seeing? They are really struggling in that market. And AI, they want to do an AI MacBook.
Third quarter organic rev up 3%, a miss on estimates of 3.71%.
MacBooks, more of them, by attaching AI to it? Or is this really going to be a brand new product that you have to go out and get?
Can earnings support this equity market? Equities right now.
And healthcare organic sales up 2%, a miss on estimates of 4.07%.
Of UBS, Terry Haynes of Pangea Policy, the brilliant Adam Posen of the Peterson Institute, and retired Brigadier General Mark Kimmett. That conversation just around the corner. Futures lower, Treasury's a bid, and crude, everything's pretty contained at the moment. 82.35 on WTI. Live from Washington, this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day.
And that brings us to just less than 5 minutes away now until we get American Express's Q1 2024 earnings, an estimated EPS of $2.96, with an estimated revenue of $15.77 billion.
Only on Bloomberg Television.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very.
And also noting Procter & Gamble raises EPS growth guidance.
There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television.
Shortly
Context
expecting
changes
American
everything.
Express's Q1 2024 earnings.
basic fact is growth has surprised persistently, for the last year.
The U.S. is quite boomy right now. That does not seem like an economy that has restrictive monetary policy.
From just a growth perspective, we're exceeding expectations, but people are still nervous.
The question is, for the next 10, 15 years, is inflation at 2.5% or 3%? And the economy is perfectly fine with that and can continue to grow.
The U.S. is performing in an exceptional way. The question is, that sustainable or temporary?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital here in Washington, D.C. for our audience worldwide. Good morning, good morning. The IMF World Bank spring meetings continue in D.C. Bramo's running off to IMF HQ. She's going to catch up with the first Deputy Managing Director, Geeta Gopinath. That interview taking place in about 45 minutes from now. If you want to know where the price action is, I can start with equities. Equities right now on the S&P 500, negative by 0.1% on the S&P, but the focus is in the commodity market. And crude is a lot lower, both on WTI and on Brent. We're negative here by 0.75%. Israel said it would respond, and based on reports we got overnight, they've responded.
Absolutely. What we've seen is a retaliation from Israel on Iran. And what's key here, Jonathan, is the fact that the city they struck, this is Isfahan, this is where there are nuclear facilities in Iran. So what Israel was trying to show was, okay, we're not trying to cause damage, but we are trying to send a message.
What is most instructive, though, in fact, informing perhaps this move in the commodity market this morning, is what they didn't hit, nuclear sites, and it's Iran's response to it, which at the moment is basically, this failed, and we don't need to respond to it.
And in Iran, they're not even, according to local press, having a national security committee, which means that they want to put this to the side, which means we do have a sense of de-escalation in the region at the moment, potentially a bow on this specific episode, which is the fact why we're seeing crude pull back, but doesn't mean that we could potentially not see skirmishes in the future, which is why maybe is almost a calm before a storm.
So earlier this morning, we had two basic questions, and the first one was whether Israel had demonstrated superior capability to Iran. A lot of people would conclude perhaps they have. The second question would be, should this reinforce Israeli deterrence to Iran? Do you think it has, based on what we've seen?
I think given the city they've struck, potentially they are getting to that point. And I think Iran potentially really had this barrage, 300 missiles and drones. 99% of them were struck down. Israel sent a few to one specific city. It was a clear message that the Israelis were trying to send to the Iranians.
Brent crude down by 0.6%. Let's check out the price action for you. Starting with equities on the S&P 500. Equities negative by 0.1%. 5-day losing streak on the S&P could well become 6, but we're doing some work to make sure that doesn't happen. Yields are lower by 4 basis points on a 10-year, 459.19. Yields pulling back from the year-to-date highs struck over the last week or so. And as you move on WTI, we're back in the low 80s, heading towards another weekly loss on crude, $82 and down by 0.9%. Coming up this hour, we'll catch up with U.S. Trade Representative Catherine Tai on Biden's 2024 trade agenda. Uni credits Eric Nielsen on global central bank divergence, and Geeta Gopinath of the IMF on what she calls the risk of an economic Cold War. We begin with our top story. Markets on edge. The S&P heading for its third straight week of losses, but TPW's Jay Pawlowski remaining bullish, saying this: we remain happy to trade rate cuts for earnings growth. We are impressed at how well the equity market has moved ahead, shifting gears from the AI tech-led Magnificent Seven to a much more cyclical and commodity-driven advance. Jay, I'm pleased to say, is with us for more. Jay, here in Washington, D.C., you've heard it. They're talking about the tepid 20s over at the IMF. Have you got a different view on things?
Yes, John, very much so. I mean, the IMF meetings, historically, it's like Davos. You want to fade the consensus. A year ago, the IMF meetings were ultra gloomy, 100% view of recession. And guess what? Over the last 12 months, global equities up 18%, bonds represented by the AG down 4%. So yeah, we'll fade the tepid 20s, and we're more in the roaring 20s camp. And we wrote about this recently in the shape of things to come. Our view is that the 2023 to 2027 period globally is going to be very much like the 1995 to 1999 period in the U.S., which was a period of above-trend growth, better productivity, low inflation, real wage gains, in a pretty good environment for risk assets. We think the difference this time is it's going to be global.
What tells you, Jay, that it's going to be global? What's guiding that assessment at the moment?
Yeah, John, I mean, you touched on it, and thank you for the reference to our tripolar world thesis, which is now almost 15 years old. And it's funny, I've been thinking about it a lot over the last couple weeks. And when we originally wrote up the thesis, it was the idea that each region, Europe, Asia, and the Americas, could self-finance, self-produce, and self-consume. And what we've seen, particularly over the last 5 years or so with COVID, is an acceleration of that process as supply chains regionalize, as the response to COVID, climate, and conflict drives spending. We've shifted from a monetary policy world to a fiscal-led policy world to a point now where AI and the climate and EV revolution is really, fast-forwarding this process. And you can just see it by the AI companies in China raising money internally. You can see it, the same thing happening in Europe. President Biden's push for the CHIPS Act, Infrastructure Act, Inflation Reduction Act. We are in a period where even tariffs, you and Lisa talked about tariffs. Tariffs are forcing companies to produce in each region. You're having the Chinese coming to the U.S., producing EVs in the U.S. to avoid the tariffs. You're having the same thing happen in Europe. And so what you're doing is you're driving a period of investment in each region that is very much pro-growth. And the trade-off is, yes, we're probably going to have slightly higher inflation. And yes, we're going to have higher interest rates. But to us, that's not that bad a problem as long as we get the earnings growth that we anticipate. And by the way, consensus calls for 3 years, 24, 25, and 26, to have double-digit earnings growth in the U.S. Add to that buybacks, and you have an environment where I do think the risk-reward for equities is pretty compelling.
So, Jay, you've offered us the framework, the way to think about the world. Let's talk about the vehicle to invest in. How would you approach this? What's the optimal way of expressing that in capital markets?
Yeah, again, John, thank you. It's right on point because I really am starting to think that investors really need to have a tripolar world kind of investment portfolio, meaning they need to be exposed to the growth opportunities that are manifesting in each region. And therefore, if you're U.S.-centric, you need to be looking elsewhere. And I'll give you a reference point. The IMF just put out its growth forecast for the next 5 years, and they noted that China is going to be responsible by itself, for about 25% of the global growth over the next 5 years. So you're telling me that as a global investor, you're not going to be invested in China, which represents 25% of the global growth over the next 5 years? You need to be invested there. And today is a wonderful opportunity to do so, given that Chinese assets are selling at massive discounts, particularly in things like the tech sector. So to us, one perfect example right now, very quickly, is you have a two tech stack divide in the world, a US-led one and a China-led one. China companies are going to dominate the China tech stack. It's multiples of the size of the US tech stack, selling at a 70% discount. We love that idea. Another idea is the AI revolution is going to require tons of energy. And therefore, we want to be exposed to both the semiconductor cycle and the commodity cycle. And then finally, to put a bow on all of this, is we want to be exposed to the emerging markets, which is a beneficiary historically of a global growth upswing. And again, it's been a tremendous laggard. So you are buying assets that are selling at 30 to 40-year lows versus the United States. And so those are just a handful of the opportunities that we see. We see lots of opportunities around the world, John.
Jay, you're in the same company as Ed Yardeni, who we spoke to yesterday. He had a 60% probability chance in the 1920s, 20% 1990s, but then there was another 20%, he said, that it could be the 1970s. How do you prepare a portfolio for downside risk if this was, say, the 1970s?
Yeah, no, Dr. Ed is, we're right in the same boat with him, and we think that's good company. We respect his
China's
work a lot.
Commerce Ministry
Look, I
says
don't
they
think it's
have
anything
issued
like the
measures to
70s. I'm
support
just thinking about
overseas
that when you were
institutions
talking
investing in
the Legion
domestic
about what's
science
going
and
on in the
tech
Middle
firms
East.
in China.
Right, to me, the Middle East is the least important it's been in 50 years, right? In the 70s, the problem was the oil shock and oil prices quadrupled. That's not going to happen today. And here's a couple of reasons why it's not going to happen. One, most importantly, the U.S. is now the biggest oil producer in the world. Second is there are 5 to 6 million barrels of production capacity today that is on the sidelines in Saudi and elsewhere as they try to push the price up. And third, and perhaps most importantly, you have the EV revolution gradually eating away at fossil fuel demand as we see manifesting itself on almost a daily basis. And so I see the risk of a 70s type world being very minimal. Having said that, we do love commodities. Our asset allocation is we're overweight equities, we're overweight commodities, we're massively underweight fixed income. We have zero U.S. Treasury exposure. We haven't had any exposure for years because we're in this view of a stronger global growth environment than many expect.
I'll give you a call when we get back to 5%. I'll try and sell you some. Jay, it's good to hear from you. Jay Pawlowski at TVW. Jay, thank you, sir. It's interesting to hear that, as the Middle East is probably the most unstable it's been in years, to hear someone say it's the least significant from a commodity perspective in decades.
It's pretty shocking. Also, you have to think of the fact that there's cables underneath the Red Sea that can really hurt telecommunications. So I don't really buy into the fact that the Middle East is insignificant. Saudi Arabia, though, can also add millions of barrels right now to this market. And that would drastically change where we are in the oil price. So maybe it's not as important in the 1970s, but it's still very important.
Crude right now down by 0.7%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Yields are lower, but the rally has faded throughout the morning with the ebb and flow of geopolitical risk. Mads Peterson of Human Edge Investment Technology told me earlier on Bloomberg Brief that now is one of the best opportunities in the past 10 years to buy bonds.
The U.S. Treasury at this level is starting to look extremely interesting. The whole curve looks good. It's probably the best time in a decade to use U.S. government bond as a long time as a class diversification.
You can watch Bloomberg Brief every morning at 5 a.m. Eastern. Paramount shares up 7.5% in the pre-market after a report that Sony and Apollo are considering a joint bid for the company. Paramount is in exclusive talks with Skydance, but the proposal has generated significant investor pushback, according to the New York Times. Tesla shares lower in the pre-market trade 1.33% and recalled almost 4,000 Cybertrucks to repair accelerator pedals that can dislodge, become trapped, and cause a vehicle to unintentionally accelerate. Tesla has told customers it will fix the pedals free of charge. That's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, Biden taking on China.
The Chinese government has poured state money into Chinese steel companies, pushing them to make so much steel as much as possible, subsidized by the Chinese government. They're not competing. They're cheating. They're cheating. And we've seen the damage here in America.
That conversation is coming up next, a special conversation with Catherine Tai, the U.S. Trade Representative. That's just around the corner. Live from Washington. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Live from Washington, counting you down to the opening bell, about 1 hour and 14 minutes away. Equity futures on the S&P 500 shaping up as follows, almost erasing the losses of this morning. We're basically unchanged on the S&P. Yield still a little bit lower, down 4 basis points on a 10-year, 458.78. Under surveillance this morning, Biden taking on China.
America's still working out compete as long as they have fair competition. But for too long, the Chinese government has poured state money into Chinese steel companies, pushing them to make so much steel as much as possible, subsidized by the Chinese government. They're not competing. They're cheating. They're cheating. And we've seen the damage here in America.
Here's the latest this morning. President Biden calling for higher tariffs on Chinese steel in a bid to shore up the U.S. steel sector. China slamming the potential restrictions, saying the U.S. is, quote, arbitrarily slapping tariffs on Chinese products. Ambassador Catherine Tai, U.S. Trade Representative, joins us now from New York. Ambassador, wonderful to have you with us on the program. We've done a role reversal. You're in New York and we're down in Washington. We'll make this work properly next time. Ambassador, this is a topic we've been talking about for a long, long time. Chinese overcapacity. We all know about the China shock. We all studied it. It obliterated manufacturing bases in places like the United States of America. Can I just give you a few minutes just to sort of lay the ground for us? What's changed and what's new about what's developing right now?
Well, I'd be delighted to. It's wonderful to be here with all of you. You're absolutely right about the China shock, and it's become an established set of facts as we look back on the last several decades of China's emergence as an economic powerhouse in the world. As you've seen the growth of the Chinese economy, what you've also seen is the negative impacts on other economies like that of the United States, and of course the industrial erosion that you've seen here. The manufacturing capacity loss isn't just limited to the United States. You see it in other advanced economies. You also see it in developing countries as well. But to your point, a lot of what we're seeing right now is not new. The China shock continues. We've seen it in the sectors steel and aluminum. We've seen it in solar panels. 20 years ago, the United States, several other countries had growing economies and industries around solar panels. The Chinese double down on their what we call non-market practices, their state investment in a strategic emerging sector. And what you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices. It's a kind of predatory pricing practice worldwide that has driven out producers in other economies, leaving the Chinese economy having cornered the market in production. Right now, we're still 85% reliant on Chinese production and supply in solar panels. We've also seen it in batteries. We're seeing it now in EVs, and critical minerals is another example. So what you see us doing with respect to steel is actually responding to a set of pressures that have been building over a couple decades. On the steel point in particular, I wanted to really enforce that what you heard President Biden talk about earlier this week was to call on me as the U.S. Trade Representative to consider increasing the existing tariffs on Chinese steel imports. But we know that the challenge with Chinese overcapacity and excess production is a world economy challenge. The scale of the Chinese economy and its ability to manufacture and produce will depress prices worldwide. It infects the global economy and global prices. And so what you've seen is, as well, the maintenance of the global steel tariffs and aluminum tariffs, but you also see us as the Biden administration evolving out of that particular framework. You see us in particular taking leadership role with the European Union. Over the last 2 years, we have been engaged in intensive negotiations for a new framework, a global sustainable steel and aluminum agreement that we are working on to address not just the excess capacity pressures, but also to try to create incentives for cleaner production and cleaner trade in steel and aluminum.
So, Ambassador, if I can jump in, if we can focus just on steel, because we've got so much to unpack there. Let's take steel. And we both know how complex this is, and I can share some numbers with our audience, certainly not for your benefit. Direct Chinese imports, as you know, the estimate is something like 0.6% of total steel demand in the United States. The problem is, a lot of this is going through Mexico. So, Ambassador, a question I heard someone ask recently is, how do we make them eat it? So how can you address what is happening in Mexico? How do we stop the steel coming through the back door?
So I'm going to unpack this back at you in a couple ways. One is to reinforce the point that when you have a producer, a major dominant producer,
so the S&P 500
like China,
has now turned positive, erased
below
declines from
market
earlier
rates.
this morning. So again, they're around flat on the session now.
The entire supply chain, starting upstream all the way downstream. The Mexico challenge is a piece of this. And again, the challenge is worldwide. So I think with respect to Mexico, there are a couple pieces. One is to the extent that upstream steel is coming into Mexico and being worked on and then coming into the United States, you've got to figure out how to level the playing field there. Secondly, there's a much more blunt challenge with respect to steel coming into Mexico and improperly coming into the United States as Mexican steel. So there's a challenge with respect to the evasion of trade programs and trade frameworks where steel that's not properly Mexican is coming in as Mexican steel and enjoying the preferences that we provide to the Mexican economy and Mexican producers. So again, with respect to steel production, in order for the United States to continue to be able to produce, to continue to grow our steel industry, to continue to grow cleaner steel industries. What you see is a number of programs that we are putting in place to ensure the integrity of trade systems. The challenge right now is, and steel is an excellent example, that there is no such thing as free trade in steel. The market in steel globally is significantly distorted by what we are calling the non-market policies and practices coming out of China. Supply that's being created, production plans that are not linked to demand. And so what happens is you have a significant depression of prices, and it requires economies like the United States to work with other economies that want to be open, that want to openly trade, to take more significant defensive measures against the unfair practices that have infected this sector.
Ambassador Tai, do you see the similar dynamics in what you're describing in steel happening right now with the EV market?
100%. It's the same pattern that we see repeated over and over in different sectors. And the challenge for us is this has not been our practice. Largely, we have really adhered to this notion that if you just keep taking down barriers, if you just keep trying to trade more, if you just keep chasing efficiency, that everything will work out great. The challenge is that in every one of these sectors, we see that Chinese practices allow for Beijing to capture larger and larger shares of the global market so that you end up with a dominant producer in this entire economy. And what happens is the rest of us become extremely vulnerable and reliant on that supply. What we are trying to do is to find opportunities for us to defend, to stand up so that we can restore more freedom to trade, more freedom to economy, more freedom for other economies to stand up to the coercion that results when you have these types of vulnerabilities that can be used to create political pressures on economies.
Well, the Biden administration made it very clear that tariffs on Chinese EVs, bigger tariffs, are coming down the pipeline. But Secretary Yellen also said the
US
U.S.
Trade
quote,
Representative
won't
Tai
take
says
anything
China's
off the
shock
table
threatens
when
US
it comes
steel
to this
and
overcapacity
aluminum prices.
coming out of China. We, though, have not seen one single WTO complaint from the United States. Is that potentially a tool that you can use?
I wonder if you get your TPs, so your talking points, from my Republican senator counterparts from my hearing earlier this week. Look, the World Trade Organization is an incredibly important, valuable institution in the world. As part of the post-World War II Bretton Woods framework, the World Trade Organization is critical to the functioning of a modern world economy. That said, we also are very clear in our commitment to the WTO lies our commitment to reforming the WTO. I know this conversation is actually not unique to the WTO. All of the Bretton Woods institutions, the IMF, the World Bank, this is their week. In all of the conversations today, what you hear in all of those conversations is the question of how do these institutions evolve to meet the challenges that we're facing today. With respect to the WTO, that is also true. And in terms of WTO dispute settlement, we, as the United States, are very, very proud of our record with respect to challenging Chinese practices at the WTO. What we have found over time, however, is that each one of those cases that we bring, each victory that we score, ends up being a quite limited victory. It ends up in quite limited change. What we are dealing with in terms of the challenge of the Chinese economic system is structural, it's systemic. And so that's why we are bringing more strategy, we are bringing more creativity to look for more effective ways to level the playing field, working with other like-minded economies, and also working to raise these concerns inside of the WTO.
Ambassador, it's funny you bring up Republicans and their talking points, because broad strokes wise, what we see is that whether or not we get another Biden administration or Trump back into the White House, trade policies look almost the same when it comes to China. Do you see a divergence in what we potentially could see from Trump or Biden, given the fact that we still have Trump-era tariffs right now under this administration?
So I think what I will say is this, that whether it's Republicans or Democrats, going back to the earlier comments around the China shock, we are together, and I think that this also applies outside of the United States as well. We are coming to a realization and raising in our consciousness a common assessment with respect to diagnosing what the problem is, what the source of today's world economic and trade challenges is. Then you have to move on to what are you going to do about it. And with respect to the Biden administration, we are very proud of our record. First of all, that tariffs are an important tool in the trade toolbox, and that it is important to use them effectively and strategically, and to know what the leverage is with respect to the tariffs. So yes, we continue to retain tariffs for strategic purposes. Second, the Biden administration hasn't rested on just trade or just tariffs to address the challenges that we face with respect to competing fairly with China. We have also, as you've seen, activated significant investments into the United States economy for the U.S. workers and for American infrastructure. It's the bipartisan infrastructure law, CHIPS and Science, the Inflation Reduction Act, the investments into the clean energy revolution. In addition to that, you also see that we have initiated an investigation into China's unfair non-market practices that have been alleged by 5 of our labor unions with respect to their maritime, logistics, and shipbuilding sectors. When you take these 3 segments together, what you have is the articulation of the Biden administration's China trade response.
Ambassador, I just want to ask you a question very quickly about Chinese EVs. Have you had a decision on that? Well, can we expect a conclusion anytime soon?
So I'm not quite sure. There's not a specific question before us. I think with respect to maritime logistics and shipbuilding, for instance, there is a petition that was presented to us. I think to your point, it's what are we going to do about this trend that we see repeating itself in the EV sector? Again, we have an entire set of tools before us. Many of them are with the U.S. Trade Representative, whether it's with respect to investigations that we can begin, whether it's looking at the set of tariffs that are enshrined in our tariff review, which has been ongoing for the last 18 months. With respect to that tariff review, I am confident that as a whole of government exercise that we have been undertaking with deliberation, seriousness, especially with respect to looking at more strategic, more effective deployment of the tariffs that we have to address the inequities in our trade relationship with China. I am confident that that conclusion will be coming soon.
Ambassador, can I just conclude with the following question? And it's probably difficult to answer directly, but the issues that you and I have discussed, that we've discussed over the last 10 minutes or so, as we started this conversation, they're not new. They've been at the forefront of many economists' minds for a long, long time. What strikes me as somewhat amusing is that it took someone like Donald Trump in 2016 to put them at the forefront of American politics, to shake the establishment, to almost make this consensus. And when I was listening to Secretary Yellen over the last few weeks, I just thought, this feels like a Secretary Yellen discovery tour, something personal to her, and nothing really new for policy. Ambassador, can I ask you, what took so long for the establishment in America to figure out this was the road they needed to go down?
Well, it's an excellent question because, you know, what I would do is I would actually have leaders in trade policy take ownership of the earliest calls for the need for attention to the challenges that we are all focused on now. These are issues that we have been raising at the WTO bilaterally with China very directly. For a very long time, we had direct dialogues with China where we would raise these issues over and over. We would raise them with our partners. I think part of what you see is the increasing pressure that is being placed on economic dynamics. One last point I wanted to make with respect to inflation. The inflation conversation gets attached to tariffs a lot. The more we are talking about inflation and examining our worldwide experience with this phenomenon over the last couple of years, the more we are realizing that the inflationary pressures are linked to the supply challenges that we have. Those supply challenges go to our vulnerabilities, over-concentration, the domination that we see by certain producers in the world economy. I think that is the next area where we need to drive coalescence around our analysis so that we can work together, whether it's Democrats and Republicans, whether it's the United States and other countries, on solutions.
Ambassador, looking forward to having this conversation in person next time. Enjoy New York. Thank you so much for your time over the last 10 minutes or so. The U.S. Trade Representative, Ambassador Catherine Tai there, on a whole range of trade issues. If you are just joining us, welcome to the program. We should probably kick it off with what's happening in the equity market. Equity futures on the S&P 500 just about turning positive moments ago. In the equity market on the NASDAQ, we're still negative by only 0.1%. The Russell just about unchanged on the small caps. If you switch up the board and turn to the bond market, we'll look at a 2-year, a 10-year, and a 30-year. The 2-year at the moment down 2 basis points, 496.43 on a 2-year maturity. On a 10-year, we're down 5 basis points to 457.96. Strikes overnight from Israel on Iran, according to reports. In the commodity market, though, no big move higher. We're down by 0.7% on Brent crude at 86.49. On WTI, we're down 0.6% at 82.21. Under surveillance this morning, our top stories: Israel launching a retaliatory strike on Iran following this weekend's missile and drone attack. Explosions were heard in Iran's third largest city. UN watchdogs saying nuclear facilities didn't sustain any damage. Elsewhere, Netflix reporting better than expected first quarter earnings. The streamer rebounding from a post-COVID slowdown. Netflix also saying it will stop reporting both paid quarterly membership and revenue per subscriber in the first quarter of 2025. That stock has been trading negative all morning and is down something like 5% at the moment. And finally, Apple bowing to Beijing's latest request, removing WhatsApp and Threads from its Chinese app store. In the United States, lawmakers trying to force China's ByteDance to sell TikTok. They're the latest protectionist measures by both countries. Economics. UniCredit's Eric Nielsen joined us now at the IMF World Bank spring meetings, where trade is very much at the top of the agenda. Eric, good morning to you.
Good morning.
It's good to see you. Let's talk about what's happening. And can you give us your impression of the tone of cooperation in Washington, D.C., with all of these protectionist spats ongoing?
It's terrible, right? I came to Washington thinking this is, we are on a slippery slope. It's getting worse. Maybe I was naive. But I've been stunned by how fast this thing is moving. And suddenly you hear senior people not longer talk about tariffs next year, but banning stuff, right? EVs, for example. So I'm starting to think, we are thinking as a Western analyst about where does the U.S. go, how does Europe follow, and these sort of things. I think we have to start to think about how will China react to what we do, because we will do things now. It's pretty dramatic things, I fear.
And this used to be an economics forum, and you said recently it's sounding more and more like a national security forum.
Yeah.
How big a change is that over the last few years?
It's big, right? Let's remember, national security has always sort of been the big thing, right? Ultimately, a country, this is the number one, right? But for 30, 40 years, we had an understanding and belief that globalization, economic openness, all these sort of things took care of it. Remember, Larry Summers once said, there's never been war between two countries like McDonald's, right? So the whole idea that if we sort of expand, we invest, it doesn't happen. That has changed now.
Russia happened.
Yeah. Well, Russia happened, right? So certainly within the last 2 years, the game has completely changed, right?
Do you think now we've moved on from a world where we're past peak free global trade?
Yeah, for sure. This is this I'm sure about. And what worries me more, if we always go in ways, what worries me more right now is we are in a vacuum, but we don't know what regime we have, right? We've had all these years, the IMF sort of set the tone of macro thinking. We have WTO. I think you're, with all respect, the ambassador, saying they always work through the WTO. Well, America was not, always cooperative in the WTO, let me put it this way. So I don't think it's fair to put blame just on one here, sure. But we can certainly observe that things are...
So where does this leave institutions like the IMF?
Where is it in the debate?
Where does this fragmentation leave them? Because it almost feels like they're steps behind what the countries are coming here discussing and concerned about.
Yeah, exactly. So this is economics and economic policy making has become secondary to national security. So the way I would put it, and a senior official said to me, a few years ago, when you met with the president in the sort of big strategy meetings, the first one who spoke was economic policy, and then sort of things for now it's national security. So my impression is that in the U.S., Jake Sullivan started by saying so and so, and then
everyone follows.
And then everyone follows. And when the economy says, well, this industrial policy and protectionism is not good, he said, we will do very little, but very high walls. But interconnectivity. Why is it that Tesla cars in China, which are made in China, are not allowed into any parking lot near a government building? Because EVs have become data collection centers, right?
Yep.
And I don't think we have fully got our head around this. And as it happens now, it's for us economists, it's problematic. Let me put it that way.
You've got to think about the economic outcomes. So, Eric, let's try and do that. This is clearly the direction of travel. Governments are known for their efficient allocation of resources. And I just wonder, what are the consequences of this massive industrial policy effort that's taking hold right now? What are they going to be? What does this look like 5 years down the road?
So, as you said, certainly less trade, home sourcing, friend sourcing.
Higher inflation, lower growth?
Yeah, so certainly lower growth and higher inflation. This is almost for sure. So less global growth. So it's not a surprise that the IMF has they have this 3.5% global growth, which is a lot less than it used to be, right? So I think we are, for the next 5 years, you're going to have lower growth. But it really, really depends on how the West reacts to this, and then, of course, how China and other countries react to us. So if we had an intelligent and coordinated for the Western world industrial policy idea to our thing, it's not all is lost, right? But the risk is that it sort of falls off, and the institutions are no longer playing a role in sort of getting people together.
Yeah. Eric, I was going to say enjoyed the last day in Washington, D.C., but it doesn't sound like you've enjoyed it at all.
No,
maybe just the weather. It's warm.
It is. I have been disappointed, right? I mean, it's problematic, it dominates the debate, and it should. But actually, I think it, as you sort of hinted at, it doesn't dominate the official debate as far as I know. I mean, so it's seminars we talk about now, and we talk about environmental things. It's all important stuff, but it's sort of, we kind of have to anchor it together and see what, if this is the first thing that we have to understand, that globalization and free trade is gone, then we have to rethink as economists, where do we then take it, and how do we sort of, and we're not very good as a profession, we're not very good at reprogramming ourselves. So I
have a feeling we'll be talking about exactly the same thing next spring when we meet each other again here in Washington. Eric, this was great. Thanks for having me. Eric Nielsen there of UniCredit. Up next on the programme, we'll catch up with the Santander chair, Anna Botín, and the IMF first Deputy Managing Director, Gita Gopinath. That's all coming up next on the programme.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about, how do I take everything that I know and I've learned and actually do the opposite? And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Live from the nation's capital, good morning to you and welcome to the programme. Let's start with the price action in the equity market on the S&P 500 going into the opening bell. We've recovered. We were deeply negative. We were down more than 1%. We're now just about unchanged on the S&P. The rally in the bond market continues. We're down 3 or 4 basis points on a 10-year, 459.60. Under surveillance this morning, the Fed and ECB divided.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal. We are clearly seeing signs of recovery now, beginning timid and picking up in the course of 24.
Here's the latest this morning. The ECB and Federal Reserve on diverging paths. The ECB looking to cut rates as soon as this summer. In the United States, Fed officials are warning cuts may not come at all this year. Anna Botín is looking to navigate these challenges and more as chair of Banco Santander and the IIF. Anna joins us in Washington this morning. Anna, good morning to you.
Good morning.
Thank you so much for being with us today. We had a guest with us about 5 minutes ago. It was pretty depressing. Very downbeat on cooperation in Washington, the future for growth outside of the United States. How downbeat are you and your team about the same things?
Well, you know, first of all, we are at war. We have 2 wars, which is a human tragedy, and our thoughts are with all the people that are suffering. But aside from those very important issues, which obviously we must deal with first, the economy does not look bad. So, you know, we have managed to bring down inflation. Remember, We were around 9-10%. We were around 3-4% in most countries. Really important. That's the one thing we cannot allow to get out of control. We have growth, yes, slower growth, but growth overall. And third, we have very high employment levels. If I think about Santander's Europe and America's footprint, every single one of our countries is at historically high levels of employment. So, this is not bad. If a year ago you had asked many people where are we going to be, anybody that said soft landing, you would say, oh, you're being too optimistic. We have a super soft landing so far. So far, so good.
The growth profile is certainly much better than we thought it would be, not just 12 months ago, but maybe even 3 months ago. Though we still have 2 wars, we also have increased protectionism. It's been a key feature of the meetings this week, as you well know. A backslide towards industrial policy in places like the United States. Can I ask you, as someone who leads a bank, does that make it more difficult to be an international bank against that backdrop?
The key thing we're all looking to, and this is not different from what everybody is saying, is that the most difficult and the key risks now are geopolitical. As I said, the macro looks much better, at least for now. So as we think about what is happening and what these geopolitics mean for supply chains, for our business, understanding that this is going to mean more structural inflation because, you're going to have higher cost. Understanding that you need to prioritize defense or national security, or in the case of companies, diversification, which again is a key asset, at least for us, and this is really very valuable. So these are the things you need to think about. How do I protect my business at a time when the world is increasingly volatile, where you're having a big shift in terms of we want secure supply chain. Yes, we want it to be affordable, good prices, but security is paramount. And of course, we also want to ensure that we can manage the green and the climate transition.
And that could potentially mean. Do you expect the ECB to then, what's been pretty much forecasted by everyone, go ahead of the Fed and have this rate cut in June?
So, what we're all thinking about is what is the terminal rate? Where does this end up? That is the key question. And our view, and as an institution, is that terminal rate is not going to be the same in Europe as in the US. It's probably be around, if you talk to most economists, 4% in the US, around 3% in Europe. What it means is that, let's say, rates will end up around those levels, around 3%, 4%. And that is really that is what allows us to plan. Again, that is not a bad thing for commercial banks, for the sector. Negative rates were unsustainable, risky for the system. Very high rates kill the economy. Low rates, maybe we are going to have too low growth. And that is the one thing we need to focus on. How do we manage an economy where terminal rates are a bit higher because all the structural factors, not just defense, demographics, decarbonization.
True.
So you have structural trends that are more inflationary than before, slow growth. What do we do about it?
So I know that you're in a quiet period, so you can't talk directly about the financials, but can you help me understand, how do you plan for things like net interest income when you're across so many different regions with so many different policies and so many different so-called terminal rates? How do you plan for that kind of thing? What does that look like?
Look, Santander is a global bank, but basically it's Europe and the Americas. And we have 166 million customers. First thing is diversification is key, not just for us, for anybody. And we have diversification by businesses, 5 global businesses, and by regions and countries. So that means that if something doesn't go well in one country, usually it gets compensated by another. And so what you try is to really have a context for risk appetite. Do we take more risk, less risk? We don't manage interest rates, right?
Yeah.
As I said, the context is really good for financial institutions, especially commercial banks like ours. Why? Because negative rates meant that with a big retail base, you cannot charge, but you were being charged by the central banks for 20% of our deposits, and we couldn't charge. So positive rates, low growth, high unemployment is not a bad scenario for commercial banks.
Some other banks have pulled back from the United States, international banks. I'm thinking specifically of HSBC, BNP Paribas are still there. They still have a presence. You've been leaning in a little bit more. Could you develop that for us this morning? What are you planning in the United States? How big is your presence going to be going forward from here?
We're very excited about the opportunities in the United States. We're very confident we'll reach the 15% return on tangible equity. And we're keeping it simple. play to our strengths. Where do we have global scale that helps us in this market? Make sure that we are leveraging our network. And so in the biggest business, which is the consumer, we have something none of the other foreign banks have or had, which is at scale auto business. We're number 5 in the US. We're number 1 in Europe. We bring our OEMs here. And second, we have scale to invest in our own technology. So we're going to deploy our own technology to launch a digital bank to make sure we can fund the auto business competitively. Simple.
Anna, this was brilliant. I know you've got a super busy morning, so we appreciate you carving out some time for us here at Bloomberg. Thank you so much.
Great to be here.
Anna Botín there, the Banco Santander chairman. Let's go over to the IMF headquarters where Lisa's standing by with a special guest. Lisa, we're going to throw it over to you.
Thank you so much, John. I am here at the IMF headquarters with Geeta Gopinath, the first deputy managing director for the IMF at a time of highly fraught geopolitical tensions, all this discussion about fragmentation. You wrote a paper that was fascinating about fragmentation, just how much of it is actually happening, the onshoring, nearshoring, reshoring, et cetera.
Yes. So, Lisa, if you look at the data and if you look at just a superficial number, which is the ratio of global trade to GDP. Now that number is holding up well. Everything looks fine. But if you look under the surface, you're absolutely seeing signs of fragmentation. And if you look at trade between a US-centric bloc versus a China-centric bloc, that trade has gone down by much more than trade within geopolitically aligned firms. That's also true for foreign direct investment. So we are seeing these shifts, but at the same time, we're also seeing the role of connector countries like Vietnam and Mexico that are coming in and channeling supply chains around the world. And all of this can raise the cost, ultimately, of goods for countries.
Which is really the key question here, which is how much structurally higher is inflation in this new era of fragmentation?
This is a main concern, and these are numbers that we have to determine. And now, we're still at an early stage, so we aren't looking at very dramatic movements over here. But if this process continues, it could lead to much more inflationary pressures.
Or do you have a rate in mind about, is it 3% or 4%? Is that the kind of rate we can imagine in this world?
Right now, based on the scale at which it's happening, I wouldn't say it will be that large. But again, the risk is if it heads in a much more worse direction.
It seems like this is the path of travel. Everyone's talking about fragmentation. Everyone's talking about protectionist policies. In an era where so many countries seem to be rejecting free trade, what's the IMF's role?
We have a really important role to play as a multilateral institution. You know, the world is moving away from a rules-based trading system. So what needs to happen is diplomacy and pragmatic approaches. And that's what we're trying to push for through this meeting, getting countries together to work at least on areas where they can agree on. Like on services trade, there's much more progress that's happening on services trade. We need to work together on debt issues, on climate issues. That will hopefully rebuild trust and slow the process of fragmentation.
We also see an increase in geopolitical tensions, and we saw this overnight with the attacks in Iran. There were some real questions around what the price of oil would do. It did nothing, but that's as people were talking about de-escalation. Ed Yardeni yesterday was talking about the possibility of an oil shock akin to the 1970s, with oil prices going to $100 a barrel, should this escalate. Do you foresee a similar type of thing happening?
This is a risk we worry about. If there is a serious escalation, which means a much more wider regional escalation than what we've seen so far, then yes, we could have a severe oil shock. But we're not there yet, and as you can see in terms of oil prices, it went up some, but it's come back down. We have supply excess capacity in Saudi Arabia. We have non-OPEC countries putting a lot more oil out on the market. So there are other sources of supply that can, buffer these shocks. But if there's a large-scale escalation in the Middle East, that is a problem.
Is that the line in the sand, $100 a barrel, and that would consist of the shock?
I think if going up $100 a barrel would be problematic, but even going from here to $100 a barrel would be difficult for countries to deal with, who are still fighting the last inflation fight, which is the
IMF's Gopinath says there are risks exist of a severe oil shock, but they're not there yet. So again, that's Gopinath saying risk exists of severe oil shock, but not there yet.
It's the fear of some sort of slugflation or just sort of a sluggish growth kind of picture because of the overhang? Is it higher rates and potentially a Liz Truss moment, which I've been talking about and get shot down all the time in the U.S., but is there something like that?
Gopinath adding that oil going up to $100 a barrel would be problematic.
Very large deficits for a country where demand is very strong and there is still the last mile in terms of bringing inflation down. So for all those reasons, the deficit, you can't have a deficit of 7% of GDP. It needs to be lower. And if you project out, it's going to stay at those high levels for a while. That has consequences, of course, for debt servicing in the U.S. But in a sense, the bigger problem is in terms of spillovers to the rest of the world. Because for the rest of the world, when you have so much of debt being issued by the U.S., that can crowd out the borrowing from other countries. Their cost of borrowing goes up and their debt servicing costs go up by much more. So, I wouldn't say the U.S. has a debt sustainability problem now, but at the same time, when the U.S. is borrowing that heavily, that causes rates to be that much higher. It has implications for the rest of the world and for, corporations and households in the U.S.
How much higher? I mean, could you see rates staying here between 525 and 550 for the rest of this year, for even into next year?
That would not be our baseline. We would expect to see rates coming down. So, right now it's for getting inflation back to target. So we expect that will come down. It's going to take a little longer, but we expect that to come down. The question is whether it comes back down to what we saw in the decade after the GFC. And there, right now, that doesn't seem to be the case.
One thing that you talk about is this era of fragmentation is going to lead to a higher inflationary regime. Do you think it's appropriate for central banks to have a higher inflation target long term as sort of their goal? Say not 2%, but 2.5%, or somewhere between 2 and 3%, just because it is a different reality now?
Yeah. So firstly, that is a conversation we should not be having now. We need to ensure that inflation comes back down to 2%. Monetary policy can pin down a level of inflation. Yes, if you're going to have a lot of volatility in that inflation statistic, that could create problems because we are in a much more shock-prone world. But again, that is a conversation for later.
For later, but it might be.
Yes.
Okay. Geeta Gopinath, I know, has to run. Otherwise, she will walk off the set because you have to get to a panel that you guys are hosting. That was wonderful to speak with you. Thank you so much, Geeta.
Thank you so much.
John, back to you.
Lisa, great work. Thank you so much. Lisa Bravitz there with the IMF First Deputy Managing Director, Geeta Gopinath. Part of that conversation about fiscal sustainability, just to recap some of those headlines for you. The United States doesn't have a debt sustainability problem as of now. As of now is probably where the emphasis is right there and where it should be. The US cannot have a 7% of GDP deficit. It must come down. It's part of the problem here in Washington, D.C., and we've been having this conversation for the last couple of days. America is running a very large deficit, and that's part of the reason why we're seeing this so-called US exceptionalism. And that US exceptionalism is coming with problems for the rest of the world. You don't just get the positive spillover from economic growth, you also get much higher interest rates, and with that, a much stronger dollar. And what you've heard over the last few days is complaint after complaint about what's developing in foreign exchange. And those complaints are coming from all over the place, including Malaysia, who have had to intervene, South Korea and Japan, who are stressing that they might do the very same. And South Korea and Japan, officials from both those countries, had a meeting earlier this week with the Treasury Secretary, Janet Yellen, and no doubt they were airing some of those concerns. Now, the big question for the IMF and the World Bank this week is whether that continues. How much longer will this go on for? The duration question is the one that's being asked in Washington, D.C., and none of us can give you an answer to it because, AMH, the longer this goes on, the more problems that accumulate, the more stress that will build, and ultimately, words won't be enough from Japan and South Korea.
Absolutely. And Jonathan, you didn't just hear that from Geeta. This was in their report. What I found interesting is they said, and don't expect this to be a quick remedy to what's going on in the fiscal policy in the United States, because also on the sidelines of the IMF, what everyone is talking about is the U.S. election. And the fact of the matter is, the United States is not going to spend less. And there's not going to be tax hikes in an election year. So getting their fiscal policy under wraps to be a more healthy outlook, that's not going to happen this year, and it's definitely not going to happen in 2025, what Adam Posen said.
Seen that the US are to expand its scope of items for Iran and Russia export curbs.
For the lineup on Monday morning, Dean Kernan of Macro Risk Advisors will join us. Al Salinios of RBC, JP Morgan's Bob Michael, and European Investment Bank President Nadia.
The effective Fed fund rate is unchanged at 5.33% for April 18th.
Thank you very much for being with us here at the IMF World World Bank spring meetings. This was Bloomberg Surveillance.
From Washington to New York, to our viewers worldwide, a very good morning. I'm Manus Cranny filling in for Jonathan Farrow. The equity markets are grappling with more hawkish Fed speak and de-escalation from Israel on Iran. Is that the context? We'll count you down to the open right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up in the show, markets on edge over escalating tensions in the Middle East. Fed officials continue to push their higher for longer rhetoric. The stocks flirt with their worst week since October. This as Netflix misses the mark. The bar was high. We begin with the big issue.
Comments from ECB's President Lagarde as they comment in an IMFC statement. Disinflation process in the euro area has continued.
Iranian attack on Israel, unprecedented in scope and scale. Scope because it was a direct attack on
Lagarde adds that if the inflation criteria is met, it would be appropriate to reduce the current level of monetary policy restrictions. At the same time, the Governing Council is not pre-committing to a particular path.
Committed to de-escalating, to trying to bring this tension to a close.
ECB's Lagarde adds that upside risks include geopolitics, wages and profits, adds that surveys point to a gradual recovery over the course of this year.
Talking about this from a market's perspective, Anne-Marie, talk me through the response from Israel to Iran. How well telegraphed was that? Were there warnings given? And the market seems to be reading this situation as a
ECB's Lagarde says the disinflation process is expected to continue.
That's exactly right. You know, we've been hearing from Goldman Sachs, and they were talking about the fact that there's between $5 to $10 priced in the price of oil, but you won't see it.
And ECB's Lagarde says risks to the inflation outlook are two-sided.
There was this retaliatory cycle, and right now what it does feel like is that this is contained. What you saw from Israel in terms of their retaliation on Iran, it went to a city called Isfahan, and this city is incredibly important because not only was it one of the areas where Iran fired off their missiles and drones to Israel last week and over the weekend, but this is a place where there's nuclear facilities. So Israel was sending a clear message. We can hit your nuclear facilities. We can stunt your nuclear capability. Do not test us. And that is why you see the market start to ratchet this back down. In Iran, they're even downplaying this, and you don't even see a National Security Council meeting over in Tehran because of this. So it does feel like this could be the end of this specific episode. But clearly, overall, what you hear in conversations at the IMF in Washington, D.C., is that geopolitical
ECB's Lagarde says growth prospects remain subpar by historical standards.
On the terminal now, that the United States is expanding the scope of their sanctions.
We have posted out the full statement from ECB's President Lagarde to the IMFC for anyone interested.
But enforcing them is a completely different issue.
It is, and this has been the greatest accusation of all in regards to the oil cap price that was coordinated. Was it ever really that effective? Antony Blinken says again, Israel makes its decisions, and we have a commitment to defending it. I just wondered to what extent, Anne-Marie, this was Netanyahu calibrating to take consideration of Lord Cameron, along with the U.S., saying, you know, think with your heads, not with your hearts, and to this call behind the scenes for recalibration from the United States of America. I like what RBC Halima Croft had to write, which is, this is about the metastasization of this. We are not done with this geopolitical issue by a long chalk.
Right. This is just potentially the end of one little chapter we had. I would note two things. I think Netanyahu needed to show deterrence, but also wanted to show a little bit of restraint to put a little bit of a close on this specific chapter, because you had the very hawkish national security advisor in the Israeli government come out and in one word tweet in Hebrew say, week. So he wanted to see more.
Yeah.
So potentially you're seeing some of that restraint. And of course, the second thing is that at the same time this is happening, you have the U.S. Congress about to send over more aid to Israel, and the Wall Street Journal this morning reporting that the Biden administration is weighing another $1 billion when it comes to weapons to Israel. So even though they told Netanyahu, do not take the win, do not retaliate, they still seem like they are completely backing Israel.
Okay, Anne-Marie, thank you very much. Great work, you and the team. Over the past couple of days in Washington, joining me now is Terry Wiseman, Macquarie Group. Terry, good to see you this morning. We're just listening to Anne-Marie. We're trying to understand the calibration of markets' response to these actions by Israel. Your very first take on this, you talk about the axis of war and peace. You talk about the inverted smile. A bona fide peace without a war of attrition and without the threat of a wider regional war in our Mid-East would be disinflationary. I put it to you, Terry, it's a bit early to make that call that that's where we are.
Yeah, look, the point of what I was trying to say a few days ago is that if you are a bondholder, and this is specifically a view that pertains to bonds, not to FX, not to the stock market, but if you're a bondholder, you generally want to see two things. You generally want to see disinflation, because that will keep bond yields low and prices high for bonds. Or, you know, in a manner of speaking, you want to see a global conflagration. You want to see total war. Why? Because that's going to cause a flight of into safety, out of risk assets, out of stocks, and the beneficiary of that is typically U.S. Treasury bonds, and then yields would fall and prices would rise. So those two extremes are generally good for bonds, and we saw a little bit of a flavor of that last night when you saw the first initial reports of the Israeli strike on Iran. While people didn't understand yet that this was a limited strike, but they thought it could lead to full-out war, bond prices did in fact rise, yields fell. But when we realized that this was a limited war, that this is still in the confines of a shadow war, when global conflict generally these days takes place on borders, like you see in the case of Ukraine and Russia, those limited wars are not good for bondholders. All it does is keep the tension and expectations and the price premiums and things like oil high. That is not good for a bondholder, because you don't get the disinflation that you'd want to see if you are holding bonds. At the same time, you don't get the massive flight to quality out of stocks and into bonds that you would see with a much graver conflagration, much graver situation geopolitically. My point is that when you're in the middle between total peace and total war, you don't want to be holding bonds.
No, and you talk about this, the most sort of ill-fated place to be is the uncertain middle. We look at oil. I mean, I look at the price action yesterday in oil, $4. I look at bonds down 14 basis points, and there is this immediate volte-face this morning when we understand the nuances of the strike. Here we are kissing $90 on oil, and yet oil in of itself is not dislocating the bond market. At what stage does the price of oil really begin to kick into the bond market?
Look, the relationship is not necessarily linear, but I don't believe that the rally in the price of oil and gasoline in the U.S. over the last few weeks has had nothing to do with the rise in bond yields and maybe the suffering that we've seen in the equity market. To some extent it has, even though traders tend to associate an increase in oil with the non-core component of CPI and the PCE price index. I like to think that ultimately, if you get even what we've seen in terms of the increase in oil prices, it will have an effect on inflation. Put it this way. Fuel prices do enter into the general cost of business for sure, so they do have to raise prices on other things. But more importantly, when workers sit down with their bosses to negotiate wages, they don't say, they don't look at core inflation. They look at the things they need to buy, which includes food, which includes gasoline. So if headline inflation goes up but core doesn't, I think it can still have an indirect effect on core inflation down the road simply by virtue of the fact that it increases wages, not just in the goods industry, but in the services industry, which are critical to core inflation. So I don't like this increase in the price of oil. I do think that it is ultimately something that the Fed could have to respond to. It's something that has been driving bond prices lower and yields higher. And it's as simple as that. Of course, if oil prices were to rise even further on an escalation or expansion of this war to the rest of the region or to include the superpowers, of course, that would be inflationary as well. But keep in mind, like I said before, it would not necessarily be bad for bonds because at that point you could see that flight to quality.
Terry, what do you make of the past 48 hours of the descent in regards to the strength of the dollar around the world? And some would say the tacit acceptance by Secretary Yellen to allow the Japanese and the South Koreans to intervene. We don't know what shape and what form, but there is growing global dissent with the strength of the dollar.
Right, and central banks around the world are addressing this in two separate ways, two clear and distinct but yet separate ways. One of them is the threat intervention. So we've seen that, for example, from Japan, from the BOJ. We've seen that from the BOK in Korea. We have seen outright intervention on the part of Malaysia. That's one way to address the problem. The other way to address the problem is not to talk about intervention and to talk about simply tightening monetary policy. Now, we've seen from a few of the emerging market central banks in the last few days. We've seen, for example, the rhetoric coming out of Brazil and Mexico from the officials at the IMF meetings talk in a more hawkish direction. Of course, some central banks might ultimately do both, right? Japan is a classic situation here where they could do both because they have a history of having intervened in the FX market. They did so in 2022 in the fourth quarter, for example. But they are also moving already in the direction of tighter monetary policies. In that case, you could easily conceive of the BOJ doing both to strengthen their hand. And it's one reason why I would not be a buyer of dollar yen, let's say, at 155 here. I think that's a good target, but the skew is downward, i.e. towards conceivably a lower dollar yen because of these threats.
Indeed. Well, you know, history shows that unilateral intervention in of itself is usually folly and money ill spent. But when you're looking at a tripartite agreement with the US driving the bus, it certainly can spook some of the dollar bulls on dollar yen. Terry, thank you very much. Stay with us. More to do. We're going to dig into some of the Fed speak. Joining me now ahead of the opening bell, it's Abigail Doolittle, side by side with the details. Abby, what have we got?
Well, Manus, right now we're looking at the possibility of a 6-down day in a row for the S&P 500. That would be the longest losing streak going back to October 2022. And one big weight is Netflix. Shares are down 6.9%. This after the massive first quarter beat, but it's not to last. The forecast for the current quarter relative to revenue, a bit tepid, disappointing. Plus, they will stop reporting subscriber numbers in 2025. Given the fact that the stock was up basically 90% over the last year into today, investors selling it off. Trading down in sympathy at least the last time I looked to some degree. Microsoft, this will be one of the next big companies, tech companies, to report next Thursday. Actually, you can see not much of a reaction. More of a reaction from streaming competitor Disney, down 1%. And then take a look at Paramount Global, a content creator competitor, soaring up 8.9%, having nothing to do with Netflix, having everything to do with the speculation that Apollo and Sony may submit a joint bid for the media giant. We will, of course, be talking more about that, Manus, that possibility at the Open.
Okay, Abby, thank you very much. We're counting down to the Open. We're 18 minutes away. Coming up, sounds like higher for longer.
I'm of the view that things are going to be slow enough this year that we won't be in a position to reduce our rates until toward the end of the year.
Well, Fed officials see little urgency for rate cuts. The conversation next on Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Inflation is high. It's too high, and we need to get it to our 2% target. The pathway to 2% is going to be slower than people expect, and it'll be bumpy. I'm of the view that things are going to be slow enough this year that we won't be in a position to reduce our rates until toward the end of the year.
Atlanta Fed President Raphael Bostic there signaling higher rates are here to stay. The hot U.S. economy drawing criticism from other countries around the world in Washington this week. German Finance Minister Christian Lindner saying earlier in the week, "I don't want to be impolite." But if we look at the economic development in the U.S., the inflation rate is higher again, and this forces the Fed to react. For more on the Fed and how it reacts, let's bring in Bloomberg's Liz McCormick. You know, Liz, there's a great saying, the road to hell is paved with good intentions, and the good intentions are we hope to be able to be cutting, but of course Bostic and Williams both fly the kite marginally of higher rates, but then dampen it down. Why fly that kite at all?
Well, I think, first of all, let's be fair to John Williams, who was asked that question, right? Manus, he was said, "What do you think you could see higher rates?" So he has to answer, and he said something like possible. So, but I think you're right. The fact that, you know, he nodded to it's a possibility, and like you just played the clip of Bostic saying, you know, maybe not cuts till the end of the year, and I think he might have even flicked to maybe next year. I think, in fact, Chairman Powell on Tuesday at the conference in D.C. that he spoke at, he kind of said not hikes, but kind of a stronger clarity on we could be higher for longer, kind of if inflation doesn't perform. So I think there's been a bit of a sea change and a nod to like, hey, we at the Fed are going to still, you know, make sure we do what we have to do. If inflation doesn't come down, we'll stay higher for longer, or if we have to, they'll hike.
I know. Well, look, I suppose I latched on to the Williams thing because it really did spook markets. I think when they inject optionality to a hike, suddenly we become myopically obsessed that door is open. But as you say, we need to be a little bit more controlled and contained. I love your article this morning. Everybody should go and read it because you get a nice little insight on the five-year forwards. Now, this is about the anchoring or the unanchoring of inflation expectations, and there are people out there that are concerned about the unanchoring or disanchoring of inflation expectations. Take me through the thesis.
Yeah, so the Fed has always, they've made clear that inflation expectations are important to them. They factor that into their thoughts when they're thinking about policy. And, you know, Chairman Powell has in the past nicely explained it. Like, the risk is that if inflation, it could go two-sided, but let's talk where we are now, that if people continue to think inflation's getting higher expectations, it could bleed into actual inflation. Now, right now, and they look at long run because there's a lot of noise in short run. So, yeah, in that article, I was talking to Benson Durham, who's at Piper Sandler, but he was at the Fed, and New York and the board, very good wonky options guy. But he looks at long run, 5-year forward inflation expectations, even kind of models them to splice out some other forces, say like liquidity premiums, and says, they're too high. They're not screaming, fire in a crowded theater right now, but they're too high. They're above the Fed's target, and the Fed will be, that he thinks is what could really, his words, get the Fed's goat if they start to really unanchor. So that's on the radar of people. Like, you have to keep those contained. Of course, actual inflation has been troublesome 3 months in a row, hot CPI. So we'll see.
And this geopolitics and oil really take another leg higher, Liz. It can manifestly change the narrative as well. Great column. Encourage everybody to go and read it this morning. Liz McCormick on the bond markets. My guest this morning are Morgan Stanley's Dan Kelly, Macquarie's Terry Wiseman. Terry will be with me in just a moment. Dan Scully is with me. That's the beauty of live TV. Dan, good to see you in the end. Here we are.
Good to see you.
So I've just looked at bonds for the month. They're up 40 basis points. The bond market has aggressively repriced to a higher for longer narrative. I would say stocks have got away with it so far. Do I de-risk? Do I still have an option to protect myself? How do you look at the bond repricing relative to equity?
Yeah, excellent question and good morning. And I think it's a function of what you do within your allocation, right? And on that particular note, just this week, our Global Investment Committee, led by Lisa Shallett, made a couple of allocation changes to our outlook in terms of adding to larger cap equities, reducing small caps, and actually reducing some of our fixed income exposure on the duration side. And importantly, adding to real assets, right? So again, it's a question of staying invested here, yes, but mixing up the allocations within your portfolio to adjust to what's obviously a very fluid environment.
And that's what you basically say, net, this pullback is a healthy correction of overbought conditions. And the valuations are discounting an unreasonable rate of expectations. I mean, we haven't seen a major drawdown. We've seen a skirmish in these equity markets. We're going to go into earnings season aplenty next week. Netflix has its own tortured set of narrative in the past 24 hours. Procter & Gamble are raising prices. The stock is injured this morning somewhat. What are you expecting from earnings report next week that can create a solid floor in the equity market?
It's such a great question because next week is where the real fireworks, I think, could happen. You have 40% of the S&P reporting next week, inclusive of all of those big tech names. The implied volatility and the implied one-day movement in S&P holding reactions on earnings this season is actually the highest it's been in over a decade. And so, look, our expectation is that many of the quality, scaled, strong free cash flow, still positive earnings revision type tech names can do fine.
Yeah.
We think, again, we are more cautious on some of the more lower quality, leveraged, smaller cap names. And so I guess the final thing I would say is, this particular, you alluded to it, a skirmish, a mini correction off the March 28th high has been notable in that all of the first quarter leaders in tech, communication services, energy, have actually been the most defensive since the sell-off, which is telling us this isn't a real growth scare. It's not a real economic, cautious sell-off, because if it were, you'd be seeing the dividend and the defensive sectors like utilities, like staples doing better. So again, this is a pause that refreshes in our view.
Just very briefly, you also make it very clear. I mean, the SOX index is down, I think in the cash down 5.34 on the week. But you talk about a differentiation between owning bigger energy versus the semis and the industrial data present, the energy and the semiconductors that feed the data centers. You want to be longer a big energy relative to the semis.
For the moment, yes, but let's not deny the fact that some of the semis still have tremendous secular tailwinds. I think this is obviously a market that had gotten, over its skis in terms of cut expectations. Now that is adjusting. So some of those growthier assets and stocks are resetting. but longer term, we still like many of those exposures. And so, yes, it is a question about the long term versus the short term. I also want to just caveat, right, that when we think about a better economy, the inflationary environment, and you want to own some value, you want to own quality value, right? You want to own those names that still have good balance sheets and that in some cases are utilizing technology and actually in some instances utilizing AI themselves.
Dan, we got to cut it off there. Unfortunately, the clock has ticked against us. We count down to that earnings report sheet next week. Dan Skelly of Morgan Stanley on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Let's get to your morning calls. First up, Canaccord downgrades Netflix to a hold, expecting a period of slower growth. Wolf Research upgrades Bank of America to outperform, seeing notable upside ahead. And Morgan Stanley upgrades Shopify to overweight, growing increasingly confident on its growth.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors.
Noting Germany's 2-year bond yield is up 3.8 basis points now. The Germany 10-year bond, that's currently up around 1.4 basis points as well.
To bring in different kinds of institutional money going forward.
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Equities are nervous as we go to the close of the week. The dominant theme is Fed speak, which is hawkish from Williams and Bostic in a relative sense to the geopolitical
So looking out to the market on open imbalance, 250 million to the buy side.
Do you trust that? These are your markets. We're set for a dip as we start trading this Friday morning. The rest of your asset classes look a little bit like this. The dollar has had a heck of a run this week, both from a geopolitical aspect, but of course then this drop in yield that you've seen on the de-escalation risk in the Israel-Iran situation lets the dollar drift and the euro bid. 10 years down by 3 basis points. We dropped by 14 basis points yesterday. You saw this haven status of the bond market. We're at 4.6%. When will we possibly touch 5%? Does real money come in at these levels? Crude comes back to flat. We did spike higher yesterday on this retaliatory action from Israel to Iran. Right now, it is being assessed as a non-escalatory confrontation. Do you trust that narrative? There's one stock to watch, Netflix. The shares are moving sharply lower with the downbeat revenue forecast. Ed Ludlow is with me. I mean, the subscriber numbers were blowout, Ed, but it is about the guidance, and that's where the questions arise.
Yeah,
market scale back bets on 2024 ECB rate cuts to 70 basis points now.
Biggest drop since July and trading at its lowest level since February of 2024. It was a strong quarter, right? They added 9.33 million net new subscribers or customers in the quarter, which was almost double what the street had estimated. And revenue growth or top line growth of 15% was slightly above expectations. The guidance is that in the current period, that subscriber growth will slow, even though top line growth of 16% would be a sequential quarter-on-quarter acceleration, but still below expectations, disappointing. It's a really interesting case study in corporate communication. We know what Netflix is and what it does, and they're saying that from 2025, we will stop reporting this quarterly subscriber gain or loss figure. And it is a figure that for all streaming platforms, investors have obsessed over. You know, there is probably more philosophical debate to have about the value of it. Netflix management want the street to be focused on, you know, bog standard traditional financial metrics like the bottom line, how exciting. But if you consider the quarter just gone, 9.33 million new customers, the story behind that was that the password clampdown worked. In other words, users that had been password sharing or sharing accounts with family and friends had to sign up for their own account for the first time. And so contemporaneously, we had an understanding of what was happening. We know the content slate is strong. So if they're going to stop giving us this metric, there is some hangover and anxiety from the street about that. And what management said is, we will give you milestones when we hit big numbers along the way, but they're not buying it. The stock down more than 7%, biggest drop since July of last year. Happy Friday, Manus.
I hope you're not sharing your password, Ed Ludlow. That's all I'll say to you. Ed Ludlow there on the Netflix story. Let's stick with streaming. Shares of Paramount, they're surging as Apollo and Sony are said to be considering a joint offer for the media company. Here with a little bit more detail, it is Abigail Doolittle.
And that report, man, is coming as a bit of a relief because this stock down a lot over the last year. In fact, just this year alone down 25%. There is a significant bearish short interest, so some of today could be a short squeeze. But yesterday there was a report of exactly what you said, that Apollo is continuing a joint bid for Paramount.
The IMF sees OPEC Plus starting to lift oil output gradually from July.
Sony together. It could, if it were to happen, would likely assuage some of the financing concerns that Paramount management may have had with Apollo's prior $26 billion bid, given Sony's deep pockets. Basically makes Apollo more attractive when they come together with Sony. Now, there is, of course, the Skydance bid out there, but a lot of people thinking that that one might not go through or it wasn't necessarily well received. What is well received, especially given the fact that the stock is down so much, CDS on Paramount Global, senior CDS, have tightened 34 bips on this report, Manus, the most in 5 months, suggesting maybe there's some hope that this deal, again, right now it's just a report, speculation, but that maybe it will come to fruition and be successful.
Yeah, well, we have this changing media landscape. Abby, thank you very much. Abigail Doolittle on the stock moves. Let's turn to EVs. Never far from our heart is Tesla, pairing the earlier declines. This was following a recall of nearly 3,900. The Cybertruck, faulty pedals. Alex Semenova is with me. They just don't need this level of bad news on the Cybertruck, do they?
Indeed, Manus, good morning. The troubles do just seem to keep piling up for Tesla. The EV maker received complaints from 2 customers related to this pedal malfunction. This is according to a recall report submitted to the U.S. National Highway Safety Administration. They say that when high force is applied to the Cybertruck's accelerator, the pedal may dislodge and get stuck, increasing the risk of a crash. Sounds quite dangerous there. That's resulted in the recall of nearly 4,000 vehicles. And of course, it's been a really challenging year for Tesla. Shares are moving higher after heavy selling this morning, but it's down about 40% this year. And earlier this month, the owner of a Cybertruck recorded a viral TikTok video where he described the accelerator pedal getting loose while he was driving, and he was stuck in full throttle. As of April 15th, Tesla said that it was not aware of any collisions, crashes, or deaths related to this. CEO Elon Musk on X said that they were just being extra cautious here. Manus.
Okay, well, it's a big week for Tesla next week, isn't it, in terms of the future on the Model 2 and other details. Alex, thank you very much. Alex Semenova. Turn over to the earnings season. American Express gains. This as revenue tops the estimates. Simone Foxman is with me, so we're spending on Amex.
Yeah, and especially consumers continue to flock towards Amex's premium cards. Fees from premium cards, cards with a fee accounted for 70% of new account acquisitions, a lot of those coming from Gen Z and millennials. Apparently markets like this, although this stock opened flat at the open. If you look through the financials that came out this morning, broadly, slightly better than expectations. We had revenue up 11% year on year. That was a slightly higher. Expenses slightly lower. And the firm set aside $1.3 billion for delinquencies. That's a tick higher year on year basis, but really in line with what the street had expected. And that allowed earnings per share to come in at $3.33, better than the estimate of $2.96, the company maintaining top and bottom line guidance. Amex says its high-end consumer that it really caters to is very strong, and it continues to remain strong. The CFO saying we're not seeing any softness at all in terms of demand for premium cards, reporting a 9% growth in spending, especially on airlines, especially in first class and business class. William Blair calls this a strong start to 2024, but they say that they're really waiting on an investor day that will be April 30th, Manus.
I still travel coach. Simone, thank you very much. Simone Foxman there with the very latest on American Express. Now, global markets are struggling to recalibrate and balance between the hawkish Fed speak from Williams and Bostic, as well as the Israeli retaliation against Iran. S&P 500 now tracking its biggest weekly decline since October. Joining me now with the view on the market, it is David Bianco, of CIO over at DWS. David, good to have you with us. So here we are. There's a number of different big themes at play. Do I just have to be strong, accept a higher for longer narrative and a higher inflation environment, and begin to adjust accordingly?
Well, that's right. I think they're not so much new issues, just we're getting a little bit more clarity on these issues, and things aren't working out quite as the biggest optimist or biggest bulls had expected. I think what we're seeing this week, I think it's setting the tone for the summer, and I think it will be a soft summer for markets. I think the S&P 500 is going to work its way below 5,000, kind of settle in a 4,700 to 5,000 trading range up until the election. And the reasons at this stage, it's becoming pretty obvious. The Fed's going to have to wait longer before they begin cutting, and we'll even find out how much they eventually cut. And the geopolitical situation we know is still running hot. And the valuation at the S&P 500, particularly against these interest rates and just a 20.5 PE multiple on this year's earnings estimates, this is still an expensive PE, and that's why next week, where about 40% of earnings are reported, the beats need to be big. The beats really need to be over 5% on average for us to have any, continued confidence that the $243 that we and the street are estimating are really achieved, because those estimates for the year are back-end loaded with a lot of growth coming in the third and especially fourth quarter of this year.
Where is the biggest susceptibility to disappointment on what you need to create the floor? We're at the money now at the moment. We're at the money at 5,000. So next week could be pivotal to open up the trapdoor to 47.50. So where's the susceptibility in this reporting season?
Well, there are two key parts of the S&P 500, and each of those parts has their own susceptibilities. The 492 S&P 500 index stocks that are not the grade 8 digital type names, they're susceptible to a further increase in interest rates, and I would argue their PEs at about 18.5 on average are very high versus a 4.6% 10-year Treasury yield or 2.2% 10-year TIPS yield. So the 492 is at risk to these and higher interest rates. And when we look at the earnings that are coming from those companies, particularly ex-financials, there are some green shoots of improved earnings growth. But if those companies don't beat by at least 5%, then there'll be flat earnings growth year on year again for the S&P 492. So, I mean, there are pockets of strength, industrials, there are pockets of weakness, energy and others, but this is really sluggish earnings growth outside of the grade 8, and at these interest rates, that's a concern.
I always feel like
the other part of the market. The other part of the market's the grade 8, and they have to just deliver tremendous earnings growth and very optimistic outlooks and continue to disclose all the data they can on their operations to keep investors confident and very exuberant about the long-term view.
And keep them on side. I always read the fund manager survey from Bank of America, and I always feel like I'm the poor retail victim left at the back of the bus, that forgot to get off at the right stop. Big money, institutional money, smart money, as I've written down here, $21 billion flowed out in the last 2 weeks, the biggest outflow since 2022. And yet the fund manager survey is the most bullish since January 2022. What do you see in terms of flow? Are the retail like me left on this bus at the moment, vulnerable to a material drawdown when institutional flow is taking money out?
Well, I think when you look at different investor types, big money, institutional money has an asset allocation type mindset. And big money is definitely noticing the attractive risk-adjusted opportunity being provided by bonds right now.
Yeah.
Short duration, but also inflation-protected longer bonds. And that just cannot be denied by those who have to make and do make decisions across asset classes. I think they're going to use these short-term interest rates to see how things play out and take a little and further risk off the table. I would argue that retail investors, where we have seen signs of their risk appetite cooling a bit, they are still confident in the AI story. But I think those type of investors also need to be a little bit more appreciative of valuations, and that not every company is going to be a winner in the end, and competition will heat up in that space, particularly semiconductors.
Yeah, well, I mean, I had the Norwegian Sovereign Wealth Fund with myself and Danny just the other day, and they are cautious about the valuations in tech, and not so much that monetization can't happen, it's just how quickly it can happen in the AI space and the timeline to that margin. You talk about financials, we talk about this higher for longer narrative, you talk about the valuations not exactly being stretched. We've just gone through the reporting with JP Morgan, with Wells Fargo, with Goldman Sachs, etc. Differentiate for me now on financials in terms of whether you want to be in regionals, whether you believe the CRE is past, or whether you want to be on the big beasts.
So let me start by saying we are a little cautious on markets going into the summer before the election, and financials are clearly higher beta stocks. But those who are more optimistic and those who are looking to, make plans for where to act upon a dip, we would point out big financials, big banks, big insurance, big asset managers, big brokers, big exchanges. And the results that are coming out of these companies are good, and capital markets activity is good and has potential to further accelerate. But I think big is the key theme when it comes to financials. These big institutions have the deposit base, they've got the confidence of those who buy their securities, and they are the ones in the position to continue to invest in technology, AI productivity. I'm really afraid that smaller banks and smaller financials in general are going to fall behind, be left behind. We know the challenges at regional banks. I don't want to overly beat up on them because those valuations are beaten up. But I would stick with the big banks. I would stick with the big financials.
Big is beautiful.
And for those who've been arguing, yeah,
big is beautiful. David, we got to leave it there. We got to leave it there. You're right.
All right.
Hunker down for 16.
See you next Friday.
See you next Friday. $16 trillion worth of reporting on the markets next week. David Bianco there of DWS, my guest on the markets. Coming up, Netflix stopping subscriber numbers.
We're just perplexed. Why wouldn't you give subscriber numbers? They're just a little less confident. And don't want to surprise on the downside. The analysts are saying maybe this is a more mature company.
We'll continue the conversation on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
just perplexed. Why wouldn't you give subscriber numbers? They're just a little less confident. And don't want to surprise on the downside. The analysts are saying maybe this is a more mature company.
Let's set the stage. Netflix posts its best start to the year since 2020. 9.33 million subscribers. But the celebration was short-lived. The streamer announcing it will stop reporting quarterly subscriber numbers. How injurious is that? Geeta Raghunathan joins me now from Bloomberg Intelligence. Do you think that's really the reason why the market is so irked? They still say that they will give us milestones, Geeta. They had a pretty strong subscriber growth, double what the original estimates were just a few weeks ago. Is that the flesh wound we're suffering this morning from this scare to guidance?
Yeah, it most certainly is, Manus. I mean, that was a very, very high quality first quarter earnings report. There's no doubt about it. They outperformed on all the metrics that we were looking at. Guidance also came in pretty much in line, but I think this whole point of them going to stop their subscriber as well as their ARPU disclosures starting in the first quarter of 2025 has really kind of spooked investors. What it really tells us is that, maybe the company is entering this more mature phase and maybe, subscriber growth is going to peak this year and it is going to start to decelerate. And obviously they want to reduce the volatility around that reporting of subscriber metrics.
I'm looking at your most recent note. It's a no house of cards, to quote you, not me. 27 times forward earnings. Where does that rank relative to other streamers? And is that the disconcerting part of this narrative, which is if I look at Netflix on a relative basis to its other peers in this space, the numbers are not strong enough?
Yeah, so that is the question, right? Should Netflix be valued like a media company or should it be valued like a tech company? So if you kind of looked at where Netflix was trading before yesterday's earnings report, about 27 times forward EBITDA, that's double of where its closest peer on the media side, Disney, is trading, right? Disney is at about 13 times forward EBITDA. Again, you could, but then again, you compare it to some of the other, the TV media peers like a Warner Brothers or a Paramount or a Fox, it's almost 4 times, that EBITDA multiple. So obviously there's this huge delta. I would say Netflix justifies that multiple. And I would say that just based on their profitability metrics, Manus, because you kind of look at what they've been able to achieve. Obviously, they have that first mover advantage in streaming, but then you look at some of their operating income metrics, $7.5 billion in profits last year, close to almost $9 billion is what we're expecting this year. Free cash flow has been on a tear. And then you look at their margins, right? And this has been the perennial question in media. Can Netflix ever replicate the old media model where you had these TV companies throwing off about 35% margins, and Netflix shows that they're already hitting 25% this year. They probably are going to get to 30% in the next couple of years' time, and maybe even more than that. Maybe we're going to see them get to like 35-40%. There's a lot of operating leverage in the model when you have scale, and Netflix is showing us how it's done.
Okay, well, it's certainly a juggernaut, isn't it, in terms of valuation, and you lay the landscape very clearly in terms of the acceleration of margin expansion rather than headwind. Geeta, thank you so much, Geeta Raghunathan there of Bloomberg Intelligence on your Netflix movers. Let's get to Abigail Doolittle. She's got the other sector price action to wrap up the week.
Well, we are looking at something that we have not seen since October of 2022, right now at least. The possibility of 6 down days for the S&P 500 in a row. Not surprisingly, communication services, which Netflix is a part of, the worst sector on the day, down 1.3%, taking the other 2 mega cap tech sectors with it. To the upside, energy, but up just 0.8%, unable at this point at least to outweigh some of that point drag from mega cap tech and Netflix in particular. As for the week, as you've been mentioning all morning, Manus, we are looking at the worst week potentially since October of last year. Most sectors are lowered. The worst sectors are in part some of those mega cap tech sectors, including the tech index down 4.9%, having a lot to do with some of that chip weakness. Real estate also lower, down 3.7%, having to do with yields being higher. The dividends look less positive. Of course, rising yields not positive for the real estate sector. Then there's discretionary. Tesla a weight there. Energy, despite today's gain, well, it's down 1.5%. A little bit of a rough week here for stock investors.
Yep, it's certainly been one of the toughest weeks for quite a while. Abby, thank you very much. We're struggling with higher rates, volatility on the geopolitical front. Coming up, we'll give you the market moving events to close off your week and set your trading diary on Bloomberg.
is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity markets really are struggling with geopolitics and Fed speak. Netflix, are you sharing your password? That's not what's dragging Netflix lower this morning, but it is having weight on the NASDAQ. What's dragging it lower is about valuations. It's had a cracking run. They're not going to disclose subscriber growth. Keep an eye on NVIDIA. Look, it's a bellwether for, I suppose, confidence. It's also taken a bit of a hit this morning. We're going to wrap up the week for you. Stocks are really trying to steady themselves for now. This is what you need to know for your trading diary for next week. Fed President Austin Goolsbee speaking at 10:30 a.m. Eastern. And moving to next week, Tesla results are out. More from IBM, Meta, Boeing report on Wednesday, Alphabet, Microsoft on Thursday, and UMich on Friday.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
we are 30 minutes into the U.S. trading day on this Friday, April 19th. Here are the top stories we're following. A mixed bag for media. Netflix plunges despite a strong start to the year after delivering a tepid forecast. Meanwhile, you have Paramount shares soaring amid reports that Apollo and Sony are considering a joint bid. We'll break it down.
The IMF says monetary policy in advanced Europe needs to match unfolding conditions and easing neither too fast nor too slow.
DXY, quote, might be too good to be true.
And says central banks in the rest of Europe will need to maintain tight policy for longer to fully rein in inflation.
What happens to ETFs after they die? Bloomberg intelligence data reveals that many ETF strategies actually perform better after the funds liquidate. We'll discuss in our ETF Friday segment. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. Take a look at markets on this Friday. It's pretty quiet if you're taking a look at the S&P 500, currently unchanged right now. Of course, we'll see if that holds. A much different story, of course, if you're looking at big tech. The NASDAQ 100 currently off to the tune about 0.5% or so on the last trading day of this week. And I threw out Bitcoin on there just to have something that had a real clear direction here. Bitcoin moving higher right now, currently higher by about 2% at the moment. We are getting closer to $65,000 a coin, but still below where we were about a month or two ago. Meanwhile, let's turn back to the earnings season. Let's turn back to Netflix, reporting better than expected first quarter earnings last night. However, the stock really taking a hit after the streamer said it will stop reporting both paid quarterly membership and revenue per subscriber in the first quarter of 2025. Geetha Ranganathan of Bloomberg Intelligence joins us now with the details. And clearly, Wall Street is taking that as a bad sign. How did you read that they're going to stop forecasting here?
Yeah, I think it definitely, Katie, it signals that the company is likely transitioning into this more mature phase. But it is going to, it obviously rankled investors. It is going to take a while to digest this. Remember, subscriber growth has always been the core of Netflix, right? They've always been judged by their subscriber success. And the market likes transparency. They like all these different details. And so kind of hiding that number from them is obviously going to make it very difficult for investors to map out the future growth, and it definitely adds to some level of uncertainty.
Yeah, and you're definitely seeing that reflected in the shares, of course. Even though the first quarter, the start of the year, was pretty strong, but also in the media world, let's talk about what's going on with Paramount right now. Shares currently higher to the tune of about 10% or so. Of course, the news right now reports out that Apollo and Sony are considering a joint bid here. It just feels like this story gets more and more interesting.
Yeah, I mean, this M&A saga with Paramount, Katie, has been dragging on for months right now. As you may remember, Paramount is actually in this exclusive negotiating period with Skydance that expires in the first week of May. But there has been so much of backlash with that whole Skydance offer. I mean, the common shareholders have really kind of rejected that proposal because there's so much of fear of dilution. The Sony offer, if they do make one along with Apollo, will probably be the most credible offer to date for Paramount. And I think in many ways it will kind of spark this bidding war. It's definitely very good for the company. It's very good for all shareholders. And obviously they're hoping that management will engage very actively.
Yeah, and taking a look at that long-term chart here, down 47% over the past year. Clearly, Paramount needs that shot in the arm. Geetha Ranganathan of Bloomberg Intelligence, thank you so much. And let's broaden out and take a broader look at these markets right now with Tim Chubb. He is CIO over at Gerard. He joins us now, and I'm looking at the S&P 500. We are poised to close lower for a third straight week in a row. Clearly, we've hit some sort of air pocket. Do you think that this is just needed a healthy sort of reset here, or do you think that this is the start of maybe a more sustainable downtrend?
Yeah, well, thanks for having me, Katie. I think ultimately, as we had this unbelievable momentum and liquidity-driven rise coming off those October lows, that we had just simply gone too far too fast and really had seen all this multiple expansion estimates get pushed out further into, the streets 2-year forecast. And so just a complete decoupling, for earnings revisions, from economic surprises, obviously from rate cut expectations from the Fed and real rates. And as yields have moved higher, there was quite a bit of complacency in the market. And so, with all that said, earlier this week when Taiwan Semi had reported, everybody seemingly was quite upset and looking around for kind of what was going on. But it's been up 50% in the last 6 months, and so I think in a lot of ways it's okay for a good stock like that, and some of these really high quality companies that really led the rally since the October lows, that when expectations are too high.
So maybe the leader's taking a little bit of a break here. When you think about the rest of the market, some of the laggards from a sector perspective, I mean, do they have the fundamentals to take the baton?
Yeah, I think certain sectors certainly do. Pricing pressures because of the inventory cycle that we've been going through are going to be very different
So
from
in
sector
10
to
minutes time
sector.
now at
One of the
10:15
areas that
a.m.
we've
Eastern
really
Time,
been
Bank of
favoring has been
England's
healthcare.
Ramsden
It's our
and
largest
Breeden both speak
overweight.
as a panelists
You
at
have
the
a pretty
Peterson
interesting setup
Institute
where we're
for
starting to see some
International
green
Economics
shoots, especially in the
on
R&D
monetary
front,
policy
and with
responses
so
to the
many patents
post-pandemic
expiring
inflation,
for some of the large mega
titled What
cap
Happened and
pharma and
Lessons
biotech
Learned.
companies.
There
In
is
the
a
next
text
10
release
years,
expected.
there's a huge rush to fill up that pipeline. Lots of M&A activity that's taking place as a result of that. And ultimately, it's defensive sector. And I think, in this environment, it really is important, obviously, to be selective and looking, very closely with where and how durable growth may be moving forward. But on the other hand, the defensive characteristics that the healthcare sector provides, even some of the cyclicals or quote unquote cyclicals within the sector, I think are still reasonably valued at this point.
And healthcare is an interesting one because it feels like, especially over the last couple of years, it really hasn't been able to get up off the ground. Even this year, so far, only up about 2% or so, really still continuing to lag. But when I talk to people about healthcare, one of the things that they bring up as a potential catalyst is maybe there's some consolidation in the space. There's a lot of potential M&A targets there. Are you thinking about that too when it comes to that sector?
Yeah, I mean, the entire R&D landscape has really changed within the last 15 years. And so, 15 years ago, 2/3 of research and development was really driven by the Pfizers and Mercks and J&Js of the world. And now it's really the inverse of that. And so it's, $100 million biotech companies and lower as far as, sales are concerned, that are really driving the R&D cycle. And so there's been a shift to outsource. These companies are more cash strapped. They're going to be certainly impacted quite a bit, as we've seen rates move up so significantly in the last 18 months. And so as all that financing has dried up and venture, and we've seen really muted M&A activity over this period, and a lot of inventory that needed to be worked down. It really was a bit of a reset. And so another element has been China, and they're obviously, for a lot of the tools and diagnostics company, a huge buyer, and so that's been another contributing factor. But we've gotten some better economic data out of China. We've had in the first quarter, from an R&D standpoint, from a deal flow standpoint, it's been the best in quite some time. And so I think a lot of those enablers, sort of the NVIDIAs of the world, for technology and artificial intelligence, the enablers of the R&D process are really where we're most focused in positioning right now, because I think that's going to be a durable growth story for the next decade with some of those exciting new therapies about to come.
So some potential bright spots there, of course, for healthcare. And when I talk to people who are bullish on healthcare, it's interesting. They tend to mention energy in the same breath. Healthcare and energy, that's where you want to be if you're trying to play that catch-up trade. How are you feeling about the energy sector at this juncture, though?
Yeah, energy is so tough. Ultimately, obviously, it's so impacted by geopolitical conflict right now, and so our view is have a beta towards energy exposure within the benchmark of at least 1, and we'll move that around based upon where we think things are fundamentally. But ultimately, this really hasn't been a demand-driven rally that we've seen recently. It's been more of a supply issue, and so we just prefer to take on more cyclical exposure elsewhere in the portfolio. Pool Corporation's been a favorite of ours, but even looking within financials, and S&P Global, that had a really nice quarter. Organic revenues grew by about 11%, and their guidance was a little light. And I think we're seeing that a lot with some of these higher quality companies, especially after everything that we went through last year, and really the pessimism that permeated throughout the year, and management teams as they've updated us on earnings calls. But ultimately, we've really seen sort of risk appetite come back into the market, and after we had that, post GFC sort of decade-long famine of low rates, many investors are sort of clamoring to make sure that they're locking in these higher yields at these elevated levels. And so, ultimately, I think that's going to present some upside for S&P Global and their certainly their pricing and capital formation services businesses. But there's, I guess my point is, there's lots of other areas within sort of the selective cyclical sectors that are a little bit more attractive to us than something that's going to be as binary as up and down oil within the energy sector.
And we only have about a minute left, so just in 30 seconds, tell me, when it comes to S&P Global, it's interesting. It's trailing the S&P 500 this year. It's down about 6% or so year to date, but it's outperforming over the past 5 years, which I was surprised to see. Does that really come back to the forecast they deliver when you think about 2024 performance?
Yeah, I mean, I think, ultimately, getting top line at 11% in an environment where that's specifically higher than what nominal GDP is, in a sector where, growth is sort of hard to come by at this point, especially within what's happening in the banking sector, as we've seen this week. So, ultimately, they're really in the position of in an oligopoly, within the industry, and have few competitors. They've got enormous pricing power. And I think ultimately this capital formation that will continue throughout the rest of this year, barring, absent any that more sustained economic downturn, I think really sets up well for the back half of the year.
All right, Tim, really enjoyed this conversation. Have a great weekend. Our thanks to Tim Chubb. He is the CIO over at Gerard. Now, coming up, a new financial drama is unfolding on Wall Street. Brent Whitten, he is the ARK Invest's chief futurist. He joins us next on his firm's beef with the Destiny Tech 100 Fund. This is Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
There's a bit of a financial drama brewing on Wall Street. You have Cathie Wood's ARK Investment Management issuing a public and pointed critique of the newly launched Destiny Tech 100 Fund. And here with the details and to get into a little bit of the fund structures, we're here with Brent Whitten. He is ARK Invest Chief Futurist.
And so we are surely expecting comments from Bank of England's Breeden and Ramsden.
The audience, of course, we spoke on this program to Sohail Prasad of Destiny Tech 100 last week. It's a closed-end fund that invests in private private companies, and like a lot of closed-end funds, it trades at a premium. Most trade at a discount, but we're talking about a big, big premium here. And it was interesting. ARK then posted a tweet thread on the fund saying that it might be too good to be true. And Brett, this caught my eye because it's unusual to see an issuer comment directly on a competitor's fund. So I guess my first question to you would be, what prompted ARK to make a public statement here?
Well, one, I think that people are interested in the Destiny Fund because they understand that this is a unique time in technological economic history and that they need to get exposed to innovation. I totally agree, and I get it. You look at a fund and you say, hey, they have lots of SpaceX and they have lots of OpenAI, and I want to invest. The issue is that the marginal investor paying $30 a share, or whatever it's trading at now, roughly $30 a share, is only getting $5 worth of stuff if they buy the Destiny Fund. So if you're familiar with like having an upfront fee on a product, you're basically paying an 80% or so upfront fee to get exposure to the underlying issue. So we think it's just like not a good structure to throw marginal money in, because you're getting much less money for the amount that you're investing. And we actually looked at, when we launched our venture fund, closed-end fund structures, and this was one of the concerns that we had, was that the price could drift from the underlying basket of assets out there.
The Bank of England releases the text for Ramsden, says the UK is less of an outlier on inflation, says there are likely to be bumps in the disinflation process from one month to the next.
And we think that's much better for clients. If you're investing, you think in
and Ramsden adds, the last few months, I have become more confident in the evidence that risks to persistence in domestic inflation pressures are receding.
So
Adds that domestic risk to the outlook for UK inflation is now tilted to the downside.
He said that
And Ramsden adding that the balance of domestic risks to the outlook for UK inflation relative to the February NPR forecast is now tilted to the downside.
Nor liquid. Investors in such products risk waiting years to access their capital. So, I mean, to sum it down, it sounds like with an interval fund, what you're saying is you're going to track the actual value of your holdings much more closely. But then Destiny would argue that, okay, but maybe you can invest at any point, but you can only redeem on
And Bank of England's Ramsden says this leaves the UK again as less of an outlier and more of a laggard in terms of recent performance numbers.
The idea that, okay, you're going to have a better tracking product, but the liquidity won't necessarily be there like it would have been in a closed-end fund.
Yeah, you're always
Ramsden adds that I have become more confident in the evidence that risks to persistence in domestic inflation are receding.
And an interval fund was actually originally designed to allow people to get venture exposures at 40 Act fund level. So non-accredited investors can get venture exposures. But it was never used that way, at least consistently. And partly it's because traditional venture investors love getting carry on their returns. They charge a management fee, and if their exposures outperform, if their innovative companies outperform, they get to take a piece of that for themselves. And so it's very lucrative for a traditional venture investor. And so the interval fund structure didn't look that interesting to them because they had to give that up. And so the way the interval fund is structured, though, because it's invested in a lot of venture companies, there is a 5% maximum outflow in any given quarter.
Bank of England's Ramsden adds that the inflation staying close to the 2% target over the whole forecast period is at least as likely as the February 2024 forecast now.
We can use the public market exposures in the interval fund to fund those outflows over time if need be. And this is the same structure that's used for a lot of private credit exposures.
Right.
There are, plenty of assets that you can get exposure to in interval funds, and it's matched to the duration you should expect when you're investing in private companies. These are companies that are not likely to list on a public securities.
So looking now to the Fear and Greed Index, 33 out of 100, which indicates fear, while the Crypto Fear and Greed Index is 66 out of 100, which indicates greed. We're keeping an eye on the VIX, which is up 3.5% on the session at around 18.64.
Well, Brett, to that point, how do you actually source your private shares? What does that process look like on your end?
Bank of England's Ramsden says we can be confident that headline CPI inflation will fall sharply in April to close to the 2% target.
Really cutting edge work on forecasting technologies for a decade. From the beginning of ARK, we've been approached by private companies saying, hey, do you want to invest with us? You know, we did a white paper with Coinbase when they were raising their Series B. And we had always been in a spot where we didn't have a mechanism by which to put client assets into the exposures. And we were resistant to doing a traditional fund structure because we think that innovation exposure should be available to everybody, not just to the rich and the wealthy. And we finally figured out that we could do it in the interval fund structure. And then, companies we reach out to are like, great, we want to have you on board because you understand technology well, you understand how hard it is, and how valuable it can be, and you're going to.
In 10 minutes' time now, at the bottom of the hour, Fed Scoresby is due to participate in a moderated Q&A at the SABEW annual conference. The text is still yet to be determined. We do have a live video link on the calendar for anybody interested.
Public market owners.
And I'm curious, I mean, when we think about the premium that DXYZ still has, I mean, at one point it had rallied over 1,000%. Now it's down to a pedestrian 223% or something close to it. And I'm curious, I mean, could you take that premium as a good signal for your venture fund that clearly investors are willing to pay a premium here to get access to these private companies?
I mean, yes, I suppose. In some ways, it's frustrating because there are much more efficient ways to get exposure to the companies that people are looking at inside of DXYZ and saying, oh, yes, I want to be invested in that thing. And again, it's kind of like paying a very, very high upfront fee to invest. Or put another way, this is, if you're buying a closed-end fund at a $30 in the market and it has $5 worth of stuff in it, the people who are accredited can buy those exposures on secondary markets for $5, and you're paying $30. So you're paying 5x more than a rich person has to pay for that, or 6x more than a rich person has to pay for that same exposure. Right. So frankly, it's a little, I would say, puzzling that people don't understand this, and our concern is that they haven't done kind of sufficient due diligence to understand it, which is why we published the piece. It's really, and I think Destiny should feel the same way. I don't think it's good for them that it's trading at such a premium. It's ultimately going to result in a lot of clients that are probably going to be disappointed because the underlying assets may do very well, but then their investment won't or may not.
Brett, I'm heartbroken to say we have to leave it there. Hope to continue this discussion soon. Really fascinating stuff. Our thanks, of course, to Brett Winton of ARK Invest. And be sure to tune into my podcast with Matt Levine of Bloomberg Opinion called Money Stuff. First episode came out last week. A new episode coming this Friday at 2 p.m. Eastern. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
US stock index extending their fall here. That's the NASDAQ down by 1% now. So in 10 minutes time now at the bottom of the hour, we expect comments from Fed's Goolsbee, who participates in a moderated Q&A at the SABEW annual conference. We do have the live video link available attached to the calendar for anybody interested.
Cybertrucks because of a problem where the accelerator pedal can get stuck and cause the vehicle to unintentionally speed up. Now, Tesla says it will work to replace or rework the accelerator pedal on all existing Cybertrucks. Next up, you have L'Oreal brushing off the haters. The French makeup brand that owns Maybelline reporting better than expected first quarter sales thanks to strength in its mainstream consumer products. Earlier this year, remember, L'Oreal saw a dip in spending by Chinese consumers who have pulled back on discretionary spending. And finally, we do have American Express crushing earnings estimates in the first quarter thanks to demand for its premium credit card offerings. The credit card giant expects full-year revenue to grow 11% as it revamps its cards with Delta Airlines, which of course is the firm's largest co-brand partner. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now coming up, big tech continues to downsize workspace in another blow to office real estate. Andy Poppink, he is Jones Lang LaSalle CEO of Markets Advisory. He joins us next. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front
So
of them.
shortly
They may
expecting
not
comments
be
from
a
Fed
buyer
Goolsby. Again, the
I do
live
want to spend
video
a lot
is
of time in
pinned
front
to
of that
their
other set
entry on the
that is a
calendar
buyer at
if
this
anyone's
point. They're
interested.
interested. They want to be an early adopter of the stock. They're interested in the story.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Well, the commercial real estate market has been under pressure thanks to higher interest rates and remote work. Bloomberg's Abigail Doolittle joins us now to break it all down.
Well, Katie, this is the pain that we do have for commercial real estate over the last 5 years. Take a look at the losses
Seeing
for
a
some
text
of these
release
REITs.
from
We have a
Fed
variety of
Goolsby
REITs
here.
up top, Boston
It says
Properties,
it makes
Office,
sense
and
to
they have
wait.
some of the Class A properties. So
Makes
there's
sense
been
to
a lot of
wait
talk
to
about
get
how
more
Class A
clarity
is going to
before
weather the
moving.
storm.
Progress
That
on
may be
U.S.
true, but some of the
inflation has
REITs are still
stalled,
getting
Fed
hit
Goolsby
despite
says,
having
and not
wonderful
all data
properties.
suggests the labour
Some of
market
them
is
being right
overheating.
here in New York,
Need to
down
determine if
55%
strong
over the last
GDP
5
and
years.
jobs numbers are a
Avalon
sign of
Bay, that is
overheating
an
that is
apartment
driven up by
community,
inflation or
multifamily,
driven
one
up
of the
inflation.
areas that has had more
It
strength,
says
but even
sees
so,
more
this REIT
space
is
for
down over
progress
that
on
time
services
frame.
inflation
Simon
from
Property
labour
Group
supply
Malls down
increases.
21%.
Persistently
Retail,
high
another
housing
area
inflation is
of
the
some
main
weakness.
short-run
And
problem,
then finally,
but
SL
Goolsby still
Green,
hopeful for a
another one of
return
the office
to
REITs down
improvement
nearly
on inflation in the
47%
months
over the
ahead.
last 5 years.
Says
So that
proper
pain,
Fed
as
policy
we've
going
shifted
forward
our
will depend on the
lifestyles
data.
with the
Fed's
pandemic,
current
many people
restrictive
working
monetary
from home.
policy
A lot of
is
it has to
appropriate.
do, of course, with occupancy. So this chart goes way, way back, and you can see back in 2004, REITs very, very high. Occupancy, not as high as it had been at 2000, but take a look now where we have occupancy going down quite a bit here. 88% REITs, office REITs, the Bloomberg REIT index going down with it. And you were talking about rates, Katie. Let's take a look at that because it would be an inverse picture if we were to put it into that last chart. Take a look at the 2-year yield. It's amazing during the pandemic, just a couple bips high, backing up by nearly 4.8%, and we have this 2-year yield now at 5%, really putting continued pressure on the commercial real estate space, but in particular office because of those secular shifts.
Yeah, big time. Great breakdown. As always, our thanks to Bloomberg's Abigail Doolittle. And for more on commercial real estate, I'm pleased to say we're joined now by Andy Poppink. He is Jones Lang LaSalle, CEO of Markets Advisory. And to start, just set the scene for us. What do you do over at JLL, and who do your clients look like?
Hi, Katie. Thank you so much for inviting me to join. So at JLL, we advise both occupiers and investors on their strategy and ultimately the implementation of that real estate strategy. So that is some of the largest corporate occupiers of office, industrial, retail space. And then on the investor side, it is a lot of those names that you just saw in the chart. And it has been a tumultuous few years in the real estate sector.
Yeah, definitely. And I mean, to that point, what are you telling clients right now when they're asking for advice? What are you actually saying?
Yeah, there are two really big factors that have had an impact over the course of the last few years, both of which were touched on a few minutes ago. The first is the pandemic. That was a shock to the system, and we had to immediately rethink the way we utilize our real estate. It also elevated commercial real estate in the minds of many corporate executives, where it used to be something that was of interest, but now it was of primary interest and a key talking point for them. The second is then the swift increase in interest rates, which had an impact on the investor side, as well as the CapEx spend on the occupier side. We're on a journey still in both of those factors. On the return to office side, which the tenant demand is really what drives the value proposition in the real estate life cycle. The U.S. is a little bit behind globally where Asia, Pacific, and Europe, Middle East, Africa are in their journey on return to office. But we continue to see increased interest in getting people back into their office spaces. At this moment in time, I think we've got 90% of the Fortune 100 have either remote or fully back in office programs in place, and less than 2% of those are fully remote.
There's probably mixed feelings about that among the American workforce. But of course, if you are involved in CRE, you're probably happy about that. But it's interesting, the conversation on office, because I was actually speaking to a CRE investor yesterday, and he made the point to me that, okay, actually the trends look really good for office right now. But the thing that could upset the apple cart would be an interest rate hike. Of course, that conversation is ongoing as the data continues to come in hot. That investor yesterday said it would be cataclysmic for office. Would you go as far?
Well, first, let's ground it in some statistics of what we've seen now with the first quarter coming to a close. We had 70% of the markets in the U.S. saw a quarter-on-quarter increase in tenant requirements. So a positive trend, not of a substantial increase, but at least an increase. And about 14% more transaction activity year over year in Q1, so 2004 to 2003. And large transactions, we've seen about just over a 10% increase year over year. So we are seeing some positive trends. We have, when you look at trying to get people back into offices, and you have a lot of people come on your program who talk about what their ideal scenario is, the average for the Fortune 100 is about 3.08 days in the office as an attendance requirement. The challenge for a lot of them has been, how do we enforce those requirements? Because we remain in a very tight labor market across the U.S.
Yeah, big time. And no signs of that cracking if you take a look at the recent data. But let's go specific here and let's talk about different areas within the country where you are seeing that office market come back and actually get a bit hot. I'm looking at your 25 most expensive streets, and probably no surprise, I see Sand Hill Road up at the top.
Yes, indeed. It's fascinating. So I spent the majority of my career in Silicon Valley, and what you see, and it's hard to appreciate because San Francisco is probably the furthest behind, San Francisco Bay Area, furthest behind in its return to office journey. But in my experience there, the innovation cycles are so swift and become so compressed that if you miss a cycle of innovation, you risk really dire consequences to, in particular, tech companies who are focused on singular products. So we've seen, to your point, significant increase in AI companies seeking space in San Francisco. San Francisco is not all the way back, but it's a lot of positive trends, and a lot of the funding still comes from those roads from those companies, investors who hang a shingle on Sand Hill Road amongst the venture capital community.
Interesting. So when it comes to San Fran, obviously there is a lot of doom and gloom about San Fran. But I mean, taking a look at some of your data, it seems like at least now some of that is misplaced.
Some of it is misplaced. I think there are signs of hope. There are rays of hope for San Francisco. But this is not just a real estate challenge. This is a community challenge. We need to bring together both the occupiers, the investors, the community, as well as the municipalities to come up with plans that help regain the strength of those streets. And when you don't have people in offices, it damages the foot traffic, which impacts retail, which then impacts the who's on the street and how we're taking care of our streets in a place like San Francisco. So I'm hopeful. A lot of discussion about the future of cities and bringing work, live, play environments closer together. That we will bring those constituents together to rebuild cities like San Francisco in a better fashion than they may have been in their previous iteration.
Interesting. So it sounds like what you're saying, that when you think about the daisy chain from workers to retail, et cetera, and everything that comes, it really starts with people returning to the office in San Francisco. But let's actually go to the other end of the country.
Fitz Goolsby says the golden path is more difficult this year now.
West Palm Beach, because that's been one of the big narratives coming out of the pandemic, that everyone is relocating to Florida, a lot of companies, and it seems like there's data to back that up.
There is some data to back that up. We are seeing a fair number of corporate relocations and then also personal relocations. And it takes time, because it does take time to build the ecosystem of companies and entrepreneurs, investors, to plant the seeds that become the next companies that enter into growth cycles and have a real impact on the environment. The other thing that becomes a challenge in a place like Miami, and this is a challenge more broadly, there's some really interesting kind of factors at play here that might not be obvious. We're in a tight capital constrained environment, so the amount of new development has slowed significantly. That's one key factor, while you also have demand that is more focused on the highest quality assets, so those things that provide amenities in newer buildings. And so we're actually seeing in some markets where you have a very unique set of circumstances where vacancy rates might be increasing while the rental rates for which the
Fitz Goolsby says we have done great on the employment mandate, but we have not succeeded on the inflation mandate.
Across markets.
Well, Andy, really enjoyed this conversation. Have a great weekend when you get there. Our thanks, of course, to Andy Poppink of Jones Lang LaSalle. Let's get a check on these markets right now. We're going to do that with Abigail Doolittle.
Well, it's been a little bit of a rough stretch here, Katie. Right now, over the last 6 days, at least the last time I looked, the S&P 500 down. That's the first time we've seen that since October of 2022. So the bear's really out over the last few weeks, but this is the worst week since October of last year. And here is this trend of stocks going lower. And for many of these days, not today, but bearish reversals.
And Goolsby says it will take longer to get inflation down to the 2% goal.
Lowered. Not a lot of conviction on the part of stock investors there at all. Now, as for what could be next, if we take a look at the technicals, I think that the Russell 2000 is really exemplary here because it is down.
Fitz Goolsby says that if you hold at this level of restrictiveness for too long, you will have to start thinking about the impact on jobs.
That has taken the Russell 2000 down toward its 200-day moving average. Now, the reason that's important, you can see the S&P 500 not close to there, but back during the last sell-off, the S&P 500 still well above its 200-day moving average when the Russell 2000 sliced below.
Goolsby says the policy trade-offs are harder this year.
S&P 500 following briefly, there's a possibility here that this playbook of the Russell 2000 small cap stocks that are more sensitive to interest rates rising, that could be a tell of what's ahead for the S&P 500. In other words, 5% is not enough consolidation for the big rally we've had. And speaking of rates, well, if we take a look at rates rising here over the last week even, take a look at these massive moves higher. The 2-year yield, as we were talking about not so long ago, close to that 5%, the 10-year yield at 4.62, perhaps not far away from 5%. Let's not forget that CEO of JP Morgan, Jamie Dimon, has even floated the idea of 8% rate, so that could certainly pressure stocks even more. And then finally, it is, of course, earnings week. One thing that could maybe save stocks, although I'm a little bit skeptical about it because at the end of the day, it's going to come down to the Fed and liquidity. But take a look at the earnings week that we've been in and take a look at next week. $16.7 trillion worth of market cap to report. It's going to be a busy week, Katie.
Yeah, that was a big statement that the Fed matters more than earnings. I guess we're going to find out over the next couple of weeks. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, EVs, they might be down, but not out. That's what Congresswoman Haley Stevens of Michigan says. More from that conversation next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Fitz Goolsbee says it's harder to get to 2% inflation without housing progress.
Of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Goolsbee says we'll get inflation to 2% over a reasonable period of time.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's time for our Wall Street
Goolsbee says, I don't know if recent inflation is a sign of overheating.
U.S. car makers are responding by cutting production and prices. Congresswoman Haley Stevens of Michigan spoke to David Weston on Wall Street Week and said that the fluctuations, not surprising.
We were never expecting a linear trajectory of growth. We've certainly seen big numbers coming out, 18%, 1 million EVs sold. Very pleased to see where we are this year, technically over the last year and the year before that. But we realize it's going to be a little bit more of a curve than just that straight linear line. And in part, David, we know we're living in inflationary times. We know we're still working on the infrastructure piece of this. Interest rates are up. How many Americans are racing to buy a new car right now? That's what's on my mind. That's where I'm pushing the trade groups and trade associations and the conversations I'm certainly having with the dealers. But the key thing is that the United States of America, under Joe Biden's leadership, passed a very large industrial policy bill known as the Inflation Reduction Act to ensure that the U.S. could lead with the supply chain for battery electric vehicles as well as potentially hydrogen. We certainly saw those investments come out in the infrastructure bill, and we didn't want to be left out of the global marketplace. Our automakers asked us to do something to enable them to lead and develop in this area of technology and innovation progress. And I am so thrilled as a member of Congress from Michigan to see what, from the supplier to the original equipment manufacturer, what these folks have been able to do during unbelievable times, a global pandemic, and then coming out of it, and we've led every step of the way.
One of the things we hear about is affordability. As you know, some of the big auto manufacturers in your home state of Michigan, mine as well, by the way, started toward the top end of the price point rather than down mid-range. And we may be leaving behind some of the mass market consumer. Do we need to make them cheaper? And does the Inflation Reduction Act do enough to allow auto manufacturers to price these electric vehicles so people can afford them?
Well, certainly we're thrilled that we got the tax credit piece done, and I think if it was solely up to Democratic lawmakers from Michigan, we would have done more, and we hear that from those who are in the intersection between distribution and the dealership world, that more tax credits might be desirable here. And we'll also reflect that when Tesla was exclusively in this marketplace, and they've got a very vertical integrated supply chain, obviously not using a unionized workforce, and they put a huge price tag on their vehicle and made themselves a little bit of an enigma in the marketplace. And now you're seeing, for instance, as Stellantis start to roll out battery electric vehicles that are beautiful, that are a much lower cost. GM doing the same thing here. And so, look, the American consumer, we know, is being stretched. We've got people paying more for food than they have any time in 30 years out of their salary. This is something that the Biden administration with the FTC is working on every single day. We've got to have some accountability on costs and holding of account of the large producers and whatnot with food. But in terms of cars, we have so much to be optimistic about in the United States of America. Look what happened with chips and microchips. Not only did we pass a chips manufacturing bill, we are going to be the only country in the United States of America that leads from the standpoint of design, production, and shipment. So I'm overall optimistic, but I'm listening to the consumer. I'm recognizing that people have large car payments with high interest rates, engaging the Treasury Department, making sure that they've got trusted leadership here in the United States Capitol where we can assist with these rising costs across the board.
How popular are electric vehicles in Michigan with the workers? Because this was an issue that came up in the UAW negotiation. A lot of concern that you don't need as many workers when it comes to EVs. What is your sense of your home state and the workers there and how enthusiastic they are about EVs coming?
Well, I'll certainly say that my building trades are very enthusiastic to see new plants being built, being rehabbed. Every time I talk to our building trades union, they are busy. They are at max employment. They're working many long hours. And so that's an exciting piece on the infrastructure side and the manufacturing side. We got, with the Inflation Reduction Act, also investment dollars to rehabbing manufacturing shops themselves for this energy transition. But we can't be naive to how we
Fed Goolsbee, when asked about a possible rate hike if needed, says, "I don't think anything is not on the table."
Large discussion, a strike that occurred around safety, around record profits, needing to increase worker pay, get rid of the tiered structure. A lot of the concessions that were made during the auto rescue period that I worked on with Steve Ratner.
And Goolsbee says the Fed is figuring out how restrictive it needs to be.
Edge of bankruptcy, and they didn't liquidate. They rebounded, as we do in Michigan. But we cannot have an electric vehicle revolution without the auto workers, and we will have it with the auto workers. And then lastly, as a government actor, it is not my responsibility to shove things down the consumer's throat. We are setting up the environment and the climate, but car makers sell cars. And I know that they are working on this every day. Anytime I get a chance to talk to Ford Motor Company, for instance, I'm asking them, what are your consumer reports saying? What are your market indicators saying?
And that was Congresswoman Haley Stevens of Michigan speaking to David Weston. Also joining David at 6 p.m. New York time tonight, Richard Haas of Centerview Partners and Kathy Marcus of PGIM Real Estate. This is Bloomberg.
next. It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Well, new data shows that many ETF strategies are actually performing better after they liquidate. Joining us for more now on this ETF Friday, the best day of the week, we have Bloomberg's Emily Grafeo. Really interesting report out by Bloomberg Intelligence's Athanasios Sarafagis. What does it actually show here?
So he was looking at a basket of ETFs that closed. And so he scanned this basket and found that on average, the lifetime gain of these ETFs was about 12%. But in the year after they closed, the average gain was 27%. In addition, he looked at the average outperformance. So if it was a stock ETF, it was compared to the S&P 500. If it was a bond, compared to the ag. And on average, over their lifetime, only 16% of these ETFs outperformed the respective benchmarks. But once they closed, that number doubled. 35% of the ETFs outperformed the benchmark in the year after shutting down.
And I mean, we've poked fun at Athanasios on air before because he makes really interesting research, but it's kind of like, so what? Like, the ETFs are closed. What can I do with this information? What's the takeaway that ETF issuers might take from this?
It's hard to time when you are going to close an ETF. I mean, I think part of the outperformance could have to do with mean reversion, because when you dive into the data, Athanasios actually showed that the ETFs that had the biggest losses actually had the biggest amount of outperformance after they closed. But I think it also just shows that the market is, again, getting more competitive. We've already had 88 ETFs closing this year, but we've also seen a record pace of launches in the first quarter of 2024. So I think it, again, just speaks to that. It's difficult to time, and it's getting harder to have your strategy stick in the market.
That's a nice place to leave it. Bloomberg's Emily Grafeo, thank you so much. And of course, you can get more on ETFs on ETF IQ on Mondays at noon. That's with me, Eric Balchunas, and Scarlett Fu. It's a great time, but Bloomberg Technology is up next, of course, before we get there. And that does it for us. I'm Katie Greifeld, and this is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde is off today. This is Bloomberg Technology. Coming up, we have full market coverage ahead as investors scale back on geopolitical concerns with stocks bouncing off their lows. Plus, Netflix shares fall after a disappointing revenue outlook and plans to stop reporting its subscriber numbers. Details to come. And financial services platform Ramp raises an additional $150 million to reach a $7.6 billion valuation with new backer Coastal Ventures. We sit down exclusively with CEO Eric Lyman later this hour. Let's get to those markets. We know the themes. Geopolitical concern, kind of some caution, if not risk-off mentality. Israel with a muted retaliatory strike against Iran. We will go to DC in just a moment and discuss the politics of it and operationally what's happening. NASDAQ 100 is down a full percentage point. Tech is actually where there is the most downward pressure right now. There are other stories within that. And on the board, you'll see names like Tesla and Netflix. Tesla with the Cybertruck recall. I'll give you the details later in the program. Netflix had a mega start to the year, but the investor base is spooked by its outlook for the future and how it plans to communicate. I'm also looking at crude. We did see oil move higher. Based on what happened in the Middle East, that's not hugely a surprise. Let's get to the top story. Israel launched a retaliatory strike on Iran less than a week after Tehran's rocket and drone barrage. Iranian media appeared to downplay the incident in the hours that followed the initial reports. For more, let's get out to Washington, D.C. and Bloomberg Balance of Power host Kayleigh Lyons. This is the framing. It is a retaliation, but muted, and seems to be that Israel listened to the United States, who were urging them to show restraint.
Yeah, and Ed, not just the United States, but other allies and partners as well, including officials from the UK and Germany, which actually made a trip to Israel earlier this week to encourage Prime Minister Netanyahu to have restraint here in the response to that unprecedented attack we saw Iran conducting over last weekend, where, of course, the more than 300 missiles and drones sent Israel's way were largely intercepted by air defenses by not just Israel and other allies. Now, Iranian media have confirmed that there was a drone attack in Isfahan, where there was a military operation. However, it did not actually hit any nuclear facilities, according to our understanding at the moment. And that perhaps could have been one of the most escalatory things of all. It does not seem that that happened. Instead, that this was relatively a limited strike with very little damage that seems to have resulted from it. U.S. officials have confirmed to Bloomberg that Israel was behind this attack. Israel, as is typical in military operations relating to Iran, has not confirmed or denied it, not commenting at all. And the U.S. Secretary of State Antony Blinken, also who was at a G7 G7 meeting in Italy, didn't directly comment on this attack, but did go out of his way to say that the U.S. has not been involved in any offensive operations and remains committed to de-escalation between Israel and Iran, knowing, of course, that the U.S.'s primary objective throughout this entire saga that really has taken place not just in the most immediate past, but since October 7th, when Hamas first attacked Israel, is to have this not spread into a wider conflict. Right now, the signal from both Israel and Iran does not seem to be that they are as interested in escalating this further. The sign seems to be that Iran is not immediately inclined to launch another counterstrike against Israel for this, as Iranian media is saying largely the strike was unsuccessful.
I'm just passing over the markets. Later in the program, Kaylee, we're going to do a deep dive on Bitcoin, and I thought that actually the reaction over a sort of 24-hour time period was interesting. Kind of came down. I think we're back up in the session. The NASDAQ 100 on the equity side, it is the kind of mega cap tech names that are pushing lower on a points basis. They're a big drag on the index. My point being, markets are trying to work out how serious this is. Operationally, the only kind of update that I've seen is from Secretary Blinken, who in summary basically said, you know, the United States did not participate. But do we have any sense of strategy here on the US side, given how they've operated in a basically advisory capacity in this situation so far?
Well, the U.S. has been quite clear that they will stand by their ironclad commitment to Israel as an ally and act in Israel's defense, as we saw last weekend when it was U.S. air defense that also contributed alongside the U.K. and Jordan to making sure that the vast majority of those drones and missiles did not actually end up in Israeli airspace. But that is really where the U.S. seems to have drawn the line. Yes, we will help defend you. However, we will not join you in any offensive operations. It was widely reported that when President Biden spoke to Netanyahu after last weekend's attack, he suggested that he should take the win, essentially not go any further, and that the U.S. would not be joining them if the Israelis decided to counterattack against Iran. Again, it seems that Israel has decided to do so, but in a limited fashion, and it's been very clear messaging from the Secretary of State that the U.S. was not involved in any particular offensive attack, including this one, Ed.
There is a lot happening in DC at the moment and in the coming week. You know, we're going to be talking a lot about TikTok. How much of the focus has been captured by the situation in the Middle East, both at the sort of federal level in the White House and through Congress as well?
Well, a great deal, Ed, especially considering that Congress, as we speak, is getting ready to advance supplemental aid for other allies too, including Ukraine and Taiwan, but billions of dollars in aid for Israel. It's working its way through the House. We expect a procedural vote will happen on the House floor today to advance that for a full floor vote tomorrow, either in the late afternoon or evening, which would then go on to the Senate and presumably be signed by President Biden in the not-so-distant future. So the U.S. is actively thinking about the military support that it is providing allies. This has been a bit of a difficult journey, especially because the Ukraine aid itself has been complicated. But I would just note that there's other political factors, specifically with the Middle East here, including very high domestic pressure on President Biden from within the progressives in his own party, who also are not very supportive of the Israeli operation that we have seen in Gaza, given the high death toll of Palestinians, which authorities in Gaza say has now surpassed 34,000. So at the same time that the U.S. has been coming to the defense of Israel in the case of Iran, wants to make sure Israel is secure, it also has been putting a lot of pressure on the Netanyahu government to take higher account of the civilian toll of this war, to make it easier to get humanitarian aid in, has been encouraging them not to conduct an operation in the city of Rafah, where there are remaining Hamas battalions, until they can safely evacuate the more than 1,000 Palestinian civilians that are there. So it's been a very difficult dance for the U.S. to still be supportive of Israel, stand behind it as an ally, but also try to exercise some leverage to change Israeli policy, perhaps, in regard to its ongoing war with Hamas.
Bloomberg's Kaylee Lyons in DC, just terrific and deep reporting on what is a geopolitical situation. But just looking purely at the index level, NASDAQ 100, super tech heavy. It's the mega cap tech names that are dragging us down, and they're really underperforming the benchmark S&P 500, and the Dow is actually in positive territory. That's why we're focused there. The reaction in the markets is being felt in tech right now. Coming up in the show, we're going to break down Netflix's earnings results with Laura Martin from Needham & Co. She has this idea that Netflix is primed for a generative AI boost, but there's a lot of concern about what they announced last night. We'll have the details. This is Bloomberg Technology.
news that move markets are on Bloomberg.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time.
Fed Scoresby says if productivity continues, it will change everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This remotely operated vehicle offers a glimpse into what lies thousands of meters underwater. It's one of several deep-sea vehicles on board this repurposed ship from Ray Dalio's philanthropic venture. The Ocean Explorer behind me that's currently docked in Singapore will set off on its mission very soon to explore the deep waters of Southeast Asia. There's lots of advanced tech at play here, like this remotely controlled underwater vehicle that can go 6,000 meters deep to collect data, and these submersibles that can take passengers as deep as 1,000 meters underwater. The vessel was once used in the oil and gas sector, but the revamped diesel-electric ship now travels around the world, collaborating with governments and working with local scientists. It's in Southeast Asia to study the region's marine environment in an attempt to protect the oceans from the effects of climate change.
Just such deep reporting on marine propulsion navigation. Bloomberg's Ainsley Assakan with that report. Okay, let's get to talking tech. And in the news, Apple is pulling Meta's WhatsApp from its app store in China amid orders from Beijing to close more loopholes in the country's long-standing internet firewall. The iPhone maker also removed the messaging services Telegram and Signal, according to consultants who are tracking that space. Plus, sticking with Meta, the social giant has unveiled a new version of its powerful Llama artificial intelligence model. Llama 3 is an upgrade from an AI model that Meta released last summer, and it's the latest effort to keep pace with similar technologies from companies like OpenAI and Google. And finally, Apollo and Sony are considering a joint offer for Paramount Global. According to sources, the two firms have held discussions about teaming up on an offer, but have not yet submitted an official proposal. Sony and Apollo's entry would complicate a deal that's already in the works for the studio, which is currently holding exclusive talks with Skydance Media. Stick with media. Digging into Netflix, shares falling after earnings, but Needham & Co. actually upgrading Netflix today to buy from hold with an updated price target, $700 US. Laura Martin, senior entertainment and internet analyst over at Needham & Co. is here with us live, Bloomberg Technology. I really enjoyed your note. Hello, good morning, happy Friday. Not so happy based on Netflix share response. The anxiety, I think, is the idea that they just won't report monthly subscriber gains or losses. Why?
So I think it's a great point. I mean, first of all, they're not going to do it until the first quarter of 25. So all of this year, we're sort of safe. Second, I'm fairly skeptical they can do this because other than Apple, which I do not think Netflix is Apple, every company that has a subscriber-driven business reports subscribers because we calculate value on a per-subscriber basis. So I don't know if they'll actually do away with it, even though they've said they will. They're pretty good about listening to feedback, and Wall Street's feedback is pretty negative about this, like opaqueness that they're adding to the fundamentals. So, but anyway, it's not an issue until the first quarter of 25 at the earliest. I also think people are having issues with sort of below, like a negative sub ad number compared to first quarter. They don't like that. And also the guidance for Q2 is a little light compared to consensus estimates. So I think people are worried about a slowdown in revenue growth.
I like the phrasing.
Fed Scoresby says consumer loan delinquencies are an area of concern.
Judge us on these traditional financial metrics, profit basically. What I found interesting, if you look at the 9.33 million customers they added in the first quarter, there's a story behind it, right? Which is that the password crackdown seemed to bring to them people that were forced to sign up for their own account, and they were willing to do that. What was your interpretation of that number in the moment?
So I also think that what's happening is when someone calls to disconnect because they're angry that they're going to have to buy a whole another subscription, or that the price is going up, with the ad-driven tier, instead of canceling your $15 subscription that's on its way to $20, you can go to a $7 per month tier. You just have to take ads. But right now, they tell us at Netflix that they don't have that many ads, that they have way more supply of ad units available to sell than they do have demand for ad units, which means the ad loads here are very minimal, like 1 or 2 ads an hour. So that's a pretty good deal for consumers right now, because you can pay $7 a month and get almost no ads in what's called the ad tier. So 3 years from now, there'll be 5 minutes of ad loads. But today, there's like 1 minute of ad loads and you're paying $7. I think that is helping their reported sub number, although it's hurting what they call ARM, what the rest of the world calls ARPU, because the subscriber that used to disconnect and go to zero is now going to $7. So it's pulling down the average revenue per subscriber as people sign up for these ad-driven tiers.
Just a quick update for our Bloomberg Technology audience, Laura. I just wanted to talk about the shares really quickly. We're down more than 8%, off session lows, but at one point, the stock was on track for its biggest drop since April of 2022. Let's see where we end up at the end of the day. I don't understand why we don't talk a little bit more about the strength of the content slate. I have just finished watching The Gentleman, for example, the TV or series adaptation of the Guy Ritchie film. Thought it was good for what it's worth. But content-wise, continuity-wise, Netflix seems to be okay. Why are we not discussing that more?
I think because Wall Street sort of feels they make widgets, right? Their widget happens to be content. We assume they're going to do a good job of that with the $17 billion a year that public shareholders give them. We expect them to maximize the quality of that $17 billion of content. We sort of think that's their core business. Like, just because Apple makes great phones, like you don't give them kudos for that. Like, they better make great phones, otherwise people aren't going to keep the service. So I think that's their core business. And I also think Wall Street is skeptical of hit-driven businesses, because you may love The Gentleman, which I also thought was excellent content, but somebody else wants to watch the Kardashians on a different service. Like, what quality content is to different people is different. And so, what we care about on Wall Street is what's happening with the return on investment for the $17 billion of content. And I will tell you, sports is really important to Wall Street. And I think it's really important to these streaming services. So they are doing more with sports. As you saw on the call, there's a lot of talk about this big fight that's coming up. They've now signed up WWE to do live sports. Let's call it entertainment sports.
Yes.
Every week for next year. That's a big deal. They are softening on sports, but they also said they are not going to spend any more money on sports. They're going to have to, the sports fees will have to come out of the $17 billion in total content costs. That's really important. I think they need to be in news also.
Laura, we got to go with some breaking news, but we'll have you back to talk Gen AI in the context of Netflix. Thank you. This is the breaking news. First of all, in the House, the Ukraine aid and TikTok bills have cleared the procedural hurdle in the House that we were waiting for. Separately, on the Senate floor, Majority Leader Chuck Schumer is speaking and saying that lawmakers should plan to work this weekend to take up the Ukraine aid bill quickly, and we'll keep an eye on TikTok. Those are stories we're tracking here on Bloomberg Technology. We'll be right back. This is Bloomberg Technology.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
PBOC's PAN says first quarter GDP laid solid foundations for the goals this year.
Let's get back to those breaking news headlines out of Washington, D.C. In the House, the Ukraine aid and TikTok bills have cleared a key procedural hurdle. I want to get out to Bloomberg's Kayleigh Lyons, who is in Washington, D.C. We are waiting as well for some summary, Kayleigh, of comments from House Speaker Mike Johnson. Kayleigh, what do we know? Think not good quite on Kayleigh. We'll get to her when she's
Bank of England's Ramsden says we will take account of Forex implications for inflation.
Saying that lawmakers should plan to work this weekend. In the context of the TikTok bill, the divest or ban bill, that's one that we've been tracking on this program because we're trying to understand the cadence of how quickly that could be ratified, if at all. I think my colleague and friend, Bloomberg's Kayleigh Lyons, host of Balance of Power, is good and joins us from Washington, D.C. I was trying to pass two things happening in parallel, Kayleigh, from the House and the Senate. What are you seeing?
Yeah, well, Ed, this was a massive bipartisan majority that this procedural vote advanced under. It was more than 300 members of the House, to be exact, 316 who voted for passage of the rule, which will clear the way tomorrow for them to pass one by one this series of bills. It will likely happen over the course of Saturday afternoon to evening. One bill that will have more than $60 billion in military aid for Ukraine, billions more in a separate bill for Israel, and then a separate one for the Indo-Pacific. And that will be a fourth bill as well, which we are calling the sidecar here in Washington. That includes a variety of other measures, including that divestiture bill relating to TikTok, Ed, as well as others like the Repo Act, which will allow for the seizure of frozen Russian assets that could be used to pay for Ukraine's war effort. So once all of this passes the House, presumably the's going to be two key questions.
And PBOC's PAN says China consumer prices were generally stable in the first quarter.
Desk of President Biden for a signature, and also what will happen to the House Speaker Mike Johnson as a result of this. He has been under tremendous pressure from a few members of his Republican conference who do not want to see Ukraine aid go to the floor of the House for a vote. One of the most outspoken has been Congresswoman Marjorie Taylor Greene, who has filed a motion to vacate, which is what ousted Speaker Kevin McCarthy just months ago, has not yet acted on it, but has long signaled she could if indeed he put Ukraine aid on the floor. So we're going to wait to see for action on that. Other members, including Republican Congressman Tom Massey, have suggested they will join her in that effort. However, Ed, and this is where it gets really interesting, it took Democrats to get this rule passed, to get it over the finish line now, and it does seem that Democrats may step in to help save the gavel of Speaker Mike Johnson if it proves necessary. There's been a lot of talk here in Washington this morning about this kind of being like a coalition government, because Mike Johnson is relying on the other party to basically get everything over the line and potentially might be relying on them to help him keep his job.
That's kind of focused on the House level. Let's take a moment here. There's a lot happening and there are a lot of headlines. In parallel, Chuck Schumer in the Senate is saying that lawmakers should plan to work this weekend as needed. You know, there will be audience members around the world, but particularly around the country in the United States saying, why are they working through the weekend on this? Why is it so important?
Well, because this aid is desperately needed if you listen to U.S. intelligence officials. And I was speaking with the chair of the House Intelligence Committee, Congressman Mike Turner, just last night, who was suggesting that it needed to pass this week based on the intel they're getting on the ground in Ukraine. Just procedurally, because of the way the House works and the requirement that members have to have 72 hours to read the bill, because of when the text is released, they can't actually have the vote until Saturday night. Now, the Senate is going to want to quickly take this up, which could mean that they take it right as soon as the House passes it and begin to do the procedural work in the Senate to get this over the finish line, which may be why they end up staying the weekend. I would also point out that the Senate tonight is facing a midnight deadline of the expiration of FISA, the Foreign Surveillance Act, which of course has been passed in the House, has been running into some hurdles in the Senate as well, and that could potentially lapse for a bit at midnight if they can't figure out a way to get the unanimous consent needed to advance that. So it could be a working weekend for everyone, which is probably not going over well for some, considering they were supposed to leave on recess beginning today. There were a number of members who were scheduled to be on congressional delegations to a number of different localities, and instead they may stay here to get this work done, Ed.
Okay, so it sounds like we're in for a busy weekend. Probably you more so than I out here in San Francisco. Is there anything we should be watching for this Friday afternoon?
Well, I would watch what happens in the Senate related to FISA in particular, whether they can reach some kind of agreement on amendment votes or things of that nature to make sure that this can indeed get over the finish line by the deadline. But really watch what happens in the House now that this rule has advanced to see if we actually see any action from Marjorie Taylor Greene, for example, to launch the process to vacate the Speaker and what could unfold from there. Also, given that there are so many things attached to this, that including the TikTok bill, which did pass by a wide bipartisan majority in the House originally, now has a revision that would allow ByteDance longer than 6 months to divest it, potentially up to a full year, which may make it easier to digest in the Senate, where many had issue with the original bill. But just look to see now that the TikTok measure does appear to be on track for passage in the House, whether anyone is vocal in the Senate suggesting that they don't like the fact that this is attached to the package. So it'll kind of be just digging into the nuances of who may be upset here, even as vast bipartisan majorities seem to be liking what they're seeing and looking to advance this, Ed.
Bloomberg's Katie Lyons, thank you. Aid and TikTok bills we'll keep a close eye on. We also check markets. The NASDAQ 100 is at a session low, down 1.2%. Tech underperforming other major indices. Geopolitics and the situation in the Middle East, the big factor, but mega cap tech, the big points drag on that index. We'll be right back. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco. We should talk about Bitcoin. And it's interesting because Bitcoin has its own story in the markets, which is the halving. And we will have a deep discussion about that in just a moment. But if you look at the trading of Bitcoin, which trades 24/7 over the last 24 hours, it tells you an interesting story about that asset in the context of geopolitics and volatility in markets. So when the headlines first started to come out Thursday evening, US time, about a Israel retaliation in Iran, there was this clear downward move on Bitcoin. Actually, in the session, we're now up higher and on a two-day basis up 6%. All told, Bitcoin just south of $65,000 per token. Then there's the other big story. The hotly anticipated Bitcoin halving is approaching. Here's what our Bloomberg guests have had to say about the event.
Every time we come up to one of these halving events, it really does come back to the fundamentals of supply and demand.
The crypto industry goes through a cycle. It's to be expected. There's going to be market volatility. It doesn't only impact the asset front. I mean, given the geopolitical tension, given the interest rate environment that we are seeing, the inflationary environment.
Obviously, Bitcoin and crypto right now in general is part of the global financial system. So we are not completely disconnected from what's happening in equities, for example, and what's happening with monetary policy or with what's happening in the geopolitical environment.
We've been preparing for many years. You know, our business is one that requires long-term planning, and these halvings are known events. And so the evolution of mining has really changed since previous halvings, where we had a really fragmented market.
I think a lot of investors are eagerly anticipating to see what the market reaction will be.
Joining us now is Kavita Gupta, Delta Blockchain Fund General Partner. Just deep expertise in the underlying technology that supports digital assets. Also some pretty strong awareness of what's happening in markets. Kavita, just forgive me, I'm going to go back to basics here. I've said the word halving. Some people call it a halvening many times. And I'm going to cheat. I'm just going to read the Bloomberg definition of what it is. And then you can tell me whether it's important or not. A halving, sometimes referred to as a halvening, is a planned reduction in the rewards miners receive. Halvings happen once every 4 years or every 210,000 blocks. Just for awareness out there, are you really excited about this, Kavita?
I think excitement may not be the word I would be using. What does Bitcoin halving really means? It just means that it makes it more difficult for the miners to have the rewards associated with mining, and also definitely that results in having mining difficulties. Basically, you have to put more energy, more complicated theorems out there, and it basically ultimately increase the cost of mining. That's what we are looking at. It is important because it makes sure that it is much more secure, mining is secure, all the Bitcoin layer is secure. Now, this definitely gets a lot of attention because of the price movement, the expected, especially now with the expected ETF, which has already happened. Now, for the first time, we're going to expect a new price curve because the supply and the demand curve for Bitcoin has been very unique this time. The supply has been huge. Usually what we see that before Bitcoin halving and around Bitcoin halving, a lot of people start putting Bitcoins out. So the supply has been there, but the demand has been so high that we see volatility instead of the straight curves down or up. So it is exciting in that way.
You make a really interesting point, which is basically one of liquidity. It's quite a liquid market. And the counter argument is that there will always be a finite supply of Bitcoin, a definitive number. And that is largely what those that build a thesis of Bitcoin reaching a much higher number in the long term rely on. Are those people in that camp correct?
I absolutely believe that at the end of the day, Bitcoin has a lot of value. And even though it is more difficult to now produce and the supply is going to be more and more limited, but that's what we see with most of the commodities, whether it's gold, whether it's platinum, silicon, anything which has limited supply, but a lot of value long run, especially storage value like Bitcoin has been considered now. It's just going to increase the price. You will see volatility, which you still see in gold today, but the value is just infinite and for a very long period of time.
Kavita Gupta, Delta Blockchain Fund General Partner, someone investing at the technology level, but I just really appreciate your market insights. Thank you. There's another big story out there today in the world of EV, and I want to talk about Tesla. The EV maker recalled over 3,800 Cybertrucks to rework or replace accelerator pedals that can dislodge and cause the vehicle to unintentionally accelerate, which increases the risk of a crash. Tesla received notice of 2 customer claims related to that issue, and that's all according to a recall report submitted to the U.S. National Highway Traffic Safety Administration, or NHTSA. The company said that when high force is applied to the Cybertruck's accelerator, the pedal may dislodge and become trapped by the interior trim. Tesla is going to fix the accelerator pedals free of charge. For me, the other big thing about this story is we now know how many Cybertrucks are out there in the wild and how many have been delivered to customers, which is quite interesting. Tesla shares basically flat. All right, coming up on Bloomberg Technology, we're going to be joined by Ramp CEO Eric Glyman to discuss their new fundraise. There are some big numbers and there's an interesting conversation ahead. This is Bloomberg Technology.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Okay, a lot of people talking about this one. Financial services platform Ramp just raised an additional $150 million for its Series D round, Part 2, at a valuation of around $7.6 billion, with a new backer, Khosla Ventures, delighted to bring in Ramp CEO, Eric Gleiman, out in New York. And this is a really interesting round. The venture firm leading it was Khosla Ventures, but Keith Raboy, who recently rejoined Khosla on the East Coast, kind of spearheaded this. Just explain the rationale behind doing the round.
I mean, there's a couple of things that, and by the way, thank you so much for having me. First, the rationale is the company is growing and we aim to accelerate it. Not only is Ramp one of the fastest growing businesses in U.S. history, but investors were deeply exciting. Keith the most, who's one of our board members, who saw the business at its large scale accelerating in growth. Typically, they tend to slow down as they grow. The rationale is to increase the pace of customers that we serve. We power over approximately 1% of all corporate card transactions in America. We want to serve the next 99%, but more than that, it's a high conviction bet, both by investors and by Ramp, to transform the way finance is done from highly manual, very tedious, to increasingly automated and leveraging the potential of AI to bring it to the average business.
Eric, you previously came on the show when you guys had done a down round, and you were really honest about the willingness to do a down round. This is an up round, and I just wondered how you think about the dynamic this time around.
I mean, for sure. I mean, look, I think that for all companies, being valued mark to market is a very good thing. Over the last summer, part of what we recognized is that it was really the fastest interest rate rise in really a 40-year period. And so even though Ramp had at that time grown by leaps and bounds, I think between rounds it had grown by 7 times over a year and a half period, we wanted to be valued fairly. Fast forward to now, just months later, Ramp's business has grown dramatically, and investor conviction has increased. And so we're thrilled that some of the best investors in the world, from public markets investors to extraordinary privates like Khosla Ventures, Founders Fund, Sequoia, Greylock, and others joining for the first time. They're thrilled for where Ramp is, but I think to invest at this valuation for the first time at this juncture, there is a high conviction belief that there is not just a 15% plus growth per year ahead of Ramp, but there's 10x plus more ahead, and so we're thrilled.
Eric, for the Bloomberg Technology audience member that's less financially inclined, mark-to-market meaning the method of getting fair value by benchmarking contemporaneously against similar companies. So I noticed on social media a lot of people were talking about your round, and so I went on social media and said you were coming on the show, and our audience on Bloomberg Technology actually had some pretty good and straightforward questions. One of them was, Eric, can you just simply explain what Ramp is and what it does, which I thought was a pretty good starting point.
Of course. So the way to think about it, we built a command and control system for companies' finances. What this means is from a single place, company finance teams, business owners can issue cards, make payments of all kinds, manage approvals, and even automate accounting to close their books. And so this means that some of the tedious aspects, things like collecting receipts, tagging transactions properly, is done automatically for you. We surface up data in ways for companies to spend less, and the upshot is that the average company using Ramp is able to reduce their expenses by 5% per year, whether that's a publicly traded scale like a Shopify to earlier stage to even nonprofits like the Boys and Girls Club of America. And I think really what's different and interesting about Ramp is it's not only the tools and bones to make payments, but it is focused on how can you make people more productive with their time instead of having expense reports take an hour at the end of a month, have it be done for you, and get your time back to focus on your core business. So that's how we think about it.
Eric, the other audience question I got for you was about you. You are generally regarded as a very nice person. I hear that a lot in my circles, at least out west as well. But the question from the audience was, are you needing to be a bit more ruthless at this stage of the company's growth as a founder CEO that's now playing at a pretty high level valuation-wise and scale-wise?
For us, Look, the broader backdrop is I actually think the U.S. business environment has gotten much more mean and nasty for the average business owner. Most companies are reducing their investment in their products. They're hiking the prices. The value they're offering and the service level is going down. We want to lean in and doing the right thing. Having more capital allows us to not just be nice, but frankly offer better service. And the last time, Ed, we were on the show, we were saving the average company on the order to 3 to 4% per year. We want to extend that idea of maybe, as you put it, being nice. We want the average company to save 5%, to be more productive. And we think over time, doing right by customers is what creates long-lasting and enduring businesses. And so it's not just a personality. We think it's a good way of doing business.
Well, you also now have a couple more investors that you'll have to account to along the way as well. Ramp CEO Eric Gleiman, it's great to catch up and have you back on the program. Thank you. Let's stick with the world of venture and startups. Maven Ventures, a seed-stage venture firm investing in consumer tech companies, announced $60 million in new capital for its latest fund. It brings the firm's total assets to $200 million. Let's bring in Sarah Deshpande, general partner at Maven Ventures, in today's VC Spotlight. This was interesting, a sizable seed fund coming together. Was it a smooth process, Sarah?
First of all, thank you so much for having me. It's great to be here today. We're really excited to bring this new seed fund to the world. Maven Ventures is best known for investing in tech companies that are addressing emerging consumer trends, and consumer trends never go away. So that's an area that we've continued to be excited about. And, I won't lie, this has been the hardest funding market for startups and venture capital firms alike. So to be able to close a $60 million vehicle, it's our fourth and latest fund, we think is really a testament to our strategy, to the market opportunity, and we're grateful to our founders and LPs for continuing to have their trust in us.
Sarah, it's so hard because if you just split technology into hardware and software, the companies that are working on consumer-facing application in both domains are giant. You're trying to get the disruption at the earliest possible stage. How do you make it worthwhile?
We really look at emerging consumer trends and technology companies that are fueled by those big consumer trends. And so that's what we're looking for, especially in today's universe where you see the bloom of AI technology. There have been so many companies invested in B2B, in infrastructure, in foundational models of AI, that we think now is the time. We also take lens of what means consumer to us. We were known for our early investment in Zoom, and no company was a more consumer company than Zoom in the year of 2020. So for us, we're looking at what are these new points of technology? What are these new emerging trends? And can we find and partner with visionary, bold founders that we think we help to unlock their potential to bring these iconic companies to the world? So that consumer lens is actually for us quite broad.
Sarah, what is the number one emerging consumer trend?
The number one consumer trend right now is consumer applications of AI. Where do we think AI can actually deliver on the grand dream of doing something for a consumer, of making something of value for consumers that actually brings something positive to their lives? So that's the biggest area we're looking at, but it applies across so many sectors. It can apply across technology for families. It can apply across search. It can apply across anything that might plan or book something on your behalf. So there's a pretty wide range of sectors that consumer AI touches, and that's where we're spending our time right now.
I think that you saying AI was not a huge surprise to many people. Sarah Deshpande, general partner at Maven Ventures, great to have you on the show. Thank you. This is Bloomberg Technology.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's not the legislation that we would write if Republicans were in charge of both the House, the Senate, and the White House. This is the best possible product that we can get under these circumstances to take care of these really important obligations.
US House Speaker Johnson has just been talking about votes on foreign aid bills. Bloomberg's Katie Lyons is back in D.C., and I think it is around Speaker Johnson that the latest headlines involve.
Yeah, of course, what we saw happen on the House floor today, Ed, was a procedural vote advancing that will pave the way for funding for U.S. allies to pass the House later Saturday. These are 4 separate bills, one for Ukraine, Israel, the Indo-Pacific, and a so-called sidecar, which is attaching other measures, including the TikTok divestiture bill. All of this aimed at getting more than $95 billion in aid to U.S. allies. However, it does seem that the House Speaker could face a threat to his job as a result. This has long been threatened by Congresswoman Marjorie Taylor Greene, who had suggested if Johnson were to put Ukraine aid on the floor for a vote, she would act on her motion to vacate, essentially trying to kick him out of the job. Already one other member, Republican Congressman Tom Massey, had joined her in that effort. And now, according to a statement from Congressman Paul Gosar of Arizona, he too has added his name in support of the motion to vacate. So now that's 3 members of the Republican conference. We're working to identify that Gosar statement or verify it independently, as this has been reported by other outlets. But of course, this suggests, because of the way the math works in the House, Ed, and how tight the margin is, that it will require Democrats to show up and support the Speaker so that he is able to keep hold of the gavel. Whether or not that's just not showing up to a new an ouster vote, whether that is actually outright voting for him, we'll see what form it takes, but it will require help from Democrats to save his job, just as it took massive Democratic support to get this procedural vote over the line today.
There is math on the votes and the bills, and then there's procedure, which you explained really well earlier in the show. We were talking about how Majority Leader Schumer in the Senate had put lawmakers on notice to be working this weekend. Just explain why the pressure to work through the weekend on these bills.
Well, the Senate won't have a chance to act on these bills until the House passes all of them, repackages them together, and sends them to the Senate for a vote. And the way the rules in the House are structured, and what was agreed to when Kevin McCarthy was Speaker all those months ago, was that members had to have 72 hours to read the text of a bill before a vote. And because the text of this bill was released less than 72 hours ago, it cannot be voted on until Saturday. So even though we've seen the rule vote today, which essentially just sets the procedure factor for how this ultimately will pass when it comes to final package. The House isn't going to be able to clear all of this until Saturday afternoon, perhaps evening, and then the Senate would be able to act after. The Senate Majority Leader Chuck Schumer has said they will do so quickly, which is why they may be staying in town. This may be a Sunday vote or later. And of course, keep in mind, Ed, that in the U.S. Senate, what is required to do anything quickly is unanimous consent. Any one senator, should they so choose, has the ability to slow down the process. So someone like Senator Rand Paul, for example, if he takes issue with this bill, could refuse to accelerate the process until he has a vote on an amendment or something like that. So it'll be a matter of how quickly the Senate can get this done after the House completes its work this weekend.
Kayleigh, just very quickly, the situation in the Middle East, is that impacting the passage of any of these bills?
It is, Ed. When you first saw the Iranian attack against Israel, the more than 300 missiles and drones that were sent toward Israel last weekend, you heard an outcry that this underscored the need to get aid for Israel out the door quickly. Of course, that has been attached in large part to aid for other allies, including Ukraine, which has been a much more difficult endeavor. But there also had been growing calls to make sure that the aid for Ukraine comes through quickly, as intelligence was suggesting that it was desperately needed in immediate fashion. So certainly the hot wars we are seeing, not just in the Middle East, but also on the continent of Europe, have really provided a lot of impetus to get this done. The House Speaker himself said the intelligence he had seen recently really underscored to him that this was the right thing to do, that this aid did indeed need to be passed. And of course, it's a decision that Johnson had to make, decide to do the right thing, even if you potentially might lose your job as a result. That, of course, Ed, will remain to be seen.
Bloomberg's Kayleigh Lyons, and tune into Balance Power later in the day for more updates. Thank you. Okay, now you'll never believe who is going viral. That's right. It's Taylor Swift. Swifties worldwide are gushing about the singer's new album, The Tortured Poets Department. The 16-song record dropped at midnight Eastern Time on Friday. The singer then announced a surprise 2 hours later at 2 a.m. She'd actually written a double album titled The Tortured Poets Department, The Anthology, with 15 additional songs. So there I am, in my vehicle, on my way to do Bloomberg Technology, and I got through the first 10. I'm not going to give my favorites just now, but check out social media. There are some interesting titles in there. Let's keep talking about it. That does it for this edition of Bloomberg Technology. A lot of headlines out of Washington, D.C., the Middle East. We are paying attention to the passage of the TikTok divest or ban bill as well. Recap on the pod. Listen to what Kayleigh had to say about the process in the coming 48 hours in Washington, D.C. Check out the pod on Apple, Spotify, iHeart, and of course, we published all the Bloomberg platforms. It's been a week in the world of technology. Thanks for watching. This is Bloomberg Technology.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating
World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, Fed officials repeat the mantra that there are no rush to cut rates, and investors send Treasury yields to 2024 highs this week as they reprice the rate path. And geopolitical risk adds tension to the direction of yields. But we begin with the big issue. The message is clear from the Fed.
Rates are going to stay higher for longer.
Higher for longer.
Higher for longer. And
higher for longer.
Those expectations of rate cuts have been pushed further and further out.
The Fed has made it very plain they want to cut.
The Fed would like to cut.
They're going to remain data dependent.
I think the biggest surprises have been retail sales and payrolls.
The data that we've had from a CPI perspective.
The key question here is around inflation. They are still seeking that confidence that inflation is coming down.
The Fed doesn't have that good an anchor on inflation yet.
We just don't have the sustained deceleration in inflation for them to even consider going in June.
If you're going to see September, again, you still need to see this softness come through.
If Chair Powell doesn't get a cut in before July, I'm not sure we can get one this year.
The Fed is trying to control the economy.
Yes, if the Fed keeps high for longer, then we will see that slowly wind its way through the economy.
And as markets realize that the Fed is in no rush to cut rates, Vanguard spoke about the 10-year Treasury yield, saying it's in a danger zone and the potential for a 5% yield. Speaking to Bloomberg, the firm's head of international rates said, quote, "We still think that there's a residual long position left over. And if that doesn't manage to be orderly squared away, that disorderly move could be what eventually takes us to 5%. And when you look at that yield's move since October, let's take a look, because you did cross that 5% level back then. You've come down meaningfully, but we have been back, obviously, on the rise here, now at 460. Vanguard saying that even a small move higher to 475 could really start to put investors on edge. And when you say higher for longer, here's a chart put out by Torsten Slok of Apollo on Friday, pointing out that normally it takes 8 months from the last Fed hike for the central bank to start cutting rates. And while the length of time has been longer in some periods in the past, we are now at 10 months. And Apollo said the risk here is that the Fed cycle could feel a little different for investors. Now, Fed Chair Powell spoke this week about delaying a rate cut.
Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Joining us now is Katie Kaminsky of Alpha Simplex and John Kirshner of Janus Henderson Investors. When we think about this drive to 5, Katie, how does investor psychology start to change as the 10-year drifts higher, particularly to that 475 mark we're talking about?
Well, if you think about it from the investor perspective, clearly we saw buying pressure start to come in. So we haven't really seen that yet, around 5%. So I think as yields start to tick up, you will start to see people thinking of this as a potential opportunity to get into the rate market and lock in those rates. But in general, the signals have been very strong all year. Short, fixed income, which has been saying higher for longer from a technical perspective for quite some time.
How do you think about this dynamic, John? If you think about the direction of travel, what kind of risks are investors pricing in now about getting in at these levels?
Well, it's very interesting question, Sonali. Basically, never have so many smart people been so wrong for so long as far as what was going to happen with interest rates. And that makes it very difficult, right? Financial markets love certainty. They're getting a lot of uncertainty. I heard the phrase as I was waiting to come on, cocktail of uncertainty. I love that. I may use that myself, so whoever said it, I'd love to give you the credit for it. But look, what we like to look at Janus Henderson is the MOVE index, which is a measure of interest rate volatility. Most people look at the VIX, which is stocks. MOVE is bonds. Normal levels for that is 60 to 80. Got up to 200 a year ago with Silicon Valley Bank. Came all the way down to 86. Now it's back up to 109. That's telling you the markets don't really know how to react to this volatility.
Well, it begs the question whether 5% is even dangerous sometimes. Katie, if you think about the buying pressure that's not coming around this time around, do you think that there's a risk here of a further sell-off, especially when you think about the longer ends of the curve?
Oh, definitely. And I think from a non-equity investor perspective, more of a cross-asset perspective, we've really seen the theme of sticky inflation and potential for higher for longer for quite some time. And this makes sense. I mean, going back to what John just said, we have seen continued high volatility in fixed income. We've also seen continued persistent positive correlation between stocks and bonds. That's very consistent with other periods of history where we saw inflation as a dominant theme. In an inflationary environment, it's very uncertain at which point yields are going to move, and it also puts a lot of pressure on fixed income. So I think that we're going to see potential for that being higher, and that's going to be more of a new normal for at least some time.
What's the read-through for risk assets? When you talk to clients, John, how is this changing the way that they're putting money to work even outside of safer treasuries?
Right. Clients want solutions, right? That's what we're in the business to do. A lot of people know me as one of the portfolio managers on our AAA CLO ETF, JAAA or JAAA. We just crossed the $8 billion mark for that ETF, almost $3 billion inflows so far year to date. What we're telling people is what you want is high quality, floating rate. Don't worry about interest rate volatility. You're getting close to a 6.5% yield. This is the ideal solution for many investors that are worried about interest rate volatility. It comes in an ETF wrapper, so the investors get the liquidity, transparency, and tax advantage, and low fees, probably most important, that most investors want.
Katie, you think about the geopolitical tensions that have been brewing in the Middle East, and you look at the bid that has been in the bond market. It has waned, that bid, even in the shorter end of the yield curve today. But what kind of role do treasuries play in an era of elevated geopolitical uncertainty?
This is a very important question because we have seen persistent positive correlation between stocks and bonds, meaning that bonds and stocks have been very focused on inflation and the role of inflation in that relationship. But what's interesting now, you are starting to see, especially with geopolitical tensions, a little bit of risk-off type behavior today and maybe yesterday, but that has been absent from most of the moves this year. And I think this is very important for investors because we have lived in an era where stocks and bonds have that risk-off property. So if we should have a more challenging environment, we're hoping that they would help us on the long side, but they haven't really demonstrated that most of this year so far.
It's an awkward dynamic because even when you see that kind of flock to safety, do you consider, John, treasuries safe anymore given the volatility we've seen in them?
Well, they're obviously safe from a credit perspective. What we would tell investors, if you want a little more interest rate duration or sensitivity in your portfolio, you should actually look at agency mortgages, also basically government guarantee, and you're getting about 100 to 150 basis points more yield. But if you're really concerned about this interest rate volatility, which doesn't seem to be going away, again, we would go back to high quality floating rate fixed income like AAA CLOs and our JAAA ETF.
You know, we're talking so much over the weekend here about the House advancing an aid bill here. But Katie, as the Treasury looks to refinance, what kind of new pressures does that put on the Treasury market?
Well, I think the challenge is that we definitely still have a very large deficit, and that hasn't come down since COVID. So that is even further pressure on the issue that we don't probably want to start cutting soon, because we could end up with more inflation. And I think that's what's really holding the Fed to some degree, is that the challenge is if you could actually unleash more inflation, that would be a very, very disruptive environment. Let's also add to the fact that we've seen commodities start to tick up and the disinflationary trend there starting to kind of create worry. So I think we really have to think that this could be a scenario that we have to avoid.
Well, there are the things the Fed can control and there are the things that they can't control. UBS warning that Fed hiking rates to 6.5% is even a risk. Do you believe that, Katie?
I think all things are possible, particularly for those of us that watch the commodity markets. And what we've seen geopolitically recently is definitely adding to that particular concern. If you look at oil prices, you look at copper prices, gold prices, all of these particular industrial-based metals as well have really ticked up. And that tells us that, we're not really to this 2% anytime soon, which means that we do really need to think about higher for longer. So,
John, what is the trade at this point? You saw investors really recalibrate their expectations for rate cuts. Even some start to think about what a hike would look like. Where do you position from here?
Yeah, I like how you phrase that trade. We tell investors, don't think about trades, think long term, right? A lot of uncertainty in the market. Don't try to time the market. A lot of people thought, I'll just stay in cash, I'll be good. And then we saw at the end of last year, rates rallied, they missed that. A lot of people thought equities were going to be great this year. They have been good, but if rates keep going up, equities are in trouble. Stick with your asset allocation. Trust what your advisors are telling you. Don't think about the day-to-day volatility. Think about right now, yields are high. Real yields are very attractive. Take advantage of that in your portfolio, because this is, some of the best return opportunities we've seen in 15 years in fixed income.
Katie Kaminsky and John Kirshner, we thank you so very much in a very complicated market. Now we're going to bring you some news, because the House earlier today announcing that they have enough procedural votes to advance an aid package for Ukraine, including a provision to force TikTok's parent company to divest. Bloomberg's Kaylee Lyon joins us now. How do you think through the events of the weekend upcoming?
Well, Shonali, it certainly is going to be a working weekend for Congress. What the House did today was pass a procedural vote that will allow final passage for this $95 billion foreign aid package throughout the day tomorrow, Saturday. It's 4 separate pieces of legislation, one bill with more than $60 billion in military aid to Ukraine, another with billions of dollars for aid for Israel, another for the Indo-Pacific, and then the so-called sidecar package, which includes repo, the taking of frozen Russian assets that could be used to advance Ukraine's war effort, as well as that TikTok bill, which is slightly amended to what had initially passed the House, now allowing ByteDance up to a year to divest it or be banned in the United States. Now, this was passed with a massive bipartisan majority, more than 300 votes, 316 for, only 94 against, more Democrats voting for this measure than Republicans. So once again, we see the House Speaker Mike Johnson relying on Democratic votes to get things over the finish line. Now, because of that, Mike Johnson does face a threat to his speakership. Congresswoman Marjorie Taylor Greene has long said that if Ukraine aid goes to the floor of the House, she would act on her motion to vacate the speaker. She already had another Republican, Congressman Tom Massey, sign on to that effort. And now just today, in the aftermath of this rule passage, a third Republican Congressman Paul Gosar of Arizona has also signed on to support the motion. So the way that this this math would work if indeed they do act to bring this to a privilege vote on the floor that would require action within 2 legislative days. It will take Democrats to help save the Speaker's gavel. So that is going to be some drama to potentially watch unfold over the weekend. And then, of course, Sonali, assuming that indeed this package ultimately does pass the House, it will then be put together to send over to the Senate. Then the Senate Majority Leader Chuck Schumer has suggested they will take this up quickly, and members should be prepared to work this weekend to get that done.
Bloomberg's Kaylee Lyons, we thank you for working around the clock to keep us updated. And up next, we're going to talk about the auction block because the high-grade market sees its slowest week of the year. But the big U.S. banks make up the difference with billions of dollars in volume. Details up next on Real Yield on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only around Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block as investors take higher U.S. yields into account. We'll start with the $23 billion U.S. TIPS auction. It had the second highest yield since 2008, and the primary dealer award was among the lowest on record. Bloomberg Markets team says the results signal a desire for inflation protection in the market. And moving to IG, the U.S. banks shine this week. JP Morgan, Morgan Stanley, Goldman Sachs, Wells Fargo, and Citizens Financial, all with sales pushing weekly volume to more than $31 billion. And over in high yield, theme park operator Six Flags helped to drive sales this week with a $850 million deal. Issuers steadily priced new debt despite those volatile Treasury yields. Sector issuance now tops $105 billion for the year. And sticking with credit, Pearlstone's Evelina Green has a warning for investors.
I wouldn't be surprised to actually see the market come down here, especially again as it pertains to credit. What we have seen at the beginning of this year is yields stay pretty flat, even though rates have continued to come up, and as a function of that, spreads have been compressed.
Yeah.
I do think that we're going to see a little bit of a catch-up, and I think that that will lead to a correction in terms of credit markets, and not only, again, the more levered structures, but also, again, investment-grade companies, which is, again, what everybody chased when rates started coming down from a spread point of view.
Ty Wallach of Atlas Merchant Capital joins us now. You saw almost an insatiable demand by many metrics to start off the year, from spreads to issuance, and you saw that floating into riskier parts of the market. How do you feel about that now, given that rates are seemingly staying higher for longer?
Yeah, first of all, thank you for having me, Sonali. It's great to be here. I completely agree with Evelina. In our Atlas Merchant Capital credit strategy, we focus on below investment grade credit and distressed credit, and we think there are a lot of opportunities now, and there's going to be a growing number, precisely because what she's talked about. Yields are higher for longer and look pretty attractive, but spreads remain pretty tight. If you look historically, spreads are near the 10-year tight levels in the high yield market. And 8% looks great for high yield, but when you can get a Treasury at 5, it's a little tight. So we think there's room for that to correct, and we generally like floating rate assets better today.
I'm really curious about the riskiest parts of the market, because a lot of folks in your market say the distressed opportunity hasn't been there in a long time. How much is that opportunity growing? Yeah, it's growing a lot. I mean, if you look after COVID, there were very few defaults in 2021, and that they grew in 2022, they grew in 2023 up to about 3%, which is kind of average for where the market has been historically. This year, all the rating agencies are projecting that default rates get up closer to 5%. And that's really a reflection of where rates are. A lot of that stress that will become distress is rate driven, because when you have companies that borrowed a lot of money over the last 10 years when capital was really cheap, they set up over-leveraged capital structures that are all of a sudden, when rates are up several hundred basis points, if they have floating rate leverage or they have fixed rate leverage that needs to be refinanced, they're going to feel a cash flow squeeze. There are a lot of investors that are sitting around here saying the economy is so strong that they're willing to get into these riskier parts of the market. Do you think they're missing something? Well, I think there is going to be a great opportunity in distressed credit. I think active management is really important, because you're going to have to pick your spots. We're seeing more and more opportunities, but with default rates still rising, if you pick the wrong one, you could lose a lot in a hurry. So where do you avoid at this point? Of the firms that are looking a little bit more stressed than others, where do you start to pick your bets, and where do you say it's not worth it, they're not going to make it through the cycle? We spend a lot of time on stressed and distressed companies trying to figure out who's going to be able to refinance and who's not. And it's not just
In 10
about
minutes
whether
time now,
their
at the bottom of the hour,
operating performance
debating
and their
comments
cash
from a
flows
Bank
are
of
there.
England's man.
There's a lot more analysis that has to go into it. It's looking at their existing debt, looking at what their covenants allow, looking to see if they have any unpledged assets, their ability to refinance, looking at who are the existing holders and what are their motivations. There's a lot that goes into looking at distressed assets besides just,
The
how
Bank
the
of
cash
England's
flows are doing
man speaks as a
at the
panelist
current
at a
time.
flagship seminar on the capital flows during the IMF spring meetings. This is in Washington. There is a live video available on Bank of England's man's entry in the calendar for anybody interested.
Yeah, there's, you call it creditor and creditor violence. You could call it liability management, however you describe it. There is a growing trend of people trying to take a bigger piece of the pie instead of trying to expand the pie. That's probably the biggest difference in the business since I got into it 25, 30 years ago. But it is what it is. It just means you have to know what you're doing. You have to be able to read the documents. You have to understand what existing creditors are allowed to do, what the issuers are allowed to do in terms of peeling off assets, in terms of layering on debt that's senior secured to you, et cetera. What keeps you up at night at this point, given that the economy has still been holding up? What turns some of these situations from a 5% default rate across the cycle to something much worse? It's an interesting question. I don't know that it gets that much worse, because the economy is actually still pretty good. In this environment, there seems to be a reversal of good news and bad news. Every time there's a little soft news from the economy, the market goes up because they think the Fed is going to cut rates sooner. By the way, our house view at Atlas Merchant Capital has been for a while that we're going to be higher for longer. I think the market is starting to come around. The Fed has been very data-driven, I'd say, and the data indicates that the economy is still robust. So I'm not as worried about that. I am worried about spreads in the high-yield market, and I think that at tight spreads that could really correct. And what I think people fail to realize is that when the economy does slow, rates will come down and people get excited about fixed income. But high yield, spreads tend to widen when the economy softens, and historically that's the case, and that more than offsets the decline in Treasury. If you think you might see some of that widening and some of the stress start to hit the system here, how much money are you really willing to put to work today thinking it could get worse tomorrow? So it's a good question. There are spots you can pick, and we're really excited about floating rate debt today. I heard your last guest talk about floating rate opportunities in the CLO market. We're buying a lot of leverage loans, below investment grade loans, but they're secured. They're generally 50% loan to value, and you can earn yields of 10% plus versus the high yield market, which are unsecured bonds, on average are yielding 8% plus. So we actually have a number of situations where we have long short positions on where we're long the secured term loan and short the unsecured bond of the same company and actually making more money on the long than the short. It's not supposed to work that way, right? You're supposed to get paid more when you take more risk.
That is how you make a market. Ty Wallach of Atlas Merchant Capital, we thank you for keeping an eye on everything that's a little bit riskier. Now, still ahead, the final spread, the week ahead, key U.S. data points, including GDP and PCE. This is Real Yield on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time
So in 5 minutes' time now, at the bottom of the hour, Bank of England's man speaks as a panelist at a flagship seminar on the capital flows during the IMF spring meetings in Washington. So the live video is pinned to Bank of England's man's entry on the calendar if anyone's interested.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the final spread. Coming up the week ahead, Tuesday, Tesla reports earnings, the start of a very busy earnings cycle that includes Boeing, Meta, Ford, Microsoft, Alphabet, and Barclays. And of course, a lot of economic data, PMI data, and then Wednesday, durable goods. You have Thursday, GDP data, and more tech earnings, as we've been talking about. And Friday, we'll round out the week with the PCE deflator. Let's talk about that, because for my final thought, let's think through what it really means, this number ahead. That for Fed's preferred gauge of inflation, Bloomberg Intelligence says that when it comes to PCE, it would look less alarming than that hot CPI print posted recently. But there are still hints of persistent inflation outside of the Fed's preferred gauge. And that's creating complication around the idea of rate cuts coming all before the big Fed meeting for the first week of May. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think
shortly expecting comments from Bank of England's man.
Financial crisis is a very low probability. When someone says their biggest worry, it doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to Bloomberg Markets. I'm Shonali Basak. We're looking at the S&P 500 falling below 5,000 as the Fed resets the clock on its first interest rate cut. Now let's get a check on those markets here because you have the S&P 500 hanging out, as we've been saying, below 5,000, and also some pressure on the NASDAQ 100, down now more than 1.8, almost 1.9%. The two-year yield, you were seeing a little bit of a bid earlier in the day, but now we're back up to 497 on the day. The yield's moving just a bit higher. Same goes for the 10-year yield, up about 462 on that day. Now we're going to look across asset really quickly here because you have seen oil on the rise in the middle of tensions brewing in the Middle East. You have New York crude well below the highs of the week, over at about $83 nearly on the day, up about 0.25%. You have the dollar spot index on the rise once again. Gold spot below the highs that we saw of 2,400 an ounce last week, but still on the rise for multiple days. Bitcoin also on the rise as we await to see how the halvening goes for that cryptocurrency. Now, some movers on the equity side here. Paramount shares are making big moves as Apollo and Sony are said to be considering a joint offer for the media company. Bloomberg Intelligence says this move to submit a new all-cash offer would likely assuage financing concerns. And Procter & Gamble reportedly quarterly sales that fell short of analyst estimates, overshadowing an improved profit outlook. The company's also on track to boost its prices for a sixth consecutive year. More on the state of the consumer in a moment. P&G now down about 0.5%. And Netflix, blockbuster earnings report with subscriber growth doubling Wall Street expectations, but shares are under pressure after the company announced it would stop reporting subscriber data and offering weak second quarter guidance. You have Netflix down now nearly 9%. And let's talk about what's happening in Congress now, because while the House advanced a long-stalled $95 billion aid package for Ukraine, Israel, and Taiwan, it also includes a provision to ban or divest TikTok within 9 months. Bloomberg's Tyler Kendall joins us now with the details. Of course, this is a procedural vote. This will go through the weekend. What can we expect, Tyler?
Hey, Shonali, that's right. So this was a procedural vote, but it's important because it essentially sets up Congress to pave the way for a finalized vote over the weekend on this critical security assistance that they've been trying to pass for months. This is a $95 billion package that would include aid for Ukraine, Israel, and also Taiwan. And as you mentioned, as we've been following closely here at Bloomberg, it includes a provision in there that would essentially force TikTok to divest from its Chinese-based parent company or face a potential ban. Now, we are expecting lawmakers to work over the weekend on this. And importantly, if we learned anything from this vote today, it's that we're expecting this to pass overwhelmingly and on a bipartisan basis. More Democrats than Republicans actually voted for this bill today. And as you know, the House has razor-thin margins of this Republican majority. So House Speaker Mike Johnson really needed Democrats to not only get on board with this aid plan and to support it, but also to come to his defense if he potentially faces an ouster. He's getting some really strong pushback from some conservative members in the party, notably Congresswoman Marjorie Taylor Greene, who's essentially threatening to put forward what's known as a motion to vacate and oust Speaker Johnson. So this week, we've really seen Democrats come to his defense, saying that he put forward this aid, they would actually support him if it comes to that. Next up, we're expecting this finalized vote likely tomorrow, and then the Senate will have to repackage this. I actually spent a long time on the Hill this week talking to senators about this moment, what would happen. I caught up with Senator Tom Tillis. He's a Republican from North Carolina. Sonali, you know him from the Banking Committee. He told me that the Senate will be ready when they get this. They don't care how the House passes it, as long as they pass it, so they can get it to President Biden's desk.
Certainly a lot happening over the weekend. Bloomberg's Tyler Kendall, we thank you for your time, for your very deep reporting. She always knows what's going on the ground. We're now going to bring in also Ann Berry, Threadneedle partner and founder, who has been watching the TikTok saga, let's call it. How do you think of the future of TikTok does play out? Of course, we know the company themselves has been lobbying against this move.
There's a very long way to go, Sonali, before TikTok disappears from the devices of US consumers. But look, the fact that this is being fast-tracked shows clearly, I think, that something is going to happen. The lobbying against will continue. The counter-suing, I'm sure, will come up. We saw the pressures being applied by China overnight, Sonali, with moves to try and push Apple to withdraw, for example, WhatsApp as an offering on iPhones. So look, I think this is going to take a long time to play out. I do ultimately think perhaps TikTok gets sold, minus the algorithm that has our, security minds very concerned about TikTok. Something will happen, but it's just not going to happen overnight. It's going to be a long way to go.
You and I have talked a little bit about the impact ultimately for the other social media giants based in the United States, particularly Meta. Of course, we see a flurry of earnings next week alone. How do you think over time that executives will address the opportunity here to step in with the uncertainty around their other large rival here?
Well, Instagram Reels, owned by Meta, Sonali, really is the play, I think, that stands to gain the most from TikTok either being banned or being sold in a weakened form. And if you look at the outlook for Meta's earnings, Reels are becoming an increasingly large part of that firm's advertising revenue stream. Morgan Stanley anticipating $28 billion, up 120% for Reels' contribution to Meta's revenue stream. And, as TikTok goes away as the leading and the fastest growing short-form video platform, Reels really stands to gain. And advertisers are going to have to think very carefully about reallocating their budgets towards other platforms that have really been impeded by TikTok's growth in recent years.
Hey, Ann, what is your favorite pick going into this earnings cycle, given that we have so many of those tech giants starting out next week?
Sonali, I take a look at what's happened to Netflix in the last 24 hours and say, okay, what does that tell us about the appetite of the market for messages they're looking for in earnings right now? Netflix had unbelievable outperformance versus some of its core metrics, and yet the share price is being punished because the outlook for the rest of the year implies a slowdown in growth, and there's going to be opacity around its key metric. So I think as I look ahead to next week, what's going to be really important, market is going to get confidence from clarity, transparency, really continuing to see reinforcement of back end of the year growth guidance, something Netflix was weaker on. And as I look at that, I think Amazon's really well positioned. It's been a favorite of mine for a long time. So many levers to pull, from continued growth in the cloud, everyday essentials doing pretty well for a pressured consumer, continued move on the video side into sports. And I think Andrew Jassy's got the company all guns blazing with many, many different ways to grow.
When you look at some of these tech giants, is the risk more to the downside at this point, given the valuations that we have seen in the last 6 months?
Yes, I think the risk to the downside, Sonali, sits in the latter part of your question. I don't think the risk to the downside is around the actual absolute earnings performance. And for big tech, it's actually been pretty strong if you look at the last couple of quarters, especially on the cost-cutting side. What I fear is that priced into the valuations we see in big tech at the moment are expectations around, for example, generative AI delivering measurable, monetized contribution to the bottom line. And I just don't think that a lot of the big tech companies can point to hard numbers justifying the AI euphoria that we've seen over the last 4 to 5 months. So that's my concern, not the earnings dollars or the earnings trajectory, but the expectations being set far too high relative to where trading and those deliverables could be right now.
And because you do like the AI sector here, and you have said so much about Amazon already, outside of Amazon, is there anything you like, especially where valuations have run?
Well, I think Alphabet's got its work cut out for it. It really needs to show some progress on generative AI, really sort of pushing in and delivering both efficiencies, seeing that come through on the margin side, and understanding how they can follow in the footsteps of Microsoft, that's been pretty savvy and pretty explicit about how they're going to price their AI offering to their consumers. I think another piece that's sort of buried in this a little bit, Shonali, and where I'd be looking out for this on the earnings calls, if it's not necessarily in the headlines, is a lot of these players have been trying to move and partner with the likes of Disney, the likes of others, to try and figure out a way to move more aggressively into using AI for ad tech, for advertising technology. Again, something touched on by Netflix. That's a theme I think we're going to hear get louder and louder and louder with the likes of Amazon to go back to as it talks about the ad platform that's sitting inside its content business.
And as we're speaking, we're looking at the lowest levels for the NASDAQ 100 since January, actually hitting session lows as we speak. And Barry, we thank you so very much for your time. That is Threadneedle partner and founder from Washington to Seattle. Now, coming up next, we're going to talk about American Express because revenue jumped as U.S. consumer spending stays strong, but the company still sees cracks in small businesses. It's our stock of the hour. Up next, this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. The world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's time now for the stock of the hour. American Express reported revenue that topped estimates in the first quarter as consumers flocked to premium credit cards. Revenue jumped 11% in the quarter and expects full-year revenue to climb 11% as well compared to 2023. And CEO Stephen Squeri told Bloomberg, quote, that the softness in the business is small businesses due to the organic decline, but otherwise it had tremendous growth and it is just tapering off a little bit. And we're going to discuss what's going on with Amex with Bloomberg's Catherine Doherty. You know, it's interesting because one thing that the market is really shrugging off is this idea of provisioning for bad loans, this idea that $1.3 billion to cover loans that go bad was higher than last year. Last year, the market kind of freaked out when they put those provisions up. Why does it not matter now?
It does seem like the market is digesting this in a different way. Analysts were expecting 1.1, so the 1.3 is only slightly higher. But if you just look at the numbers of what this company is actually making, what they're generating, and comments like the softness, they're not seeing that as it relates to the demand for premium cards. I think all of that is seen as a bright, forward-looking commentary that is really helping the market digest this in a positive way.
Well, it begs the question if we are seeing really a lot of the card growth come from the wealthier consumer. Where exactly are they seeing the biggest areas of growth?
So today they talked a lot about spending on airline travel being up. What was really interesting is that was boosted from bookings in the front end of the plane. So this is first class tickets, business class. So you're really seeing that the demand is coming from the higher end, the significant spenders that are looking for perks, they're looking for travel and other luxury items that they can spend on. And it seems as if the strength is still there and will continue. And so when you think about the weaknesses, as you had alluded to in the beginning, the CEO is saying that the weaknesses are at the lower end spenders. But again, it seems as if these premium products are catering to the higher end spenders.
Leverage is alive and well so long as you are flying first class. Bloomberg's Catherine Doherty. Earlier this week, we also learned that U.S. retail sales remain strong. We're going to discuss the state of the consumer with Rodney Williams, the co-founder of Solo Funds, a financial services company focused on community banking and lending solutions. And he says, quote, the fact is more Americans than ever before are living paycheck to paycheck with limited savings. Rodney Williams joins us now. Rod, what do you think is exactly happening here in the economy? If the data shows so much strength, but we know anecdotally that so many people feel stretched, how do you explain what's going on?
Well, I think the strength is related to the employment rate, and that's great, or it's in a good place, but you have to also talk about surging gas prices, sky-high mortgages. I mean, rent is at an all-time high. I mean, if I'm correct or not, rent rose 6.5% in the last 12 months when you look at the previous December. Inflation is real. You almost can kiss this notion that it's even under control or slowing down. To this average American, things like food, fast food, is significantly more expensive than it has been in the past. And this is causing constraints that you wouldn't imagine, where people are living really, really slim despite having solid employment.
One dynamic that I've been wondering a lot about is if you look at the data coming out of the largest banks, you see a drift higher in FICO scores. This idea that they are catering to the consumers with fortress balance sheet. If you look outside of those with a credit score outside of 750, let's call it, and that's even lower than Bank of America's average on a lot of business lines, how much do you see them having to put ordinary goods, groceries, gas on their credit card bills at a time where also APRs are sky high?
Well, I think not only are APRs at a sky high, balances on credit cards are at an all-time high. So you're absolutely right. The average consumer is putting more everyday expenses on their credit. That includes planned expenses and unplanned expenses. Those things still happen when you live every day. And that means a medical emergency, that means the flat tire. So, what we see is that, number one, there's more consumers today that are over-leveraged than ever before. When you think about a product like what we offer, which is a community-based loan for a few $100s, we see more users that make over $100,000 a year and have a healthy FICO than we've ever before seen in our history. it's talking about a couple of different challenges. I think the number one challenge is expenses are higher. I think the number two challenge is that getting a flexible loan to manage the rising costs is actually also extremely difficult.
How do you think about the crunch consumers are being put under as they take on more debt? Do you think it's going to create a vicious cycle of sorts?
Yeah, I have a big problem with the concept, right? When you think about the FICO and you think about credit, paying a credit card over time is what it's taught. Installment loans are what we have communicated as a benefit. It actually creates the current problem, which what you see is stable or increase in FICO scores, but consumers being over leveraged, meaning they have too much credit, meaning their balances are too high. This creates a scenario that they're living in a really sensitive place. You know, in 2023, we ran the cash poor report. And this is what we were talking about, where consumers are cash poor but credit rich. And that is the same problem. It's almost an evolved problem that we're seeing today, where more expenses than ever before are being managed by credit facilities and credit products that are paying over time and incurring a ton of fees, which continue to kind of create this cycle. We think it's a big problem.
What's not being reflected in the data that you see from the Federal Reserve or a lot of these banks? The reality of the buy now, pay later revolution, let's call it, is not reflected in FICO scores and is not reflected in credit card balances. Are perhaps consumers more levered than meets the eye?
They're definitely more levered. But these products only exist because consumers need them. They're demanding them, you know? And it's not like the traditional players were trying to introduce these products. It's not like our traditional banks were trying to think of innovative solutions that were meeting the needs of these consumers. These fintechs have been doing this. My company has. So for me, I think what's the problem and the message is that I truly believe regulators and politicians need to figure out how to work alongside technology and innovation to start to bring better products or support the products. I think there actually needs more support for the buy now, pay later, the earned wage access, and the community-based finance solutions of today. Because when you think about their penetration,
in 10 minutes time now at the top of the hour, see the release of the weekly Baker Hughes numbers. Oil rig count, the prior was 506. Total rigs, the prior was 617.
Or some credit card facility. Traditional players are still by far the number one players to everyday Americans.
Rodney Williams, co-founder of Solo Funds, we thank you for shining a light on the bigger picture here. Now let's check markets before we go to break, because we are watching markets really on the decline here. The S&P 500, the 6 days of losses that we're seeing is actually the longest losing streak since October of 2022. Today's losses alone don't tell you the whole picture. The NASDAQ 100 now down more than 1.6%, a little bit off the session lows, but still down on the day nonetheless. The VIX has been on the rise, trading at more than 18 handle, brings you at a VIX today above the levels you're seeing VIX futures in May trading, and the 10-year yield hanging out at around 461, a little bit of a bid in the bond market, but not all that much. Stick with us, more ahead. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate Just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Time now for the Wall Street beat. Paramount shares are popping as Apollo and Sony are said to consider a joint offer. Paramount is currently in an exclusive negotiating period with Skydance, and the decision is mostly up to the Redstone family, who owns less than 10% of Paramount, but controls 77% of the voting stock. Let's discuss this with Chris Palmieri of Bloomberg News. Chris, let's talk about the offer, the Apollo-Sony offer. To begin with here, how much does that give the Apollo team?
It definitely gives them a lot more credibility, not that Apollo lacks in that, but it's been very interesting to watch Apollo. We broke the news that they were interested back in January, but then things got cold for a while. We had heard that they actually weren't moving forward. Things escalated with David Ellison and Paramount. Then Apollo made an offer just for the film studio, which was something the Redstones did not want to do, break up the company. Then I'd also been told that they just didn't feel there was enough, that it was a solid offer when Apollo made an offer for the whole company, $26 billion, including debt. And so they've been in this exclusive period with David Ellison. But this, you know, adding the Sony element definitely creates a more credible alternative, and investors are not happy with the terms that they're hearing from the Ellison offer.
So how much does it really give Apollo credibility in terms of financing?
In 5 minutes time now, at the top of the hour, you see the release of the weekly Baker Hughes numbers. Oil rig count, the prior was 506. Total rigs, the prior was 617.
Well, you know, we had a story up today that sort of really looks at this whole process. Securities law, and has been moving even more in this direction, wants to give, even if you're a non-voting shareholder, which Paramount has a lot of, they say that those folks should get a voice in a big transaction like's being talked about. Now, there's nothing in Paramount's bylaws or in the law explicitly that says the Redstones can't just continue to exercise their power as the controlling shareholders. So they're not required to give everybody a vote. But if you've watched the way the stock has traded, the A shares and voting shares have gone up since all these merger talks have happened, because the Redstones own most of them and they would get bought out. And the B shares, the non-voting shares, have gone down for the most part until the big bump today, because investors are concerned that a deal with the Ellisons is going to dilute them dramatically.
Chris Palmieri of Bloomberg News. We have to leave it there, though I wish that we can keep going. I'm very curious to know what David Ellison is up to right now. Now, quick check on the markets before we let you go, because we've seen a sell-off underway today. Of course, we're only down about 0.6% on that S&P 500, but more than that on the NASDAQ 100, and of course, the longest losing streak in the S&P 500 since we've seen in October of 2022. Of course, yields have been on the rise all week. Stick with us, though, through the close. That does it from Bloomberg Markets today, and this is Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia.
So we're shortly expecting the results of the US Baker Hughes rig count. On release, we'll lead with the oil rigs.
From our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Funding for Ukraine and Israel set to pass the House this weekend. Welcome to the fastest show in politics.
Total recount 619. 619.
Important hurdle today that will set up votes tomorrow. I'm Joe Matthew alongside Kaylee Lines in Washington. And Kaylee, once again, Mike Johnson is getting a huge boost, actually able to get things done with the help of Democrats, as so many conservative Republicans oppose this plan.
Yeah, 316 in total voted to advance this package, which will set us up for final passage on Saturday. More Democrats than Republicans voted for this. And now it's going to be a question of whether Democrats also might need to stand up to protect the Speaker, as there is now a third Republican who has signed on to the motion to vacate, as Congressman Paul Gosar of Arizona joins Tom Massey and Marjorie Taylor Greene.
And oil rig count 511. 511.
Addition here, because the Freedom Caucus met last night and decided they didn't want to pursue a motion to vacate. They're concerned about the devil you don't know, whether it's Steve Scalise, Tom Emmer, a more establishment-oriented Republican who doesn't share the same values. So you wonder if this is just bluster or if we see something happen here.
Yeah, and of course they're also considering that this is an election year and it could potentially have political blowback for the Republican House majority. And of course all of this progress on foreign aid passing through Congress comes against a backdrop of maybe some degree of escalation in the Middle East as Israel strikes back on Iran, but in a limited fashion. We're going to have more on the latest with our very own Nick Wadhams here in just a minute. First, though, as always, we've got to get a check on the markets with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much. What a week this has been. Another down day, 6 in a row if you're counting. And yes, we are here at Bloomberg for the S&P 500 index down 26. We are below 5,000 at 49.84 right now. We are looking at a loss of just about 0.5% on the S&P. Dow Industrials up, however, up by 191 points, up 0.5%. NASDAQ also in the red. Big tech sinking today. We've got the NASDAQ Composite Index down 1.5%. Amidst all the gloom, however, small cap shares are advancing. Russell 2000 up today by about 0.1%. Your 10-year checking in at 4.61% with a 2-year now yielding 4.97%. Spot gold is trading higher by $21 the ounce, almost 22, up 0.9% right now. 24 even on the precious metal. West Texas Intermediate crude advancing today by 1%.
Bank of England's man says the clear concern is fragmentation impacts on inflation.
1% right now, 87.60 for a barrel of WTI. Bottom line here, a lot of traders refraining from making riskier bets ahead of the weekend amid all those geopolitical uncertainties. Tesla shares, they are down right now. We've got Tesla trading lower today, down 0.7%. Tesla recalling almost 3,900 Cybertruck pickups to rework or replace accelerator pedals that can dislodge and cause the vehicle to unintentionally accelerate, increasing the risk of a crash. Again, Tesla shares, they're down now by just about 0.8%. Again, recapping, stocks are trading mixed. S&P down again today below 5,000. S&P down 25, down 0.5%. The balance of power continues. The Friday edition. Back we go to Washington. Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Charlie there, Joe, talking about markets reacting to geopolitical risk. As we did see overnight, something we knew might be coming, some form of Israeli retaliation for the Iranian strike of last weekend. More than 300 drones and missiles were sent Israel's way, largely intercepted. Much more limited drones sent to Iran, and
That's
also
for sure.
Iran says this attack was unsuccessful.
Yeah, we saw a little spike in oil prices on that. Not a shocker there. We spoke earlier today with Mick Mulroy, who's the former Deputy Assistant Secretary of Defense for the Middle East. Kaylee, he described this as de-escalatory. The sort of restrained nature of this, kind of a warning, if you will, that we can get inside Iran if we want to, but we're not going to cause any damage today. It might be enough to put this to bed for a moment, but we'll have to give this some time. Something Nick Wadhams is covering for us. He leads our national security coverage here in Washington, and we've talked a lot about this in advance of the retaliation. Nick, what do you make of this now that we've actually seen Israel respond? Is this it? Was this just the reminder to Iran that, in fact, it can infiltrate Iranian territory without their knowing?
Right. I mean, you know, it was an extraordinary situation last night because we started to see these reports that there had been an Israeli attack and then quickly confirmed them from U.S. officials telling Bloomberg that, yes, it was in fact an Israeli attack. But then we all sort of paused a beat to see, well, what was coming next? Or were we going to get an announcement from the White House? Were we going to get an announcement from Israel? Were we going to get a damage report? You know, we were sort of anticipating, in some ways, this big response to that Iranian barrage that saw 300 missiles and drones hit Israel in obviously very public fashion. But then it was just silence. The U.S. issued no public statement. Secretary of State Tony Blinken declined to confirm it when asked about it at a press conference today. Also silence from Israel, in keeping in some ways with their past practice of looking to operate in the shadows here. But what we do know now, based on conversations with intelligence sources, is yes, this was designed to send a very specific message. You look at the area where Israel struck Iran, around the city of Isfahan, the site of one of its biggest drone manufacturers, and also, not incidentally, believed to be the site of some of Iran's nuclear work. So very much a demonstration there by Israel that, listen, we have the will to strike you when we need to, but we do not want to start this escalatory spiral that could provoke a wider war. That's the interpretation so far we're hearing.
All right, Bloomberg's Nick Wadhams, who leads our national security coverage, thank you so much for giving us the latest. It's obviously much to keep track of, Joe. And he did mention that we did hear from the U.S. Secretary of State about this, not directly commenting on the attack, but speaking more widely about the state of play in the region at the G7 meeting in Italy. Here is the Secretary of State earlier today.
First, the G7 condemned the unprecedented Iranian attack on Israel. Unprecedented in scope and scale. Scope because it was a direct attack on Israel from Iran. Scale because it involved more than 300 munitions, including ballistic missiles. We're committed to Israel's security. We're also committed to de-escalating, to trying to bring this tension to a close.
That was Secretary of State Antony Blinken speaking at the G7 alongside many other U.S. allied countries, including some from Europe. And so we want to get more perspective now from the European Commission. Valdis Dombrovskis is joining us now here in our Washington, D.C. studio on Bloomberg Television and Radio. He is the European Commission Executive Vice President for an economy that works for people. Sir, thank you so much for being here with us today. If we could first begin, given the developments overnight in the Middle East, knowing that you primarily look at the economy, how concerned are you about possible escalation from here and the impact that that could have on energy prices, which we know has been highly problematic for the European economy in years past?
First of all, we see that the world economy is proving to be resilient despite a difficult situation and different geopolitical tensions and conflicts we are currently experiencing. And also the impact on energy prices so far has been quite limited. Obviously, we need to monitor closely all of those developments, but the assessment is that the risks to the economic outlook are now broadly balanced.
You've been in Washington here meeting with lawmakers about the big story that we've been talking about here for months, Mr. Executive Vice President, and just today we saw an important procedural vote pass for funding for Ukraine, Israel, and the Indo-Pac region. You're obviously very concerned about funding for Ukraine. What did you tell
When asked if recent yen moves justify foreign exchange intervention by Japanese authorities, IMF's Japan mission chief said she firmly believes G7 nations, including Japan, are committed to flexible FX regimes, and says the Bank of Japan will likely have room to raise interest rates further, though future tightening must be gradual and data-dependent.
So far, we have provided support of around 100 billion euros. We now have 50 billion euros Ukraine facility for the 4 years, 2024-2027. We are already disbursing from this facility. So it's important that also other international donors, and first and foremost US, come also with their contribution. And therefore, I'm very much look forward for tomorrow's votes, and hopefully this Ukraine support is being approved, because what we see is that in last months, actually the situation in Ukraine is deteriorating for the lack, especially of military support. We see it both at the front line, and we see it with daily shellings of Ukrainian cities, residential areas, critical infrastructure. So this support is very much needed. I would say the collective West has all the necessary resources to stop Russia, not to allow this shelling to take place. So hopefully this period of undecision and deterring is coming to the end, and we will be able to come with a strong and firm response to Russia, and also to other autocrats around the world, because it's also not only about Ukraine, it's about our collective security.
Well, sir, as you outlined there, the amount that Europe already has contributed to the Ukrainian cause, it's worth pointing out that there is at least a faction of thought here in the United States that thinks Europe is not carrying as much weight as it should be. One of them is the presumptive Republican nominee, former President Donald Trump, posted on social media yesterday, effectively, to summarize his words, saying that Ukrainian survival is